A very good morning to all of you. So before we start, I would like to call our today's speaker, CA Pratima Narang ma'am. Please come on the stage and join us. I would request everybody please raise so that we can have ICI motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैत 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 एतद्वैत.
Before we start our today's session, I would like to let you know about our upcoming program for the December month. So if anybody is interested, can enroll from our website. So on 15th, we have CP program on appeals and drafting. On 16th, we have a holistic review of learning for regulatory observations and contemporary practice issues. On 17th, we have CP program on valuation. 18th, we have CP program on mutual funds. 19th and 20th, we have a national conference of AI. This is being considered as a pre-event of India AI Summit 2026, organized by Ministry of Electronics and Information Technology. 22nd, we are doing IAP jointly with Hindustan Chamber of Commerce and Tamil Chamber of Commerce. 23rd, we are doing one-day CP program on audit process and RBIA using tools. 24th, we are doing CP program on labor laws. 26th, one-day training program for peer reviewers. 27th, one-day program, CP program on CSG and BRSR. 30th, CP program on Income Tax Act 2025. So if anybody is interested, please log into our website and register yourself there. So in today's technical session, we will be covering SA 510, 520, 530, 540, 550, 560, 570, and 580. So our today's speaker, Ms. Pratima Narang, she is a director in BSR and Company LLP, which is a member firm of KPMG. With more than a decade experience in audit and have spent considerable time carrying out audit under India and international GAAP. Experience include audit of large Indian business as well as multinational companies in automotive, manufacturing, IT and ITES, BPO and FMGC sectors. Experience in auditing the transaction to INDAS, IFRS and US GAAP. Experience of audit under various auditing frameworks like SA, ISA, US GAAP and PCAOB auditing standards. So before I hand over the session, I would like to call upon CA Subha Reddy. Please come on the stage to present the memento to ma'am. Thank you so much, sir. All right, thank you so much. Ma'am, with this, I would like to hand over the session to you. Thank you so much.
Hi, good morning. Thanks for the introduction. And it's very nice to see all of you over here on a Saturday morning. I would be covering 8 auditing standards over the next 3 hours. I mean, we are a bit late. So, over the next 2.5 hours, my initial plan was I do roughly about 15 to 20 minutes per standard. That would leave me with 3 minutes for your questions. I'd like the session to be extremely engaging. Auditing is all I have done over my career. So I am absolutely passionate over these topics. Any questions, anything that you need to say, I'm here. I'm happy to hear your points on these topics. Uh, the whole series of 500 related standards are surrounding substantive procedures. I'm sure you had the 200 series of standards covered yesterday, which would have been more related to risk assessment and planning of an audit. The whole 500 series is more on the substantive testing, where you get into the execution of the audit. Simple standards, we'll get through it as we go through this. I'll start with the first one. First one is SA 510, which is audit of initial engagements. To put it very simply, if there is a new client that we've won, the previous year financial statements would have been audited by another auditor, whilst our audit report is on the financial statements for the current year, where we would be issuing our opinion. But does this mean that when we take over a new audit, can we just not do anything over the opening balance because another auditor has signed it? The answer is maybe not, and which is why the SA 510 has been issued. You're not required to re-audit the entire opening balance sheet for the simple reason that it has already been audited, and it's unfair to the client for it to re-go through the entire audit process again. However, as an auditor, we are required to do certain procedures over the opening balances, primarily first so that it helps us in our risk assessment for the client. Second, it lets us know if there were any material misstatements in the opening balance sheets that would get carried forward in the current year. And third, it would also help us understand if there have been any substantial changes between the last year and current year, which need to have an impact on our current year audit procedures. I know what I've spoken is a lot of English, but then we will get through it as I get into the slide. Okay, I think we spoke about the fact that, it is relating to initial auditor engagements. Now, the whole point is that you just need to obtain sufficient appropriate audit evidence to ensure that the opening balance sheet does not have any material misstatement that would impact your current year's audit opinion. That's the simple crux of the standard. Now, how do you go about with this procedures? Now, the point is simple. Now, when you are I explained the problem statement. Now, what are the things that you do? Step one, obviously obtain the previous year's audit report and financial statements, read through it. If the previous year auditor has had a qualification or any remarks in the audit report, you need to factor if that could have a bearing on your current year audit, or if you need to modify your procedures accordingly. Second, you need to obtain certain evidences to ensure that the opening balances are appropriately carried forward in the current year. Now, how do you go about this process? The standard has laid out certain procedures that are recommended for you to perform on the opening balance sheet. You could stick to that. First step you necessarily need to do is to see that the closing trial balance, which was there included in the last year's financial statements, is the one which is carried forward in the current year. That, to make sure the carried forward has happened appropriately, is still your responsibility. Now, on the accuracy of the balance, what are certain procedures you need to perform? We'll keep seeing in the upcoming slide. Now, if you believe that the previous year financial statements have had some misstatements that could have a bearing on your current year financial statements, it is still your obligation to evaluate its impact on the current year's audit report under SA 705. We'll get into case studies to see with more examples. I have a few more aspects after the case study which I want to speak, because one could always have a practical question as to, while I said you need to perform audit procedures over opening balance, what are these procedures? How detailed do I need to get into? I'll get into that later. First, we'll look at the reporting consequences and the issues that arise from this standard. So now if you take this case study here, let's see this. During the audit of Trident, the auditor noted that the company had changed its depreciation method from written down value method to straight line method at the beginning of the current year. the auditor needs to evaluate whether this change has been accounted for appropriately and disclosed appropriately. The fairly straightforward case. Now, if you had read the previous year financial statements, you as an auditor would have known that the company had earlier adopted written down value method for depreciation. When you get into the current year audit, you would know that the management has changed it to SLM. Both under AS or Ind AS, I think the standards from their perspective are fairly clear that when the method of depreciation is changed, management needs to have an appropriate basis for such change. It cannot be that they ad hoc realize that the method needs to be changed. So step one, you will obviously need to understand what led to the change in method of depreciation. Second, because you have an understanding of the opening balance, because you've looked through the previous year financial statements, you would know the change is warranted. Any change that is warranted would appropriately have to be factored in the financial statements and disclosed. Now, with the updated way in which the financial statements are, you will look at it as from a prospective. I mean, the change in method of depreciation would be prospective. But that being said, you will still have to ensure necessary disclosures come into the financial statements, and also the impact has been appropriately factored in the current year. Therefore, it becomes very essential for you to know and understand the previous year's accounting policies from the financial statements so that you can evaluate how it will have an impact in the current year. In this scenario, obviously, as an auditor, you look through, understand the reason for change, see the impact, ensure the disclosures go into the financial statements. If all of this is appropriate, then I think you've done a reasonable audit. We'll move to the next one. During the audit of Orion Electrics for the year 24-25, the auditor noted that the opening inventory had been overstated in the prior year due to an incorrect valuation method. The overstatement, if uncorrected, would materially affect the current year's cost of goods sold and profit figures. Now, this is a scenario where the auditor carried out certain procedures. Now, when I said you have to make sure that you do the audit of the opening balance, now let's just take a scenario. Your opening balance had inventory. You do the audit for the year ended 31st March 2025. Your opening would have been 1st April 24. That is, the year end would have been 31st March 24, and that was audited by another auditor. You've come in midterm. Obviously, you would not be able to do a physical verification of inventory of the opening balance. But that being said, you should be able to get enough data to understand the method of inventory valuation. And if you look through that and you have a fair understanding of what are the permissible method of inventory valuation under the existing accounting standards, you would also know if the inventory is overvalued or undervalued. I mean, that level of information you would be able to get. If in this scenario, what has happened is the auditor has come across a situation where the opening balance of inventory has been overvalued. Now, what happens if the actual valuation should have been 100, and let's just say the opening valuation led to an answer of 200. Now, you believe this is overstated by 100. Naturally, even if you correct it in the current year, the only way this can be corrected is by routing it through cost of goods sold, which means that this will also impact the profit for the current year. So although it's a previously audited financial statements which has a number, there is an overstatement. Correcting of that overstatement is going to impact your current year's audit. In this scenario, obviously, you as an auditor need to ensure that the computation that you now do is appropriate and you arrive at what is the quantified misstatement, evaluate its materiality, discuss with those charged with governance. By that I mean, I'm hoping SA 265 was covered yesterday. So communicate it to those charged with governance, whoever be the case, board members, audit committee, as the case may be. Now, ensure that when you do your current financial statements, if this misstatement is corrected, depending on the accounting framework in which your financials are prepared, you would be giving effect to it. The reason I say that is under Ind AS, you can't touch the previous year number. It will end up in a restatement. If it is accounting standard, then there is a separate accounting standard relating to prior period. You will accordingly account for it. And if this is corrected in the existing financial statements of the current year, you will still evaluate if a prior period impact is material, then should you then therefore give an EOM as well. Because if a previous year number is impacting a current year, either by way of restatement or if under AS where you don't do restatement by adjusting it in the current year, you will have to evaluate if you want to give an emphasis of matter to draw the user's attention towards it. Depending on the magnitude, it is level of professional judgment, but that's something I would want you to ponder upon. And if the current year financials are free from misstatement, the opinion would obviously be unmodified. I hope I've explained this a bit clearly. Yes, someone has a question? Yeah. Would you want a mic?
Hello. Madam, suppose in case there is a change in the grouping of accounts in the previous years, and according to that line, current year also it is regrouped. Is it forming part of the modification in the financial statement?
Okay, so if your financial statements are prepared under Ind AS and you are doing a reclassification in the previous year, a reclassification in the previous year would also form part of a restatement. Okay, and the reason I'm saying all of this, assuming it's material both quantitatively and qualitatively. So if this is an Ind AS financial statements, it is although an accounting question, I'm answering it, but still, since you asked, I will say, you will have to evaluate if you've identified an error in the classification in the previous year. If it's material and you want to give effect to it, if it is under Ind AS, it would still lead to a restatement. If it's not material, then you change the current year and let the previous year be as it is. If it is material under AS, then under the AS, the standards are fairly relaxed. You can do a previous year reclassification and that shouldn't be a problem. You just give a note in the financial statements that the previous year numbers have been reclassified to conform to the current year reclassifications. I hope I answered your question. But to the extent of SA 510, classifications of the previous year do come in under your scope to make sure that it's comparable with the previous year. So you will have to evaluate it. I think you have a question. Yeah, you will really have to help me with the mic.
Hello. Ma'am, say suppose in financial year 24-25, I have adopted for Ind AS and I did the Ind AS convergence. So and I gave all the appropriate impact every game. Now while verifying the opening balance, the auditor got changed and the new auditor, while verifying the opening balance, I came to know that there was a material impact in the Ind AS convergence and the effect given in the 24-25 financials. Now how I need to consider, ma'am?
Okay, again an accounting question, but then let me understand. This is an auditing standard course, but yes, for me to understand your question properly, you're saying that this 24-25 is the year in which you did an Ind AS transition. If 25 is your first year of Ind AS, you will give effect to Ind AS. Your transition date would be 1st April 23. And when you went to 1st April 23 to give effect to Ind AS, you identified there was a misstatement. Was the misstatement on account of transition to Ind AS? Was it wrong in AS also, or was it wrong only because you moved to Ind AS?
Because we moved to Ind AS.
If you move to Ind AS, then it's anyway a gap difference, no? So no, that wouldn't be.
While giving the effect in the financials, there was they gave the effect. While verifying, I came to know that the effect the procedure they followed, there was a material misstatement in that procedure.
Yeah, a material misstatement under what gap? Was it wrong under the erstwhile gap also, or is it just that in the current gap there has been a problem?
In the current gap.
In the current gap. So if it's current gap anyway, my question is a gap difference between AS and Ind AS, or is there no gap difference between AS and Ind AS?
There is no gap.
There's no gap difference between AS and. Then you're anyway transitioning, no? I mean, when you transition to Ind AS, you give effect to the previous year also. You're anyway restating. I mean, when you move from one standard to another, if 25 is your first year of Ind AS, 1st April 23 would be your date of transition, which means 23 and 24 would anyway be translated to Ind AS. If there is a gap difference between AS and Ind AS, you will be giving effect to this adjustment. If there is no gap difference between AS and Ind AS, then it means that there was a misstatement under AS itself. If you come to a conclusion that there was a misstatement within AS itself and not because of the new accounting standard, then it means that the opening balance sheet is misstated. Now here as an auditor, you need to evaluate whether does this misstatement get carried forward. If you were to rectify this misstatement, would it mean that your current year numbers would be impacted? Then in that case, you will have to give effect to it in the current year, call that out as a misstatement in the previous year and evaluate if you want to give an EOM or not. If the client still doesn't agree to correct it in the current year and as of March 25 the misstatement continues, then obviously in March 25 you will give a modified opinion. I hope I answered the question. Okay, should I move ahead? During the audit of Nova Polymers Limited for the year 24-25, the auditor discovered that the accounting records of 23-24 had been destroyed in a warehouse fire. There was no audited financial statements which were provided. The previous year auditor and the working papers were not available. The current auditor could not verify the opening inventory and trade receivable balance, which were both material to these financial statements. Now, this is, I think, a very straightforward case. Both inventory certainly is one such balance that gets carried forward. If you're not able to get any evidence over the opening balance of both inventory and trade receivables as an auditor, then I think there is a significant limitation of scope within your ability as an auditor to perform procedures. Although it's the opening balance, but these would have a bearing on your current year audit procedures. And if you're not able to get evidence about it, I would look at it as a limitation of scope. Given that it's an area like inventory would mean cost of goods sold, purchases, materials consumed. If it's trade receivables, even the closing trade receivables would have an impact. Provision for bad debts would have an impact. I would not just look at it as material, but I would also want to evaluate it as material pervasive, depending on the client and nature of size. So if you conclude material or material pervasive, that would determine your implication from the current year audit report perspective, how you draft the modification. If it's just material, then qualified. If it's material pervasive, you will draft the limitation of scope as disclaimer. Okay. That brings me to the end of the case studies I had as part of SA 510. Do we have questions? I could pick that up. I probably have 3 minutes more. Otherwise, I could speak on potential procedures that you could do on balance sheet captions when you do an initial audit. Do we have questions? Okay. I will speak about procedures that you can do on the opening balance sheet over the next 2 minutes. So let's just say you have from an asset side, your significant assets would be, say, fixed assets from a non-current assets perspective. There, what you could do as procedures is look at the opening asset balances, see if the FA register is appropriately maintained to match with it. The depreciation method and the historic useful lives have been appropriate and consistent. And also if the accumulated depreciation has been carried forward appropriately, that I think would be fairly certain. If they have permanent assets like land and building, in that case you could look into details like verifying the title deeds, etc. From a current asset perspective, let's take two significant examples. I spoke of inventory, so I'm not going to repeat it. Let's just take bank balances and trade receivables. In the case of bank balances, what the standard says is you may consider it to send bank confirmations even for the opening balance. The word may means it's not mandatory, but then if bank balance is material to the size of your balance sheet, I think it is urged to send bank confirmation for the opening balance as well. For trade receivables, I think what you require, again, the standard uses the term may consider sending external confirmations. But then if that is not the case, and if the client, it's not permissible because the year end would have come and even the customer would get confused because they would have largely repaid the trade receivables, then you could look at the aging of the receivables to see the provisioning policy or the expected credit loss model and look at the subsequent collection of trade receivables. Come to liabilities, I think share capital, fairly simple. If you go to MCA, you would get the necessary details. From a liability perspective, I think from the standard looks at it the same as trade receivable, may send confirmation. But if may sending confirmations is not permissible, you look at subsequent payments and adequacy of liabilities from the trade receivables perspective. I think borrowings, same as cash in bank, may send confirmation. If not, look at subsequent payments that have been made during the year and reconstruct the opening balance. I have covered SA 510. Do we have questions? Till I change slides to the next standard, I could take questions. Otherwise, I will move to the next standard and manage. Thank you. Okay. We will move to the next standard, which is SA 520 on analytical procedures. I'm assuming this is a room of chartered accountants who are practicing or in the field of audit. By way of show of hands, how many of us here have used analytical procedures in the audit and actually relied on it from a substantive testing perspective? Yeah. Okay, great. Very helpful. So clearly, from an analytical procedure standard, I will look at it in three phases. One is the planning analytics. That is something you do at the beginning of the audit, and that's what's going to help you identify risk and identify anomalies within the audit of financial statements. The other is analytical procedures that you do as part of your substantive testing. My examples and case studies have situations where analytical procedures could be substantive procedures you do as opposed to the conventional test of details. And also the final analytics, that is which you do at the end of the audit to have an overall analytical review of the financial statements. Because what happens is when you look at a particular component or you're reviewing and auditing a particular component, you may look at it in isolation. But when you look at the overall analytical review as part of your final analytics, it gives you a perspective of how different captions of the balance sheet are correlated with each other. So for me, analytical review happens at 3 stages of the audit. I will focus more on the stage of the substantive testing, that is when you're executing the audit. Okay. It is simple, and I'm not getting into details to say what analytical procedures means. It means basically where you analyze the relationship between two different line items or components or two different inputs that go into it and see how it has an impact on the numbers in the financial statements. When I have audited, I have always looked, and I'm talking about the analytical procedures that are used in substantive testing. I have always looked at the audit of analytical procedure as a 4-step process. Step 1, which is where you develop your expectation. Step 2 is where you test the data where you have, that you're relying on. You test the base data that you're relying. Step 3 is where you test the set thresholds. What is an acceptable difference? Because the whole point of an analytical review is that it's not going to pi to pi match. If it's going to match pi to pi, you'd call it recomputation. So you set what is your acceptable difference threshold. And step 4 is where you actually arrive at your balance and compare it with the actuals to see what are the difference and investigate the difference. That's how I look at analytical procedures, and I'll give you an example. I will not just leave it at this theory. Take a situation where you take the caption of payroll. Payroll, I think, is genuinely an area where analytical procedures could be applied, because it's safe to say that the salary that is paid to employees in a company would largely remain the same month on month, but for the increments that are given. So you take this scenario where you're doing a substantive analytical procedure on payroll. This is an April to March audit. The company has a history where increments are given to employees in the month of October. Whatever is the average increment percentage is approved by the management as part of their annual budget, and the controls surrounding the annual budget are fairly comprehensive because even the board reviews it and approves it. Now with this background, and you are the continuing auditor of this company. Now with this background, how would you do an analytical review? You could take the average monthly salary per employee from the previous year. You know what is the rate of increment, and you know the period from which the increment is available. You could take the average headcount in the current year, multiply that with the average salary of the previous year for the first 6 months, and multiply that with the increment salary for the balance 6 months. Arrive at an expectation of what the payroll cost should be, compare it with the actual payroll cost, and investigate differences. What you could set as a threshold, I would normally, of course, I leave the threshold up to the professional judgment of the auditor, but I would look at it at 3% of the account balance or performance materiality, whichever is lower. That's how I would look at it as a threshold, but I'd leave the rest to you. Now, in this scenario, I think the procedure was fairly straightforward. What is important over here is I had three base data that went into. One, previous year's average salary. Second is the rate of increment. And the third is the average headcount of employees. These were my 3 data that went into. What I need to do my entire computation or the expectation comes from these three data. What is essential for me to do as an auditor is to test the reliability of these three data. My opening average salary of employees can come from my previous year work paper. I am the auditor, I have looked at it, so therefore it is reliable. My average rate of increment to see if it is reliable, like I mentioned, increment budgets are approved, it's comprehensive, controls are surrounding, you've tested the controls have passed. Third is the average head count. Now, average head count is the information produced by the entity. I don't know if I'm complicating. Did SA 315 get covered yesterday? Yeah. Okay. So I think that would have touched based on the topic of information produced by the entity. If not, I can still speak about it. Head count reconciliation. Basically, the head count of the employees is you have the pay register where you have the head count, and every month the client will have a procedure where they'll have opening head count, additions during the year, leavers during the year, and then the closing head count. That's where you get your average head count from. For you to be able to rely on the data, what the underlying data for this is the pay register. Now, for you to rely on the headcount number, you should be comfortable with the pay register. By comfortable, I mean you need to test two assertions over here. One is completeness, another is accuracy. For a completeness perspective, if you reconcile your pay register to your trial balance, that is a payroll versus GL reco, completeness can be ensured. From an accuracy perspective, you would have tested controls over your pay register where you would have seen sample employee files to match whether the number as per the offer letter or the increment letter is in agreement with the salary that is getting processed. So that way you will have comfort over the accuracy. So that means that the third element, which is the average head count, which comes from the pay register, is from a reliable data where you've tested the information produced by the entity, IPE. So now that your three inputs are the base data of the three inputs are validated, everything else that follows from there is simple arithmetics. How do you set the threshold? Like I mentioned, you can define what your threshold is. Threshold can never be exceeding the performance materiality, otherwise the purpose is defied. So you set the threshold and then you compute the difference and see. Now, another aspect is when let's just say you identified a difference between what your expectation was and what the actual is, and that exceeds your threshold that you've set it. So my expected payroll was 100,000. The actual payroll cost is 160,000. My acceptable threshold was 10,000. Now, in this scenario, if my acceptable threshold was 10,000 and the difference has exceeded, it means that as an auditor, I need to obtain evidence and inquire the difference for the entire 60,000, not just for the 50,000. You'll have to, because you never know if there are netting off differences between the two. So you'll have to look at the variances, or you'll have to inquire and obtain supporting documents for the entire variance that comes in. We'll look through it through case studies. Okay. During the audit of Beta Manufacturing Limited, the auditor decided to use analytical procedures for verifying consumption of raw materials. Management had provided monthly consumption and production data in an Excel sheet extracted from their ERP. The auditor noted that the consumption pattern appeared stable, but there was an unexpected increase in the material cost per unit in the last quarter. I think this is a very intelligent analysis that has been performed. What they've taken is that let's just say this is a standard ERP where your consumption report and the production data are system generated. You as an auditor have tested the general IT controls over the system. You've also tested the fact these are standard, let's just say the ERP is SAP. The consumption report and the production report are standard reports that come out of the SAP ERP. If you are able to test the general IT controls and you are able to test the system controls automated surrounding the report generation to see that the report that is getting generated is not tampered, in that case, you will be able to place reliance on the base data. The purpose of this illustration is to explain that when you take certain data, how do you rely on it? So here, it's not a manual data, it is a system generated data. If you've tested controls over the report that is being generated, you'll be able to rely to, in case the the situation was not very clear, what the auditor has tried to do is try to take the monthly consumption report, which has the value and the quantity consumed, divided the value by the quantity to see whether the average rate of material consumption per month is consistent or not. And the same exercise has been done with the production report to see the quantity produced and the total cost of production for every month, and to see whether the cost produced per unit is consistent or not month on month. This is a monthly analysis which the auditor has tried to do. And here the expectation that the auditor has set that the number every month would be the same as that of the previous month, unless there is a situation where the rate per unit has fluctuated. Then in that case, they will go and inquire with the client. Now here what is important, and while this case study's purpose was to drive home the point that the base data needs to be tested and needs to be reliable, here what the auditor should have done when they were also testing the monthly consumption pattern is to say, let's just say you are evaluating whether rate per unit of raw material consumption has been consistent month on month. You'll also have to set what is an acceptable difference threshold. That is absolutely important, because and that needs to have a rationale to it. What may seem as 5% acceptable to A might seem unacceptable to B. So now this is very specific to the client that you're auditing and the nature of audit engagement that you're doing. So when you're doing a regression analysis where you're seeing month on month, like the trend analysis, even though it's a trend analysis, like it is very easy to set a difference threshold when my payroll example, because you're actually quantifying the difference. But when you're doing a trend analysis, it's every month. Here, your difference threshold will be a percentage. That 3% is acceptable or 2% is acceptable. That's absolutely based on your understanding of the business of the client and the nature of work that's happening. We move to the next case study. Okay, this case study is on how does an auditor deals with exceptions. In the audit of Zeta Electronics Limited, the auditor noted that gross profit margin has dropped from 30% to 18% when compared to the previous year. Although sales volume and purchase prices remained the same, this inconsistency suggested in potential errors and misstatement. The management stated that heavy discounts were offered to clear off slow-moving stock. The auditor reviewed sales invoices, credit notes, and inventory report to verify the claim and compared to the selling price before and after the discount was offered during the period. Now, in this scenario, what has happened is you did a gross margin analysis. You see a decline in gross margin. When the auditor saw sales volume were very much consistent with that of last year. When they looked at the purchase prices were also very consistent with that of last year. When they inquired with management, management said there could have been discounts given to clear off slow-moving obsolete inventory. Now, auditor did the analysis where they expected that the gross margin should be consistent last year versus current year. So the basis of expectation was last year's gross margin. Last year's gross margin comes from last year's work paper, reliable. Current year's gross margin has been computed. Let's just say you set a 0.5% variance expectation in the gross margin because you've seen sales volume are constant. When you did your purchase analysis, you saw purchase prices were also constant. So you expect at best a 0.5%. But here in this scenario, auditor has obtained a 12% variance. What should an auditor do? Has to go back. One is make inquiries with the management to understand why this has happened. So when they made the inquiries, they understood that whilst the sales volume have been consistent, the selling price has been affected because extensive discounts have been given to push out the slow-moving, non-moving inventory. Now, does the auditor stop with this? Answer is no. Auditor has to get into further details to obtain evidence to see what has happened. First, whether the sales were actually made or not, because these are slow-moving obsolete goods. Sales by default, if SA 240 was covered yesterday, would be an area of presumed fraud risk and thereby significant risk. So you'll have to verify the underlying documents to see whether first the sales happened, second whether the discounts were approved, authorized and backed up by credit notes. And once you're convinced with either of these two that the sales were not overstated or the sales were not goods were dispatched appropriately and the discounts were given after appropriate authorization, only then you would conclude on these this particular substantive analytic procedures. Okay, case study 3. This is one of my like at least back in the day when I did articleship, where India's had not come in and IFRS 16 confusions were not there, auditing rent was fairly simple. It went into the P&L. And this was one such procedure which was explained to me by the people who taught me audit, that you can do this analytical review and do away with test of details. So which was in the area of rent, because it comes from a simple place that rent is it's safe to say that rent is going to be consistent month on month, unless in between there is a period where there is an escalation. But even if there is an escalation, that comes from a signed rental agreement. So you take the monthly rent from the signed rental agreement, you take the period of rent from the agreement. So all the base data comes in from the rental agreement, basis which you can set expectation for what should be the annual rental charges. You can compare that with the actual rental charges, and then you will know what the difference is. And if you're able to do that based on the underlying, and you've tested controls to make sure that control surrounding payment of rent is appropriate, you can fairly rely on this as a substantive procedures and maybe not perform test of details. And of course, if you will have the rental term, so that you can do lease equalization, recomputation, etc., all of it from one rental agreement. Any questions? That brings me to okay, so whilst you have materiality and performance materiality is simple, that if your entire account balance has that particular misstatement which is less than performance materiality, your financials will not be materially misstated. Now, a lot of times what could happen is the caption for your performance materiality could be set for a account caption as other expenses. When you're doing a rent substantive analytical review, given the rent balance, maybe you believe that as an auditor that that's a very high threshold for a variance, that performance materiality is a very high threshold for a variance. So therefore, you can bring down your tolerable threshold to 3% of the account balance. Because ultimately what you do is your substantive and analytical procedures variance should be in correlation with the account balance for which you're doing the substantive analytical review, not for the caption. So your performance materiality will be set at the other expenses level. You are doing substantive analytical review of rent, which is only one line item within other expenses. So maybe applying the whole performance materiality to rent might mean that you're susceptible to a higher misstatement. So you want to lower that possibility. That's why you set a threshold of 3% of the rental balance as an acceptable difference, or performance materiality, whichever is lower. See, your difference can never exceed PM. Then you definitely have a problem. This is to see if it can go below the PM depending on the nature of the account balance you're doing this for. Yes, you have a question. I don't have a person helping me for the mic, but yeah, if you could speak up, I'll try to hear. Okay. I gave the example where you're the previous year auditor, where you can take the previous year average pay from your last year's work paper as an example to make my example easy. In your scenario, you're not the previous year auditor. You want to do substantive analytical procedure for payroll. Where do you get that from? One way you can get this from is, you say you're the auditor for April 24 to March 25. One way you can get it is get the March 24 pay register. From that, compute what is the average pay. Can you just take the March 24 pay register and use that for average pay analysis? Answer would be no, because that per se has not been subjected to audit by you. Then that is an information produced by the entity. You do necessary procedure to see whether that information produced by the entity is reliable or not. Let's just say that the payroll register comes out from a standard ERP. You've tested GITC controls. It's a standard report that's coming out. You are assured of completeness and accuracy. You can rely on that report. If it's not coming in for an ERP, you do manual procedures to check completeness and accuracy of that information produced by the entity, and then rely on it. So you can still take the March 24th pay register to set expectation, but you will have to ensure that the base data is reliable. I hope I answered your question. So it's just 1 month pay register, no? However small the company is, you can get the March, like how you get April 24, you can get the March 24 pay register and do it. Okay. Any other questions? Okay, moving to the next standard because I'm also running short on time. And while I change slides, if someone has a question, I'm happy to answer. Okay. Next standard is SA 530, which is on audit sampling. Chronologically, I started with the opening balance sheet. When I spoke of substantive testing, I spoke about the analytical procedures that are performed. And once you perform the analytical procedures, I am a bit distracted because one of my dear colleagues is right there who walked in. Yeah. So when you do substantive analytical procedures, the next phase would be to do test of details, which is a part of substantive testing. And here's where you do the after you've done the analytical procedures, you get into a test of details, which very conventionally is vouching. How do you go about it? I think the standard sets principles on how do you go about doing the test of details or your audit sampling. I think we've all read and known enough and more number of times that we do a test check basis. What we provide is reasonable assurance. The inherent risk in the audit is that we do our audit on a sample basis using materiality consideration, and therefore we are not verifying and giving reasonable assurance. So this entire premise of reasonable assurance comes from a place where we do sampling. And how do you go about samplings? What are the factors that you consider when you are sampling? That's what the standard covers. Now, there are different factors that go into. First is, to make it very simple and not get into technical jargons, when you are deciding to do sampling on a particular account balance, you have 3 questions. How many samples do I select? How do I select those samples? If I find a difference in that sample, what do I do with that difference? These are the 3 questions that you have when you're doing vouching. I think that's fairly simple. I think the standard through all the different elaborate English is trying to address just these 3 questions. How many samples? How do you select it? What do you do when you find a difference? So first we'll come to how do you, we'll address the question of how many samples. How many samples that you do comes from a place where you have factors. It comes primarily from risk factors. You identify the risk associated with the account balance that you're considering for the purpose of sampling. Second, of the volume or the the impact, how material that account balance is. So materiality, risk associated, and the quantum. These are the 3 aspects that you identify before you determine how many samples you want to select for the purpose of auditing. Risk obviously is a combination of the inherent risk associated along with the control risk. Higher the inherent risk, higher the sample, higher the control risk, higher the sample. Now, that will give you the answer of how many. I have a case study to talk through. Yes, number of samples is still subject to professional judgment, but consideration for how many samples comes in have to follow the factors that I just said. Materiality of the balance, risk associated with it, and the quantum of transactions. All of these 3 go on to determine your number of samples. Coming to how do you select samples? Method could be both statistical or non-statistical. How do you decide when to choose statistical and when to choose non-statistical? Or maybe should I take a step back to see what is statistical and what is non-statistical? Statistical is one which follows a particular method. I will cover. I want to finish the case studies and then get to see what the standard says about statistical and non-statistical. For now, the difference between statistical and non-statistical is if you believe that volumes are very homogeneous in nature and a risk associated with a particular account balance is low, then in that case you could choose a non-statistical method. But if the volumes are not homogeneous in nature and the risk associated is higher and it's a combination of both, then you'd rather prefer a statistical method of sampling. So I spoke about how many, what are the factors you consider when you decide how many. And the next question was, how do you? Now, of course, the third question of what do you do when you find differences? there are potentially two things that you can do when you find differences. One is when you're doing your testing itself, you define what's a tolerable error. Like, what is a tolerance of difference that you can have? Depending on that, you decide whether you want to extend your number of samples or do more samples to see if the difference or the exception still continues. Or the second is you project your misstatement for the rest of the balance. So these are the only two things that you can do. I have illustrations to cover both. We'll get through in the case studies. Yeah, I think I missed speaking about these two matters: tolerable misstatement and tolerable rate of deviation. Now, tolerable misstatement comes from the place which is your performance materiality. We spoke in detail about what the performance materiality is. However, if you believe that the risk associated is higher, or you as an auditor want to reduce it below performance materiality because you believe this is prone to error, or based on your prior experience you believe that you want to go below performance materiality, you can have a tolerable misstatement threshold below your performance materiality as well. And a rate of deviation, like I mentioned, what is it that you can tolerate as a deviation in every sample you select? I will give you an example over here. Let's just say you are doing sales vouching. Simple sales invoice. There is quantity sold, rate sold, sale value, which is there in your GL listing. You trace your, you look at invoice, you look at sale order from customer, and you look at the dispatch note to ensure that the goods have been delivered to the customer. You trace the price to the sale order received from customer, you trace the quantity to the invoice, quantity and price both to the sales invoice, and then you trace the quantity to the dispatch note, which is acknowledged by the customer to ensure sale of goods has been complete. Now that you've looked at all of these documents, in such a scenario, I would take a view that the tolerable rate of deviation is 0. Because there is no judgment over here. These are goods being sold. The price cannot vary. The quantity cannot vary. Of course, there could be different industries. I'm talking of a very straightforward manufacturing industry which sells goods where there is no judgment involved in the quantity of the goods. In this, my rate of deviation could be 0. Take a scenario where you're doing inventory count in a chemical industry, where it is measured in liters, say by dipstick. And the quantity or the amount that comes in could vary based on the atmosphere. Kind could have done the count in the morning. You will go and do the count in the afternoon. The atmosphere condition could be different between the two. Here, there could be an acceptable threshold of variance when you're doing the inventory count. In this scenario, you could design, based on your knowledge of the industry and the knowledge of the client, what could be a tolerable rate of deviation in this. I hope I've explained or driven home the point of what is a tolerable rate of deviation. Okay, we'll get to my case studies. Everything else I've spoken over here. Okay. While auditing the sales transaction of Alpha Retail Limited, the auditor planned to test operating effectiveness of controls over sales invoicing. Initially, a sample of 20 invoices was selected. However, the population comprises of 10,000 invoices during the year. Now, this is a scenario to think through. Like I said, how do you select how many samples how do you select how many samples you want to audit or cover as part of control testing? For a moment, for the limited situation of this case study, we will keep the IFC guidance note outside, which gives sample range when you're doing control testing. For the simple purpose of discussion of this example, you take a scenario. You have sales. Now, the reason I kept sales over here as an example is because by default, sales is presumed fraud risk, therefore significant risk associated with it is higher. This is a scenario, while it's 10,000, it's only to drive the point that it is quite voluminous. Given that it's sales, it's needless to say that the account balance is going to be absolutely immaterial. Therefore, it is safe to say that you as an auditor, when you're testing controls, your number of samples should be at the higher end because of the risk associated with the account balance. 20 for controlled, and another, if there is 365 days in a year and there are 10,000 invoices, clearly means that it is multiple times a day occurring control. So therefore 20 doesn't even seem appropriate as a representation of the volume or the quantum of this population. You need to expand your sample size. For the purpose of this example, they chose 100 as the sample size. This is not a standard. It is left up to your professional judgment to decide. But the factors that I hope I've driven the point of what are the factors that you need to consider when you're determining your sample size. And especially if it's control, you, apart from the risk, you also see the frequency of the control, which goes on to the volume that I said. Okay. ABC is a mid-sized audit firm, was engaged to perform statutory audit of XYZ, a manufacturing company with large volume of financial transaction. During audit planning, the audit team debated whether to adopt statistical or non-statistical sampling approach for testing inventory and revenue. One of the junior team members suggested using statistical approach solely because the sample size was large, assuming that a larger sample automatically necessitated statistical sampling. This led to confusion amongst team members regarding criteria for choosing the sampling method. I think this is, I did touch base of how do you decide between sampling and, statistical and non-statistical sampling. In this example, the view that the engagement team debated and came up to was that the standard defines that your volume alone is not the basis for deciding statistical or non-statistical. It is the nature of population and risk associated. Nature of population goes by whether it is homogeneous or not homogeneous. And risk associated, I think we've spoken enough about it. Here, what the engagement team assessed is that the risk associated with a particular stream of revenue that they were discussing was low, although I know I've said it's rebuttable. Let's just say they rebutted it. The risk associated was low. The complexity involved in revenue recognition was not very high, and the nature of the revenue transaction were absolutely homogeneous. Therefore, they took a non-statistical approach for revenue, and as opposed to inventory, where they believed that the complexity was high, the nature or the method involved in inventory valuation was not consistent for each category of inventory. Therefore, they chose a statistical method for inventory sampling. Okay. Determination of a tolerable error. I would want to skip this example because when I spoke about rate of deviation, I have given that example of the chemical industry where you go to see how do you determine. I think we should stick to that example over there. Okay, so I will pause for a minute if there is any questions. If there are no questions, I think I have been instructed to give a tea break. It is 11:20. If we're okay, we can come back by 11:30. So we could come back. We could come back by 11:30 if that is okay. If we have questions, I'm happy to take questions. Otherwise, we can come back at 11:30. Management bias, and therefore from a management override control perspective, estimate is considered as a area of focus or a potential management bias. So therefore you given that there is a fraud risk associated with it, there could be management bias, therefore you as an auditor need to perform certain specific procedures or rather be more skeptical when you're auditing estimates. And that brings the whole reason why SA 540 is a separate auditing standards for you to audit estimates with this background. Now, before I get into estimates, let me give you a few examples and tell you what I mean when I say management bias, estimation uncertainty, so that I'm able to drive this point home a bit better. Now, let's take a classic example of a goodwill impairment testing. Is it safe to say that people in this room would be familiar when I speak about goodwill impairment testing? Maybe by show of hands, if you've dealt with goodwill impairment testing before, so that I can pace out my discussion accordingly. Very few. Okay, I will still try to be as detailed as possible. Okay, goodwill, do I change it to fixed asset impairment testing to make it more relevant? I'll test to non-current asset impairment testing. I will stick to that. So now if you're doing any impairment testing, a standard way to do it would be by way of the discounted cash flow method. You arrive at value in use by way of the discounted cash flow method. Now, there are two key aspects from where I see in the discounted cash flow method. One is the forecasted cash flow projections, and the other are the assumptions that go into the process of discounting, like the discounted rate, the expected growth rate, etc. So now your discounted rate is basically your weighted average cost of capital. So the one is the assumption and the other is the forecasted cash flow. Both these are highly judgmental areas. Firstly, the forecasted cash flows comes from management. Now, management could expect a 5% year-on-year revenue growth rate. Now, that could be management forecast. But you as an auditor need to be able to validate whether this 5% is relevant or not, because this is something where they are projecting in the future. This is where the area of management bias comes in the process of estimation. The second key input that goes into the impairment exercise, let's just say the discount rate, the rate at which the cash flows are discounted, which would typically be your weighted average cost of capital. Now, the whole point of weighted average cost of capital could be something that is highly judgmental. Let's just say you arrive at the cost of equity, which would come in from the capital asset pricing model. What you arrive as the beta could be slightly varying between how one valuation expert looks at it and how another valuation expert looks at it. This therefore becomes very judgmental. Now, given the judgment on the assumption and the potential management bias on the cash flow, estimate becomes a complex area, and given that we are doing something like an impairment testing, safe to say that it would be having a significant impact on the financial statements and therefore the user's decision, which is why it is very essential that the auditor focuses on this. Now, how do you audit estimates and what do you focus on when you're auditing an estimate? That's what is covered by the standard. So, first step when you're auditing an estimate is that you look at the risk assessed with the underlying estimate. Now, like I mentioned, impairment testing, it's safe to, like, unless it's goodwill impairment, which is where it's mandated by the accounting standards. If it's any fixed asset impairment testing that you're doing, this comes through an impairment trigger. If there is an impairment trigger, it's safe to say that the risk associated with it would be higher. So first is identify the risk associated with the estimates, the method of computing and arriving at the estimate. Like I mentioned, discounted cash flow in the case of impairment could be a method. If the estimate under question is long-term employee benefits, like for example gratuity, then actuarial is projected unit credit method or actuarial valuation is the method. The third factor that you will consider is the assumptions that go into determining the estimate. Assumption, like I mentioned, key assumption, let's just say in the forecasted cash flow, management's assumption is 5% revenue growth rate. Now, this is one of the key assumptions that goes into the example of impairment testing. Third is the base data and the controls surrounding it. Now, in my example of impairment testing, where you have a discounted cash flow, the controls surrounding how the forecast is done and how the projections are made, that is something that you need to factor in. So when you're auditing estimates, it is the risk, the method, assumptions, data, and controls. These factors need to be considered on the level of audit that needs to be done with it. Another aspect is the degree of estimation uncertainty. To drive home the point of degree of estimation uncertainty, let's just take a situation where the company deals with litigation. They have a particular litigation where the management believes that the likelihood of that litigation turning against the company is remote. However, when you do your estimation exercise as an auditor, you may arrive at a conclusion that the probability of the litigation going against the favor of the company is higher and it's a very probable transaction. So now here the estimation uncertainty is very high between a litigation being in favor or not in favor. So that also goes into determine your risk associated and the level of work that you may need to perform surrounding the estimate. Of course, you have to obtain written representation from management. We spoke about uncertainty, we spoke about the method, data. One way for you to be able to evaluate or get some basis of comfort on an estimate, actually there are two ways. One is to see whether the estimation process that management has followed has largely remained consistent with that of earlier years. And if that has remained consistent with that of earlier years, you do a retrospective testing to see whether the previous year estimate was appropriate. I know I've spoken a lot of English. I will give an example. So you take a scenario where provision for warranty in the case of manufacturing company is an estimate, where when you make the sale, you need to estimate what's the likelihood that somebody is going to come back and make a warranty claim from the company, and therefore when you make the sale, you will not know whether it's necessarily going to come back or not. There is a degree of judgment involved in it, therefore it's an estimate. Now, management takes a position where every year 2% of revenue is created as a provision for warranty, and the warranty period is 2 years. And the company has been in business for the last 10 years. And you've also been the auditor. You've been the auditor for the last 6 years. Let's take that scenario. So now in this case, management has taken a view that the provision for warranty would be carried at 2% of sales. One way for you to be able to test it is, you know the term of warranty is 2 years. You have the last 10 years data. You know what has been the sales. You know what has been the actual warranty claim from year 1 to year 8. Maybe last 2 years the window could be open, but year 1 to year 8 you have the trend. You know what is the actual warranty claim. You can see each year's sales and warranty, what has been the true up, and you'll know whether 2% is a reasonable basis or not. This is the retrospective testing of an estimate over here. And I chose warranty because degree of uncertainty is low, and for me to drive home the point of a retrospective testing of an estimate to see if historically 2% has remained consistent. 2, for you to see based on the past data whether the 2% is justified or not. I hope I drove the point clear. Okay. Now, I spoke of the example of actuarial valuation. Sometimes, given the extent of judgment involved and the uncertainty of the estimate, management themselves may involve a specialist from their end. Classic example, an actuary. I take 2 examples. Let's take the example of provision for gratuity, which is done based on projected unit credit method. Management will involve their specialist, which is an actuary, to do the computation of what is the closing liability of gratuity to be carried. Now here in this scenario, what is it that you do? First is you test the base data that the management has given to the actuary, because no matter what computation the actuary does, although that could be specialized and technical, but all of it will get driven from the base data that management has submitted. If that is wrong, everything else will follow wrong. So first step, you test the base data in that case. Second step is you look at you test the assumptions that the actuary has made. And if you've looked at an actuarial report, you will know that the actuary is mandated to disclose all the assumptions that go into the process of actuarial valuation. And even companies required to disclose those. So you have to test those. For example, if the actuary has taken a discount rate, which could be, let's just say, an 8-year government bond yield, you should be able to validate and test that particular estimate, which the assumption which the actuary has considered while computing the provision. Now, so the first step is the data. The second step is the assumption. Now come to the third step of whether you need to involve an expert from your end as well. I'm taking a scenario of provision for gratuity, fairly routine, occurs across all companies. I'm also taking the actuary, which is not involving an actuary where there is no significant estimation uncertainty or a potential management bias, because all of the assumptions are auditable and the base data is also available. And the risk associated with gratuity, I'm assuming in general cases, is not high, it is low. In this scenario, you could take a view that you don't need to involve auditor specialists, or you don't need to involve an expert from your end, and you're comfortable with these projections. Let's take a scenario where a company has a IP infringement litigation, where the output could result in a material liability on the company. Management can get you a legal opinion where they have a lawyer's view stating that the likelihood of this being against the company is remote, and therefore management concludes to not carry any provision in their books. Now here, this is an IP infringement case. Safe to say that you may not be very comfortable with the IP related laws for you to understand what is going to be the likelihood of the outcome. Estimation uncertainty is high. It could either be 0, 1. I don't see, or maybe 50, depending on how the 50%, depending on how the litigation could get settled. But you as an auditor may not be in a position to take that judgment whilst there is a legal opinion and management has controls. That would give you comfort. In this scenario, you may look at involving an expert from your end whose work you will rely on. And what you do when you involve an expert is a separate standard. But for this limited discussion, I wanted to bring out the difference of how do you as an auditor, management could use an expert. How do you as an auditor think through and evaluate whether you want to rely on what the management expert has done and just do further procedures on that, or think of bringing in your own expert and do further procedures on those. Irrespective, you have to still do your procedures. We get into the case studies to see more. I think I've spoken enough about the background of estimates. JKL Limited faced a pending litigation with potential exposure of 60 crores. Management did not recognize any provision, asserting that the likelihood of the outflow was remote. The estimate involved significant judgment and constituted a significant risk. So now you have a significant risk associated, you have judgment, there's a litigation, the uncertainty is high. In this scenario, like I mentioned, typically you would involve, management would get a legal opinion, you would look at the legal opinion with professional skepticism, and you would consider how you want to do it, because the amount, safe to say, is material and will impact the user's decision if an auditor believes that sufficient appropriate evidence is not obtained and they are not satisfied with the considerations of the legal opinion and their evaluation. The auditor could even consider modifying their audit report in this regard. Move to the next one. JKL Industries prepare multiple accounting estimates relating to inventory obsolescence and warranty provision over several years. Individually, these estimates appear reasonable, but cumulatively, they are consistently favor optimistic outcomes, raising concern about possible management bias. So, what they are saying is that individually, there are two estimates in this question. One is provision for warranty and the other is provision for slow-moving obsolete inventory. Individually, what they're saying is the estimates appear reasonable, but the trend is they show potential, optimistic outcomes in the favor of the company. Now, this raises some skepticism in the mind of the auditor, given that these are areas of estimates. Now, point being, at least inventory is generally not an area of significant risk in the client. So you would believe provision for slow moving, non-moving inventory by default at least not to be a significant risk unless it's something very industry or company specific. However, you are still required to test provision for inventory as an estimate and consider, because there is an element of management bias associated with it. When you do this testing, if you get indicators that management's provisioning policy for slow moving, non-moving inventory is not adequate, then in that case, you need to raise questions and challenge management on their basis. Let's just say company has a policy that every inventory, we will create provision for inventory only if it is beyond 3 years. If inventory is aged beyond 3 years, then we'll create provision for slow moving, non-moving inventory. Anything below that, we will not look at it. But you take a scenario, you are able to establish based on past trend of consumption patterns that if they launch a new product, if the product doesn't pick up sales within the next 6 months, the product is likely not going to take off. If you have these details available with you and you know that the product has not taken off within the next 6 months, the sales are not likely to be met. It may not be very prudent on you as an auditor to wait for 3 years for management to create provision for this. It would only be relevant that you go back and challenge management saying, great, you have a policy of 3 years. But how about this scenario where this product is not taking off? The sales haven't been great. We're not able to see a turnaround time. And this has been in stock, non-moving for 6 months. What's your plan over it? This is where you go back and challenge management's provisioning policy and ask them questions on it and further evaluate if there is more risk associated with it. I think on warranty, I very fairly explained to you where you can go back and do a retrospective testing of this estimate to see if it's reasonable or not. Are we comfortable on what we're trying to do here with estimates? Like it's either the base data and the assumptions that go in, or it's the retrospective testing of the estimate. And I think the whole idea here is for us as auditors to be absolutely skeptical of potential management bias in each of these areas so that we can go back and challenge management on it. Okay, we get to the third one. DEF Limited changed the method of estimating warranty provision from simple historic average to discounted cash flow model due to market changes. The estimate was judgmental, relying on management's assumption on defect rates and cost. Now, one of the things I had mentioned is one way you could test your estimate is see the prior year estimate and do a retrospective testing. This is a scenario where the method of estimation process itself has changed. From a simple historical method, they've gone to a discounted cash flow method. So the method of estimation has changed. While you may not be able to do now, there could be factors and reasons that led to an estimation change. The moment the basis of estimation changes in the client, the first question should be, is there a potential management bias over here? And that itself needs to be substantiated by management as to what led to these changes. Because if these are genuine, like in this case, they're saying there are certain market changes which are outside the control of the company, that's what has led to the change, then it could be a genuine case. But you need to evaluate the factors that led to the estimate change and then accordingly need to define your procedures of how to test the new estimates, because you can review the historic or do the retrospective testing of the estimate, but if there are changes beyond the control, then you'll have to revisit your strategy and see whether it's the new. The key question is, does changing this method of estimation go in the favor of the company? The moment that happens, that raises skepticism, and then you reevaluate risk associated with it and design procedures. I think that brings to the end of this session. I can take a few questions over here if anybody has, while I'm changing slides. Actually, my first two standards had a lot of questions. I don't have questions, so I'm not sure if it's actually getting transferred, whatever I'm trying to say. Okay, we'll move to the next standard, which is SA 550 on related parties. Before I get into this, I think it's safe to say that a related party has been the focus area for all regulators in recent times, and I think we've known enough instances of why that has been the focus area of regulators. Before I get into it, there is one slide that I would like to show here. This one. This, I think, is one, while of course, full credits to the Institute for preparing it, but I think this is one slide which captures the crux and essence of every such regulatory requirement which is surrounding the related party or the term related party. There is SA 550, which speaks of how an auditor must consider related party transaction in their audit procedures. Of course, Ind AS 24, AS 18, which defines what disclosures are required for a related party, what goes into, how do you disclose, what is it that you need to bring into the financial statements. There's a whole lot of sections under Companies Act which are also linked with the Caro report, which casts both obligation on management as well as auditors to ensure compliance. That's 184, 185, 188 on all related party transactions. And if there is a listed company, there is also the SEBI LODR regulation, which requires necessary approvals for related party transactions from the audit committee. I think this comes from a place where I think it comes from three places. First is that all related party transactions must necessarily be disclosed appropriately in the financial statements, because it helps the reader understand of how much the company is dependent of within intergroup transactions. Second, the point is, if it's related party, the question comes on arm's length, whether the transactions that are happening with the related party are happening at arm's length, and this whole governance that comes in and the responsibility that is casted both on the auditor in terms of reporting and the audit committee in terms of their approval is so that they are vigilant and they ask the relevant question on the underlying nature of that transaction, whether it's for real, whether it's in the ordinary course of business, and whether it's at arm's length or it's prejudicial to the interest of the company. And the third is to make sure that all related, the reason the approvals and disclosures again come in is to make sure that the related party transactions are transactions that have actually happened and are not just merely book entries or round tripping of funds. I think these are the three places from where RPT is given so much importance and so much regulatory framework for this. Safe to say, all of these developments come from a place where there have been some overrides in the past that have given birth to this level of regulatory scrutiny. What is important is the last line in this slide also brings in penal provisions on each of the responsible authorities. With that note, and trying to adequately drive the importance of related party, I'd get into the standard to see what is it that we need to do as auditors. Okay. Now, first thing that we need to do as auditors when it comes to related party is do procedures to make sure that the related parties that are disclosed in the financial statements are complete. Both the name of the related party and the nature and the amount of transactions. So completeness becomes the first thing that we need to ensure as auditors, and there we need to perform certain procedures. I will get into what we need to do. Second is, of course, to carry out get reasonable assurance that the transactions with related party are at arm's length or not. How do we get to our assertion on completeness with respect to related party? Of course, there's inquiry. Second is evaluate controls over identifying and approving related party transactions. There are certain specific captions where it is very necessary for us as auditors to be able to necessarily test controls. Even if it's a company where you're not issuing an IFC opinion, where ICFR is not applicable, you still have to perform a walkthrough and controls testing and understand the controls surrounding related party. And this comes from an SA 550 requirement, irrespective of what you're doing in your ICFR reporting. This is something that as an auditor, you need to identify, because the moment you realize that the controls surrounding related party are ineffective or inappropriate, I would, at least from where I would see, it would be by default a significant risk. The risk associated with this would be higher, and the level of audit procedures that you need to perform will be higher on these transactions. while I think I missed telling this for estimates, but like related party, even for estimates, even irrespective of your ICFR reporting requirements for estimate, you will do an understanding of the controls. You will identify controls because a lot of estimates also depends on the controls that management have in place, like my case of forecast and budget. So for RPT and estimates, there are, I know I'm stepping out of my scope of work, but let me just do this because I've read this. Controls testing for 3 cases, irrespective of your ICFR requirement, are mandated and they come from auditing standards. One is your area of significant risk. If you're not rebutting revenue as significant risk, you have to do a walkthrough. You have to understand controls. Whether you want to test controls to rely or not is left up to your judgment, but understanding the controls for any area of significant risk, let's just say revenue, or if not, management override of controls. For management override, they further segregated into entity level controls and journal entries. The second place where you mandatorily need to test, identify, understand controls is a related party, and the third is estimates. All of these 3, irrespective of your IFC reporting, the auditing standards mandate you to understand the controls that management have in place. This is the nexus drawn between these standard and ISA 315. Okay. Now, throughout the course of audit, you're required to remain alert on undisclosed related party transactions. This one of the classic ways, at least that's how I learned when I initially started auditing. You have a question? Getting there. We'll tell. So, of course, read every board minutes. There is no second thought to the fact. So let's start on the assumption that every related party if a company wants to comply with 188, they would have to route related party transactions through board minutes. So first, read board minutes. Second, one thing that we used to do as part of skepticism was we used to send open-ended confirmations to the bank. Because the moment you send open-ended confirmations to the bank confirmation is not just restricted to your bank account balance or the FD confirmation. They will also give data where the company has been a guarantee to a loan availed by somebody else that could pave way for you to understand if there are potential related party transactions. Third, scrutinize rates and taxes for legal and professional expenses to see their nature. If you identify that there are any legal related costs being entered, or if there are any peculiar parties with whom these transactions are being entered into, you could raise questions and see if there is any potential unidentified related party that would warrant a disclosure. And if you've identified a new related party through your course of audit, you could evaluate if it actually eventually gets disclosed with management, then perhaps it's only a control lapse where they couldn't identify. You could communicate to those charged with governance as a significant or control deficiency because it is getting reported in the financial statements. If it doesn't get reported in the financial statements, modify your opinion. Yeah. Another requirement which comes from this, and more often than not, which could be missed out, and that's a nuance in the standard, is if you identify in your client certain very specific related party matters, you need to necessarily communicate that to those charged with governance. Fair question could be, and even I deal with private companies that don't have audit committee. What do I do in that case if I identify significant related party matters which I want to draw with them? Irrespective of what you do, whether you have a formal audit committee presentation or not, you are required to have a communication with people you identify as those charged with governance. Could be board of directors, could be the CFO and CEO, one of whom is on the board. You will have to have a conclusion meeting with them where you will be communicating whatever you did as part of audit findings. You need to formally minute that and keep it in your work paper. So if you've identified a significant related party matter, you are, and where you as an auditor did spend a lot of time in arriving if whether that is appropriate or not, you're obligated to communicate to those charged with governance, irrespective of the size. And that doesn't come from the Companies Act, that comes from the auditing. Okay, let's look through this. A couple of case studies. During the audit of P Limited, the auditor found loan guarantees issued to Orion LLP through bank confirmation. Orion Trading was not included in management's related party list, but board minutes and legal records showed it was controlled by the MD's brother-in-law. I think this is a classic. I think there were two sources from where they identified. One was the bank confirmation, which said they were the guarantor, and the other was the board minutes that led to say that this could be a potential related party. And both this in conjunction together took to a situation where it was previously unidentified. And like I told you, if the management discloses it, then you can accordingly evaluate the audit opinion. But if they refuse to, then you modify. But irrespective of what it is, you communicate to those. In this scenario, I would definitely bring this as a topic to be reported to those charged with governance. During the audit of S Limited, the auditor found through a review of bank confirmation, a corporate guarantee had been issued to a private company not disclosed as related party. Further inquiry revealed that in this company, 70% equity shares were held by managing director's brother, which management had failed to report earlier. I think this is another case. If you have a corporate guarantee given, even though it may not have a direct financial impact unless there is a default, you would still have to disclose it as a RPT transaction under the requirement of India's 24 AS 18. So this would be a necessary disclosure that has to be given because a company has given the guarantee, and if that is not done, then this would be a issue. And clearly, this is an indicator that the controls failed to detect it. So you may also evaluate the impact on your ICFR report. During the audit of E Limited, the auditor noted several high-value purchases from a related party of the company. However, there was no documentation showing that these transactions were reviewed or approved by the board. This is a scenario. I mean, you don't just take it to the board. Of course, one is for compliance with the uh, respective companies act, but then you also take it to the board for it to have a particular level of governance, because the assumption is that if you take an RPT transaction to the board's actually going to ask you a question saying who else provides this service, what is the rate at which they're providing these service, have you got comparative quotes or not, how do you know this rate is reasonable. So the obligation is on the board to ask all of these questions. So therefore, it's important for you to know that whether this control of board approval is there or not, apart from the fact that there is a Companies Act non-compliance, which may trigger multiple reporting. This is also a control lapse on behalf of the company, and that's something you need to evaluate as an auditor and, of course, communicate to those charged with governance. Yes. Any questions on RPT? No questions. Okay. Okay. Since there were no questions on RPT and we were absolutely clear, and move to the next one, which is on subsequent events. From a subsequent event standard perspective, fairly simple standard. Uh, there is an accounting standard which is the basis for management to consider the implication of subsequent events as to what is adjusting, what is non-adjusting. Not under the scope of today's session, so I'm not going to talk much about it. What I'm here to speak about as part of the auditing standard is to see how we as an auditor need to consider. And when I speak of subsequent event, I would like to break subsequent event into two parts. It is safe to say that we all understand subsequent event is anything that happens after 31st March. I mean, safe to say we are all in India, we do March accounts largely. So anything that happens after 31st March is subsequent event. But up to what that comes under the purview of the auditor is something that we need to consider. So there is one level which is any subsequent event that comes to your knowledge from the date of that is the March 31 up to the date on which the financials are approved by the board and signed off by the auditor. That is a particular subsequent event that gets governed by the AS, which is whether it's disclosing, adjusting, non-adjusting, etc. There, the principles are clear. Your obligation doesn't stop there. If the auditor is aware of any subsequent event which may have an impact on the financial statements, which is after the date of the sign off, that is after the board meeting when the auditor has signed off and before the date of issuance of the financial statements, to make it simple, from the board meeting date to the AGM date, in between that period, if you come across any subsequent event, how do you deal with it? Even that comes within the scope of the auditor, and that you also need to factor that in. How do you factor that in? How do you report or deal with it? Covered as part of the examples today. There, it extends a bit further of if after the financial statements have been issued also, and you still come across, now here you don't have the obligation to actually go do any incremental procedures, but if you come across a situation, if something related to your financials would have an impact through a subsequent event identified after the issuance, what is your obligation of the auditor? Even that is covered in the standard. So the reason I skipped the part of the accounting standard on subsequent event was because I clearly wanted to bring out the three distinguishments and the obligations on the auditor at each of these three stages, between the balance sheet to the sign off, between sign off to issuance, and after issuance. And what you do in each of those is something that the standard will cover. With this precedence, I will start the standard. Now, from from 31st March to the date on which it's signed off, I think it's fairly simple. You have to read the minutes, board minutes of the subsequent period, look at the interim financials of the subsequent period, not audit it, read it to see if there is anything that could impact your year end. If anything is identified that would warrant a disclosure or an adjustment, you accordingly factor it. And then, of course, obtain representation from management that demonstrate and do certain inquiry procedures with management, which you document to make sure that you factored and covered in all subsequent event procedures. Again, here you don't require to really audit. It's just more of reading and understanding and staying vigilant. Now, if there is a scenario where you've already signed off on the financial statements and before the AGM, if you come across something, then you need to evaluate if you need to amend your existing audit report or not from the date of board meeting till the date of AGM. Okay, and once the AGM is done, and that is once the financial statements have been issued, then there is no going back from there. Then it's only for you to evaluate as an auditor if you need to communicate to regulatory authorities, if you want to withdraw your report or disclose something to the regulatory authorities. We have an example for that as well. I think I'll be able to explain it better through the example. We'll get to the case study straight. During the audit of Bright Chemicals Limited, management requested the auditor to date the audit report a week before the financial statements were approved by the board to meet a regulatory filing deadline. I think this is an absolute no-brainer. I see a smile on everybody in this room. The auditor should not be signing this. I don't think the auditor can sign the financials unless the board has signed the financials, so or the board has approved the financials. So the auditor declined the request of the board. During the audit of Lunar Pharmaceuticals, the auditor had already signed the audit report on April 20th, 2025. However, the financial statements were issued to the shareholders and management informed the auditor of a major lawsuit had been filed against the company for alleged patent infringement on April 25th, 2025. The amount involved was significant enough to potentially affect the company's financial position and disclosures. Now, this is a scenario where the audit, so you are required to read board minutes and then read financials up to the date on which you sign. So till then the auditor did the procedure and the auditor nicely signed on April 20th. Before the AGM or before the financial statements were issued on April 25th, management informed the auditor that there has been a patent infringement, this is significant, it is impactful, it has to go in as disclosures. Now, the financials are not yet issued, which means the AGM has not yet happened. Now, in this scenario, what do you do as an auditor? From an SA 560 perspective, you're first required to discuss this with management, and not just management, those charged with governance as well. If you have an audit committee, or committee comes under the scope. Assess, depending on the matter, whether the financial statements require to be amended. Now, if this is an impact, this is something which is going to impact the financial statement. Step 1 is for management to do their assessment whether this should be given effect to. Preparation is management's responsibility. So first inquire with them on what is their plan with respect to this, because if management themselves are going to amend the financial statements, then you have no choice but to also then reissue your auditor's report. And and of course you have to do your own evaluation if this requires or not. And let's just say management doesn't amend their financial statements. I will take an extreme case, whilst I have never dealt with it practically, but to make it theoretical from where the standard comes, if management doesn't amend, you still reissue another audit report with a qualified opinion that the management did not give effect to it. If the matter is significant, if you believe, based on your whole assessment, if you believe this should have been disclosed or this should have been given effect to in the financial statements, then you go ahead and you still issue an audit report on with a qualified opinion. But that's a very extreme. I've never dealt with it. Let's take another one. This is after the issuance of an audit report. That is, you have signed, the board has approved, you have signed, the AGM has happened, financial statements have been issued, and then after that something happened. After issuing the audit report on 30th June for Apex Builders Limited, the auditor later discovered that a material fraud relating to prior year revenue recognition existed. The auditor advised management to amend the financial statements and inform all recipients of the earlier version. However, management refused to amend the statements or notify the users, claiming this was not material. Now, in this scenario, I mean, for a moment, we will also try to recollect the 143.12 on auditor's reporting obligation when there is a fraud identified. In this scenario, which also has a fraud identified incidentally, here we will first start with the SA 560 discussion, where it says if you've come across this, you notify management, those charged with governance, so that you inform them that none of the users should be relying on your report that has been issued earlier because you've identified something that was material pertaining to your period. If they take the necessary step, then you figure out how you have to deal with and reissue another set of financial statements. Now, let's just say it's not there, then there is the obligation on you. Now with 143.12, the obligation was on you to notify and inform the regulator about this, if this has come across, even after the financial statements have been issued. I think, like I said, these were the three principles that came in. Yes, sir, you have a question. So if I understood your question right, you're saying of a scenario where the AGM has happened. No fraud. Okay. Understood your question. Yeah, no. I know. I understood your question. So if it is not fraud, so your reporting requirement to central government doesn't arise, still you have to inform the regulator. So if it is an MCA or whoever is the relevant regulator, the obligation is on you to notify that every user of the financial statements, or even if it's SEBI for that matter, it is on you to ensure that nobody places reliance on your financial statements if you've come across something, even if it's after the issuance of the financial statements. But that is only assuming it is material and having an impact. And I'm sure we all understand what I'm talking. If it's a private limited company, then irrespective, if you're the auditor, you know who your users are, no? I mean, if you're a private company, your shareholders, your bankers, I mean, the investors, the shareholders, the bankers, these are, you know who your users are. It's on you to identify users of financial statements and communicate to them. And of course, the regulator too. Okay. what I'm talking here is theory. I have not experienced this, but I have read the standard. The standard says you have to inform the users, you have to inform the regulator. So it's safe to say you know who are the users, you know who are the regulators, inform them. The standard casts the onus on the auditors. You have dealt with it? You have the answer to this? Please.
Thank you, Pratima ma'am, for giving this opportunity, because it is a specific question people are interested. I'd also like to share my own inputs in this particular regard. Where the question is, sir, I have given a financial statements audit report has been given. It has been circulated also to the users. Users are relying on this financial statement. Now the auditor comes across a subsequent event where I should go for amending my audit report. I am intimating to the management. Management corrects it, no problem. Management says, no, I'm not interested in doing it. I'm stick to the old financial statements as well as the audit report is what the management stand is. Now, being an auditor, I know the previous audit report, whatever that I have given, cannot be relied upon because it is not appropriate. So in this case, what I have to do, as Madam told that I need to communicate to the users, even to the regulators. In case of a fraud, 143.12 will be reported. SEBI being a listed entity, I need to go for reporting for the SEBI. I'll give a practical example. It was a case. National Spot Exchange Limited was a company, NSEL. It's not a stock exchange, it is a spot exchange. It got subsidiaries also, including Australian subsidiaries, and there were a huge problem. The company, holding companies in India and Australian subsidiaries, there was a huge problem. There are financial aspects. The financial statements of that particular subsidiary was included in the reporting entities financials, and then the audit report has been originally given. And later on, after the financial statements has been issued to the public, the information about the going concern was identified, and there were huge problem in the subsidiaries. That is having an effect on the holding company's financials as well. Now, what the auditor did was, one day before the AGM, it was not even AGM, it is one day before the AGM, the auditor red flagged that particular audit report, whatever he has already issued, and then he withdrew that particular audit report and gone for a public advertisement also. Apart from reporting to the SEBI and other regulators, they have gone for a public advertisement stating that my report is no longer reliable. Please don't rely. I am not responsible for any of the consequences on account of my reliance, like that. They have made a public announcement as well. Even in case of a private limited companies, it will be very good for the auditor, because standard doesn't specify the methodology or mode with which you need to withdraw your report or how you need to intimate to the users. But based on the judgment of the auditor, I may take a call that I may even go for a public advertisement. Nothing prevents me. It is not a confidentiality aspects and all. It is a public interest activity where I need to go for an advertisement is what that we have seen. And also one practical example of a listed company where even news reports are there. I may be in a position to show that as well, where the auditor has gone open, gave a press conference stating that because of these reasons, because of the fact that the financial statements cannot be no longer reliable, I am withdrawing this particular report one day before the AGM. And then based on this particular press release, the management of that particular holding company took a call that let us go with the auditor, let us not fight with the auditor, let us go with the auditor. We recalled that particular financials and the AGM got cancelled, and then they gone for a reconsideration of the entire financial statements and then gone for another AGM here. This is what the clarity that I thought I can give it to you. Thank you. Post AGM. Oh, your question was post AGM? Okay. Super.
So
Should I need to answer
more
now? You're
clever,
answering.
more
Post-AGM.
clever on that.
Okay. Sorry, I thought the entire discussion is before that particular AGM.
Whatever it may be.
I failed to recognize the fact that the question is post AGM.
No,
Even for
whatever,
post AGM, I have a solution.
Yeah.
Post AGM, sir, I have given the financial statement. AGM has been approved this, adopted the financial statements, and then over. Then what I have to do now? Technically speaking, as per SA 560, read with SA 700. The auditor doesn't have any responsibility to perform an extended audit procedure after my audit financial statements. That's the clear stand. But however, the information is brought to me. I know that there are problems in the financial statements, because of which the audit report is also having an impact. Post AGM, what is the position? Beautiful question. under Companies Act 1956, we didn't have any of this particular aspect at all, because as per Companies Act 1956, once the AGM is adopted, then it is done, dusted, buried. That's it. I cannot even dig it, in spite of the fact that I know there are problems. Satyam was one of the classic example where we know that there are problems in the previous financials, but it was unallowed to go for recasting that particular financials. But however, that is not the case as per Companies Act 2013, where section 130 allows me to go for revising that particular financial statements, where voluntary reopening and mandatory revision, 130, 131, there are sections are there, where I know there are problems with regard to the financial statement director's report. Then they can go for digging out, and then they can go for a voluntary revision is possible as per Companies Act, is what the practical issue is. There are companies with the NCLTs that they have gone for recasting the financial statement, which was already approved in the AGM. So they have gone for revising that particular financial statements, and then they appoint one another audit. Even one of the implementation guide to this particular essay institute lightly talks about this particular provision also, not clearly providing the provision. But however, as per Companies Act, we have this aspect of digging back and then revise this financials and then recast and redo it. The possibility is there.
Okay, that is voluntary of the management. It's a voluntary here. The voluntary wording is a voluntary. That's a problem.
What management doesn't do it?
Yeah, that's that way only. That is a silent on the standard also.
Correct.
Sir.
What you think is right? You know the users of your financial statements.
Okay.
Okay, we will, yeah. If there is another question, other than significant disagreement with management, I'm happy to take on SA 560 before I start with the next one. Since there is none, I will move to SA 570 over here, which is on going concern. Safe to say we all understand, and I'm not getting into the depth of going concern. What actually came in new is the, I don't know, by show of hands, how many of us have heard of this para of material uncertainty associated with going concern? That's the theme of the standard and largely what I'm going to be speaking about, because this did get revised in recent times. Or let me flip the question. How many of us have actually looked at or faced situations where we've given an audit report having the paragraph of material uncertainty associated with going concern? By show of hands, one. Okay. Hopefully this is going to be something new we all learn from here and go today then. I think we are all come across the standard where it gave indicators of a going concern issue. We all understand. I'm not going to go back to it as to what are the indicators of a going concern issue. My focus is really going to be on aspects where you identify a material uncertainty associated with going concern. Now take us, the crux, or at least the key revision under this standard is, take a scenario where you as an auditor have identified a material uncertainty associated with the going concern of the company. I will give you an example. You audit a company which is a cost plus company. Their entire billing is to the holding company. Okay. Now, it's a fairly simple, they have employees work, whatever's cost is there, cost plus 18%, transfer pricing, arm's length there, billed to the holding company, 100% confirmation of receivables is obtained. Till the balance sheet date, all receivables have been collected, FEMA, RBI, everybody complied, happy. You as part of audit come across a situation where the holding company, which is outside India, has filed for a Chapter 11 bankruptcy. Okay. Now here in this scenario, you are a cost plus, entirely dependent on one customer. That one customer filed for bankruptcy. Classic case of what counts as an MU, material uncertainty. Because if that goes through bankruptcy, your business, irrespective of management giving you next. So for a cost plus company, 1 year projections or the projections that, so if management gives you their assessment of going concern, say they give you the next 1 year's approved budget, they have 100 employees, they have the cost of those employees, every other selling general admin expense projected, and then they put a 15% margin on it, that becomes the revenue, and that's your next 1 year's projections and assessment of management. You really cannot rely on this because you have a fact that the person who's going to actually pay you the cost plus 18% is facing bankruptcy. That's your MU. Even if you get a letter of support from the holding company, you really can't rely on it. That's your MU. So how do you deal with this MU is what the standard says. I hope I've driven the MU material uncertainty point. Now, how do you deal with it? We'll get to it later. Before that, one necessary step and something, because I'm covering audit standards, I really want to drive this point. Assessment of going concern is management responsibility. You as an auditor in your documentation file need to have management's assessment of the going concern. And by management assessment of the going concern, it should be minimum for a period of 12 months. 12 months, the way I would look at it, 12 months from the date on which you're signing the financial statements. That is 12 months from the sign-off date is where you get the management's assessment of going concern. Over and above that, you as an auditor need to perform procedures to see if management's assessment is reasonable or not. That is where how do you perform the procedures? Not covered in the PPT. I can share examples. You have the projections for 12 months. Step 1, you look at it and see whether the growth rate that's expected is in line with, again, it's an estimate. Okay, so you do the same thing that you do with an estimate, retrospective testing. If they're expecting a growth rate which is in line with the growth rate that was there in the previous year, reasonable. If you understand from market factors that there is expected you don't expect a decline, then the projections are reasonable. You apply certain sensitivities on it. Certainly something that at least I do when I test going concern management assumption is test sensitivities. So management gives you their budget for the next 1 year. What happens if 80% of it is achieved? What happens if 90% of it is achieved? What happens 70%? If any of these look at a situation where there could be a question on the going concern. Let's just say at the projections, they have a debt repayment and then they're able to manage the cash flow. But the moment you apply the 70th percent sensitivity, they are not able to achieve that. Then it clearly means you need to go back and challenge management on the projection and look for alternate evaluation plan. Maybe management comes back and says, we have another drawdown line available. You discuss that with management, but sensitivity of projection is definitely a procedure that I do. Now, with this management assessment necessarily having to be there and your evaluation of management assessment necessarily having to be there as part of your work papers, we'll get into further case studies. Okay, we'll just go through what this, if I missed something. Events, of course, evaluate events condition, management assessment for 12 months, perform extra procedures. Yeah. Now, how do you deal with a material? Of course, get written representations. I have a separate standard on representations, which I will come to it. For now, we'll just not talk much about it. On, let's say a scenario, you identify a material uncertainty. I gave you an example of a material uncertainty. If there is a materials uncertainty identified, there are adequate disclosures made in the financial statements. You can then give an unmodified opinion, but give the paragraph on material uncertainty associated with going concern in your audit report. Typically, it comes after your basis. After the basis paragraph is where this would come. Next is a scenario where the disclosures are inadequate. You have identified an MU, you've identified a material uncertainty. There is inadequate disclosures. Then in that case, you evaluate modifying your opinion. From the standard perspective, it says qualified size adverse. I really don't see a scenario how it could be qualified because going concern would be pervasive. So in my own professional view, I'd stick to adverse. And take the third scenario where the use of going concern itself is inappropriate, no-brainer, adverse. Okay. During the audit of Orchard Engineering Limited, the auditor noted that the company had incurred continuous losses for 3 years, had overdue loan installments, and its working capital limits were nearing exhaustion. On inquiry, management stated that the business will recover once new contracts are secured, but no formal going concern assessment had been prepared by management. Clearly non-compliance with this standard. I set the precedent on the tone that management has to do an assessment. If they believe that there are going to be new formal contracts, they need to identify at least in their management assessment, know what is going to be the revenue that comes from the contract. How is it that the cash flows from those contracts are going to help them finance all these pending obligations that they have, and how will they continue for the next 1 year? Could be another drawdown line available, could be that this new contract could significantly improve margins, turn it around. Great, but that has to come in as management assessment. After the management assessment has come, then there could be your work as an auditor to see whether it's reasonable, appropriate by all the procedures that I told you. Now, if you are able to, in this scenario, if you're able to get a management representation, then you evaluate and see whether it's appropriate, whether there is an MU or not. You do that assessment. If you don't get the management assessment in first case itself, I genuinely think it's a limitation of scope, at least in this scenario, or in any scenario. Management assessment is compulsory. Okay, we'll move to the next one. During the Zenith Infrastructure Private Limited, management prepared a cash flow projection to assess going concern, but the forecast period covered only the next 6 months from the balance sheet date. The company had significant loan repayments due in the following year. So, simple point of the standard to drive home that it has to be 12 months. The 6 months cash flow is inadequate. You need to go back to the management. If there is a loan repayment due, they need to cover cash flows which factor 12 months period, including the fact where they are going to do the loan repayment. And once that is done, you need to see whether they will be able to meet that. If you conclude still that there is a material uncertainty, then you give the material uncertainty related to going concern paragraph in your audit report to highlight the risk, provided disclosures have been made in the financial statements. So if management is able to bring out these disclosures adequately, you then bring the paragraph of MU in the audit report. It doesn't really modify your opinion, it just brings in, I'd equate it to the EOM. Now, the reason why the 6 months came in is that, take a scenario where you sign your financials in September and then the client gives you only up to the next March. That's still not adequate. You actually need to go in for 12 months from the date on which you're signing off. That's necessary. Okay. During the audit of Nova Chemicals Limited, the auditor identified that the company had defaulted on interest payment and faced delay in customer collection. Management provided a 16-month cash flow forecast showing recovery through a new export contract and a proposed bank loan. Now, in this scenario, you have a situation where they had historically delayed customer collections. Management has given a forecast and they are trying to show recovery through a new export contract and an expected bank loan. Now, if you feel that these sales assumptions are very optimistic, and if you don't, like, let's just say there's a proposed loan, you don't hear by just saying there's a proposed loan. You actually get a bank and sanction letter for that loan. If you just see preliminary email correspondences, that wouldn't be sufficient appropriate evidence for you to rely on the management projections for something like a going concern when you have adequate indicators for it. So if you feel the revenue projections are optimistic, if you feel the bank loan is contingent because it's at a very preliminary stage, classic example of an MU, you will draw attention if management is giving the disclosures in the financial statements about the uncertainty related to it. If it's appropriate, sufficient, then you give the MU paragraph. If it's not, then you give adverse. And if you bases on the quantum of losses and the nature of loan, if you believe all of this may still not be met, then you may want to even go back and see if you change the basis. Okay. Do we have any questions on going concern? I think the key matter here is to acknowledge the concept of a material uncertainty, see how it will have its impact on the audit report. Make sure that you give the MU paragraph only if there is a disclosure in the financial statements and you've considered the disclosure to be adequate given the facts and circumstances, and then you do the needful for this. Okay, brings me to the last standard that I'm going to cover for the day, and I think I'm fairly on time as well, despite starting late. I have 15 minutes to cover this standard, which I think is fairly good. SA 580, written representation. I think it is a fairly simple standard. Couple of nuances that we need to look into. And I really see the dichotomy within the standard. Fact of representation is clear to all of us. Preparation of the financial statements is responsibility of management. Because it's their responsibility, they should be able to give us representation that all facts, data, details, etc. have been disclosed to us. They take the onus that they have prepared the financial statements and they give that as a representation letter in writing to us. Having said that, and having had the preparation as their responsibility, the standard is adequately clear. Merely obtaining a representation doesn't absolve the auditor. You still have to do the necessary procedures and you still have the obligation to report exceptions. So it doesn't absolve you of any of your responsibility, but then not having a written representation letter from management in your file is a clear violation of this auditing standard and non-compliance. So I don't know how the dichotomy works, but then that's where it comes from. What is also important and essential here that the representation letter should be signed by the relevant person. Finance manager, with all due respect and knowledge, if signs on the representation letter to you, may not be adequately reliable. It would be insisted that somebody who is responsible for the financial reporting oversight process and authorized by the board signs on your representation letter. I normally insist one director and the CFO, like people who sign on the financial statements, sign on the rep letter. That makes it reliable. That's the practice I follow. Yes. And of course, you don't sign on your audit report until you obtain a written representation letter from management. Goes without saying. Now, if there are certain areas for which you need specific representation from management, then you include those areas in the representation letter. That being said, you're not absolved from doing audit. If you have a CARO reporting or an ICFR reporting, then you add in those aspects as well into it, because even though it's the ICFR reporting where you're testing the control, the framework or the implementation of that framework responsibility is with management. We'll get into the case studies to discuss this further. While auditing Alpha Technologies Limited, the auditor obtained a representation letter signed only by the accounts manager. The CEO and the CFO were responsible for preparing and approving the financial statements, had not signed the representation letter. I think fairly straightforward, no-brainer. While the financial manager may have been the person with whom we would have discussing as part of audit, but the people who are ultimately responsible and authorized have to sign on the representation letter. Only then the representation letter would be considered duly signed. While auditing ABC Limited, okay, we're moving to the next ones. While auditing ABC Limited, the auditor obtained a representation letter from management which stated that representations are made to the best of management's knowledge and belief. By show of hands, how many of us think this is okay and not okay? Including this line, is it okay, not okay? Okay, how many of us think it's okay? By show of hands. If management says to the best of... yeah, how many of us think it's okay? By show of hands. Yeah, to be honest, it's okay. I mean, what can management do beyond their knowledge? Anyone who's signing can only sign to what is the best of their knowledge is. So to be very honest, I think if whatever with their knowledge, if they are making it, this is an acceptable representation letter. I don't think we as auditors need to go back and fight on this further. During the audit of Neon Pharmaceuticals Limited, management provided the written representation letter dated 2 weeks before the planned date of the auditor's report. Subsequent to that date, a significant inventory loss occurred due to a fire at the warehouse. Okay, now, what do we do in this scenario? We had enough debates about the subsequent event. I mean, given that if there is a fire which happened after you signed the audit report, unless we believe we are going to be changing the financials, which I don't envisage, we don't need to go beyond the date of the audit report to obtain representation from management. As long as we are required to do procedures only up to the date of the audit report, management representation also covers up to the date of the audit report. If the fire genuinely happened after that, nothing much the management can do in this case. Okay, that brings me to the end. If there are questions, I am happy to take in any of the standards that I have covered. because we still have 5 more minutes maybe. No question? Oh, yes. Okay, you would ideally date the rep letter on the audit report date. Yeah. So, if I mean, there's no straight answer to this. If you are signing your audit report on a day after the board meeting date, then technically they would give you a rep letter on the board meeting date, and if you insist, then a rep letter after that. But it should be on the audit report date. That's how I would look at it, because that's the date on which you're issuing. Unless it's a scenario where the board approved financials before you signed off, and I don't want to dwell into that nitty-gritty because it's very rare. Yes, any other questions? Okay. I was supposed to finish the session at 1 o'clock. I think I finished it at 12:50. So we all have the 10 minutes for us to do whatever we want, I think. Yeah. Oh, yeah, you have a question. Sorry.
In your say 570, you gave an example that a company had a default of interest payment, and the company is managing to get finance from bank. Actually, the banks never finance defaulters. That is the case, actually. That's the practice. They cannot finance any customer for defaulted amount. They can give additional finance for additional activity or additional turnover, whatever it may be. So apparently, we cannot say that default in interest payment will be financed by bank. This is not right way.
Okay, noted, sir. I don't think I can dispute on that. I think the point still remains that if you have any financing that is coming through from banking or an NBFC, if the client's projection include any form of funding that is coming, you as an auditor need to be convinced that that funding is sourced, is certain, and actually going to come in. So if, as long as an auditor, you're able to be vigilant about that and then evaluate your material uncertainty, your audit is done, sir. RPT? Yeah.
You give 3 points. The background with which this RPT came into existence. No, you give 3 points.
3 points on the background of related party transaction. Oh, yeah. Okay. Yeah, I can go back. So, first is to identify completeness of the related party, identifying related party and the related party transaction. The completeness of the related party transaction. Second is to ensure arm's length, which is you have to make sure that the related party transactions are happening at the appropriate rate that it has to. And the third is to see if the appropriate if the appropriate controls or the approvals as required from a regulatory perspective have been met or not, because that becomes a reporting obligations. These are the 3 things that I need to say. Okay, yeah, I remember the third one now. The third one was actually to see whether the related party transaction actually happened in the substance. It was not any round tripping of fund or merely a book transactions. Because of this, only the regulatory came into place. That's what I said. So the first one is completeness of parties. Second one is to see arm's length. And the third one is to see the substance, whether the transaction actually happened and were not merely book entries or round tripping of funds. These were the 3 things. Any other questions? Yeah, otherwise we just get 10 more minutes full on. I'm around for the next few 10 minutes, still here. If you want to meet me in person and discuss, I'm happy to do that as well. Okay, thank you.
Thank you, madam. Lunch break, sir.
Okay, so it's time for the second session, technical session. And our today's speaker for the technical session is CA R S Balaji, sir. I would request you to please join us on the stage, sir. So in this technical session, we would be covering SA 600, 610, 620, 700, 701, 705 706 710 720. So our today's speaker, CA R S Balaji, he's practicing fellow chartered accountant specializing in audit and indirect taxation, certified peer review by Peer Review Board of ICAI, co-opted member Auditing Assurance Board of ICAI for 2019, 20 and 21, national level trainer for the peer reviews as impaneled by PRB of ICAI. He's a member Academic Council of Sri Shankara Arts and Science College, Kanchipuram. Member of Editorial Board of Paduka's Publications. He's a faculty for the subjects of Advanced Auditing and Professional Ethics for CA Inter and CA Final, Indirect Tax Law for CA Final. Co-authored 2 professional books, Paduka's Company Law, Ready Referencer, and Paduka's GST Ready Referencer. Contributed for ICAI guidance note on CARO, tax audit and background material on GST. Contributed for the recent publication Professional Handbook to ChatGPT. Awarded as Best Outgoing Student and Secured College First. Regular speaker at various professional forums including all the regions of ICAI on subjects like Standard on Auditing, Peer Review, Code of Ethics, AQMM, GST, etc. So before I hand over the session to you, sir, I would like to call upon CA Raja Gopal, sir. Please come on the stage and present a memento to our respected speaker. Thank you so much. All right, sir. I would like to hand over the session to you. Over to you. Thank you.
Okay. Shri Guru Pyo Namaha. Very good afternoon and all present here. It gives me a lot of pleasure to be part of this wonderful initiative of the Institute with regard to refresher course on standards on auditing. My love towards that particular standards on auditing. I do a lot of research activity in this particular standards on auditing, and when it is being given to the people and in a very right methodology, in 2 days we cover everything and then we give a package. It's a beautiful initiative of the Institute, and thanks for your right participation in spite of your busy schedule here. I thank the WASB and all the office bearers for the WASB for creating this particular thought of having a workshop and seminars on standards on auditing, and also SIRC of ICAI for coordinating and then having this particular session into reality. I have been given a task of dozen of standards on auditing to be discussed with you, like starting with 600, 610, 620, like that, 700, 701, 705, like that. Multiple standards has been given. Fine, all the standards are equally important. I don't deny the fact, but there are certain standards where we need to put our thoughts into it, and then there are certain standards which are very simple and then it is cakewalk. So considering the weightage and considering the importance with regard to the practical relevance, let us focus on those standards which may have a direct effect on my reporting, direct effect on my regulatory perspectives like that, and practicality, rather than something on theoretical perspective where I do certain documentation, I do certain procedures and then be happy with that. So the first session, we will be dividing this particular aspect into 2 aspects. One is 600 series and the other one is 700 series. As right from yesterday, we are in a sequential manner that we are discussing about 200 series, and then 300, 500 like that. Now 500 series is over, and then now we are into 600 and 700 series. 600 series, there are 3 standards on auditing is available, sir. One is basic SA 600 that talks about using the work of another auditor, and the other one is SA 610 using the work of internal auditor, and the other one is SA 620 using the work of an auditor's expert. When you base upon to have a platform with regard to all the 600 series, anyway, being the statutory auditor, I am going to rely or going to use the work done by another party who may be a chartered accountant is what the underlying assumption here which goes on. Because being a SA 600 where you are going to use the work of another auditor, in many places, as per the basic standard, which says that as an auditor, statutory auditor that I am talking about, I am entitled to rely the work done by other parties. I am absolutely entitled to rely on the work done by others. So in that particular case, we will go for SA 600 and its nuances, considered to be very, very important, especially in light of the new provisions by NAFRA, and also there are implications about India adopting international SA 600, like that. There are happenings are also there. So let us understand what is this particular SA 600. First of all, when it will be applicable, and to my practical relevance, where there will be an impact. If it is there, how I need to report, how I need to document. Simple. So we will be focusing on these areas, sir. That is what something about SA 600 using the work of another auditor. The moot question is, who is another auditor that we are referring here? Say for example, previously certain other person was a chartered accountant of this entity, and now I am the auditor of this particular entity. With regard to the opening balances which are audited by the previous auditor, I am going to rely on the work done by the previous auditor, who has already done the audit and then he has certified the financial statement. Fine. Now the opening balances are all completely audited by the previous auditor. I need not go and once again verify all the aspects of opening balance. I can very much rely on that. Whether will it be considered under this particular SA, because using the work of another auditor, I am going to use the work of the other person. Will it be covered? Question mark. Or take an example. I am a chartered accountant, sole proprietor. I am working on a particular area, and then there is one confusion with regard to a decision to be made. I am consulting with another chartered accountant who is also equally competent, holding certificate of practice. Sir, what is to be done? I am going for a legal opinion with that particular another chartered accountant, not just a phone call. I am making a formal written request to him, and then he verifies, and then he gives a particular aspect of confirmation or an opinion in that particular regard, where I feel that I can use it, I feel that it is relevant. So in that particular case, am I going to apply this particular SA using the work done by another auditor? Even SA 610, where there is an internal auditor who is also a chartered accountant, competent person, who has done an activity, he has verified a particular activity, am I going to rely on that particular work? So in that particular case, this particular SA 600 can be used, because using the work of another auditor. Everywhere, if you apply a normal English and then see using the work of another auditor, in all these scenario, this particular SA can be applied. However, SAs are to be read only in the context. Standards on auditing SA 600 is very, very specific, that all the instances that I have told will not be applicable in the given case. In the given case, they have explained who is another auditor. Who is the person who is going to relay the work done by the another auditor is what defined here. It is all set in the context of a principal auditor and a component auditor. Only in such a case, this particular SA 600 can be relied upon. Whom we are calling as a principal auditor, whom we are calling as a component auditor. The component auditor is otherwise called as other auditor in the context of SA 600. Say a typical example of a bank audit, sir. There is someone called a central statutory auditor, and there are many, many branch auditors. The branch auditors are to verify the financial statement of the branch. Each branch is having a financial statement. You all with me or not? Yes, do you agree with me? Each branch is having a financial statement, separate financial statements like your balance sheet. It has an asset, it has a liability, it is an income, there are expenses, there is a separate set of financial statement that is prepared for each of this particular branch, which is audited by a competent chartered accountant. That particular work, the auditor, the branch auditor is going to report on to the central statutory auditors. Now the central statutory auditors, at the side of consolidating the entire financial statement as a whole, for the bank as a whole, I am going to rely the work done by the branch auditor will be squarely getting covered under this particular SA 600, using the work of another auditor, where there is a component whose financial statements are included in the reporting entity's financials. That component is audited by a separate chartered accountant or an audit competent person. I am going to rely on their work, will be considered and will be squarely applicable in this case. Not only on this particular bank audit scenario, say for example, I am an auditor of a holding company. There are subsidiary companies which are audited by separate independent auditors. At the time of consolidated financial statement, as per section 129 of the Companies Act, every holding company needs to have a consolidated financial statement also. And the statutory auditor of the holding company will be reporting on the consolidated financial statements as well. So in such a case, being the statutory auditor of the holding company, I may not be the auditor of the subsidiary companies, where I am going to use the work done by the subsidiary companies' financials and their audit report will be squarely getting covered under this particular SA 600 using the work of other auditors. So the point that I am driving here home is the definition of other auditor is very, very specific in light of SA 600. It's not that any other person, a chartered accountant or an auditor whose work is related by the reporting auditor will not be covered under this particular scenario. There is a restriction. What restriction? There should be a component of the reporting entity. That component can be a branch. That component can be a division. That component can be an associate company. That component can be a subsidiary company or joint venture, whatever it may be. That financials is going to be included in the reporting entity's financials for the purpose of reporting in the financial statement as a whole. I need to rely on the work done by the other party. In such a scenario, this particular SA 600 will come into place, not the cases of whatever that we have discussed about. Say for example, previously there is another chartered accountant whose work is relied on the opening balances by me. I may not apply this SA. There is a specific SA 510 that talks about initial audit engagement. In such a scenario, I will be using that particular SA. Where there is an internal auditor who is also a chartered accountant whose work is relied by me, I cannot apply this particular SA. There is a specific SA 610 that I will be using that particular aspect. Where say for example, there is another chartered accountant whose work has been relied by me. In that particular case, I told an example of a practicing chartered accountant who is my friend, who has, I have given a written opinion and then he has provided me a sort of solution. In that particular case, what will happen? Whether there is a specific essay that is available, technically, in such a scenario, there is no standards that is applicable here. In that case, the other person will also be part of my engagement team. Read with SA 220, which talks about quality controls, I may be in a position to use that particular work. He will be part of engagement team. It will be my responsibility for the aspect of reporting here. Let us go and take very appropriate nuances with regard to SA 600 and then proceed further. Before going into the technical aspects of SA 600, let me also give you a background about the standards on auditing. Sir, all the standards on auditing in India are at par with international standards on auditing. There is not even a iota of change with regard to the international standards and our standards, because there are cross-border transactions are happening. From India, I am making investments in China or Australia or Singapore, and from US, they are making investments in India. So the language that I speak and the language that he speaks should be in the same parlance. So accordingly, the purpose of which me doing an audit, the purpose of the US auditor is doing the audit should be appropriate. The objective of the audit is to be same. So in order to bring in this consistency and uniformity, similar to that of your IFRS and Ind AS as the case may be, in auditing parlance also, the standards on auditing are speaking the same language, irrespective of the territory, geographical location that you are into. The international standards on auditing are set in such a fashion that their objective is going to be the same, to express an appropriate audit opinion on the financial statements, the concept of materiality, the concept of sampling, the concept of reporting, uniformity reporting, everything is going to be the same, except for a minimal change with regard to a local regulatory requirements that could be applicable in India. In India as well, as I told you, all the standards on auditing are at par with international standards, including the numbering pattern. You should have the same numbering pattern. SA 600 means ISA 600 will also be on the same number. SA 600 will also be on the same number. ISA, international standards on auditing. But the only point of difference is this particular SA 600. There is a huge difference between international standard and Indian standard. What is the difference? In international standards, SA 600, they say that the component auditor will also be part of my engagement team. The reporting auditor, the holding company's auditor who is going to report on the entity as a whole, he needs to consider the component auditor also as a part of his team engagement group. He will be part of the group audit scenario, and the component auditor will, since he is a part of the engagement team, the reporting entity's auditor will be responsible for whatever the flaws or whatever the non-identification of material misstatements by the component auditor. Also, I will be responsible is what the scenario. I'll take a simple example of State Bank of India. State Bank of India is having 45,000 branches. Out of 45,000 branches, 20,000 branches are audited by statutory branch auditors. There are some 10-20 central statutory auditors sitting and consolidating all this and then presenting the financial statement as a whole, State Bank of India as a whole. assuming in one of the component, in one of the branch, there is a material misstatement which is not detected by the branch auditor, who is also a competent person, and then he is a qualified, equally qualified chartered accountant who has been appointed by the entity, and then he is doing the reporting. If he has not identified a material misstatements, it shall be the responsibility of the central statutory auditor, is what the contention of ISA 600. In Indian scenario, there is a difference. Since he is an equally competent personality, I can very much rely on the work done by the other person. I shall not be responsible for the mistakes or non-compliance or non-identification of material misstatements by the branch auditor or a component auditor, as the case may be. We take a classic example of Punjab National Bank, sir. There was a problem in Mumbai branch. There was a huge fraud, 16,000 crores of frauds that was undetected. The branch auditors undetected. Similarly, this fact was not detected by the central statutory auditors also. Even the management has not detected. That's the problem. Nobody is talking on the management's undetection of this particular fraud. First, it is the responsibility of the management to design. The design, the internal controls are their complete responsibility. They have missed it. The entire core banking solutions was not included. This particular foreign transactions where there is a SWIFT code to be generated should be within the core banking operations. It is absolutely out of it. So the bank's failure costed again to the branch auditor's failure, which is again will be responsible of the principal auditor's failure. It is absolutely not possible. Just think of 20,000 branches. How come a central statutory auditor will be responsible for each and every component? In Indian scenario, it is absolutely not possible. In Indian scenario, what is possible is, if at all there is a requirement for the central statutory auditor or a principal auditor, as the case may be, I may be instructing the branch auditor to go for a specific verification of certain aspects. I may instruct them, I can verify whether they have done appropriately, and then I can consider that is maximum, that is permitted, that is what exactly SA 600 also talks about. So in this particular background, even there are a lot of pressures to move for this particular SA 600 in line with international standards, but our institute is very firm that in Indian context this cannot work out, because separate auditors, individually practicing professionals are appointed as a component auditor, and at no point in time they can be treated as the reporting entity's engagement team. That is absolutely not possible, is what the stand taken by the Indian scenario. And also there is a NAFRA who is coming in, who is a big brother of institute. Section 132 of the Companies Act constituted this particular NAFRA. They said, no, you should revisit, and then you need to go for thinking that you are also responsible like that. They also came out with a circular explaining the intricate provisions of the standard in such a way that explaining that you are also responsible like that. Having said all this, the statutory auditors' responsibility is limited with regard to the relaying the work done by the other party. The other party shall be solely responsible for the audit, that whatever he has taken care, is what the logic with which we are dealing with this particular essay here. With this background, let us go and understand the specific nuances of this particular essay, sir. This particular essay establishes the responsibilities of the principal auditor and the other work of the other auditor for the component. So here, under all the standards on auditing, the auditor, independent auditor, is referred as an auditor. That's it. If you talk about auditor, it means he is a statutory auditor, he is an independent auditor who is appointed and take care of the statutory audit. Because to differentiate between the statutory auditor of the holding company and statutory auditor of the subsidiary company, the SA uses the term principal auditor and component auditor, or principal auditor or other auditor is what the term used. The principal auditor in the given case, we need to assume that he is the component, that is the holding company's statutory auditor, and the component auditor or other auditor is the branch or subsidiary company's statutory auditor, is what that we need to believe here. So it talks about the responsibilities with regard to the principal auditor when using the work of other auditor. Can I use the work of other auditor? Answer is double yes. You can very much rely and use the work of the other auditor, because other auditor is also equally competent professional. In a case when the other auditor is not an equally competent professional like a member of institute, then you need to go for specific verification in order to evaluate the competency of that person. Otherwise, if he is a member of the institute, you need not do any specific testing about the competency of the other auditor, is what the provision by standards are here. This includes communicating expectations, understanding the significant findings, reviewing the documentation or summaries, and deciding whether supplemental procedures are needed with regard to a component, whether I need to perform extra verification or not, like that. There are practical insights here. If you take practically also, sir, in a branch audit, typically before starting any branch audit, the central statutory auditor will give a 4 pages, 2 pages of instruction what is to be done. It is a timeline, any problem, the MOC has to be made and any confirmation to be made, like that. There are a lot of instructions that will be coming from the central statutory auditor because they want to have the uniformity with regard to all the branches. So in LFAR reporting, all will be taken care by the central statutory auditors. Another very important aspect is the audit findings of the component may have an effect on the reporting entity's financials also. If my component's financials are also materially misstated, the same effect will also be there in the principal entity's reporting as well. So will it be treated as a modification? Should I need to go for a change in my audit procedure like that in order to evaluate the significance and influence of the component's financials into the reporting entity's financials? The principal auditor has to evaluate what is the significance of the component in the reporting entity. Say for example, I have a loan balance of 100 crores. Out of loan balance of 100 crores, 20 crores are from components. Then the effect is 20%. In the second scenario, out of 100 crores of loan balance, 40 crores is from components. Then in that particular case, there is a 40% influence rather than the 20% influence. Accordingly, I will be evaluating the nature, timing and the extent of audit procedures that is to be performed, the reliability of the work done by the other auditor, what are all the specific aspects that the other auditor has to look into, like that. The principal auditor will be discussing and devising an appropriate audit strategy here. Coordination and timely communication and documentation of conclusions are very, very essential elements of this particular essay. Very, very important term is EGO. That will play a very, very vital role, sir. What is this EGO? I am also a chartered accountant. The component auditor is also a chartered accountant. Because of the fact that I am calling myself as a central statutory auditor, I should not say that I have a separate wings and then I can fly. No. He is also equally competent. Because of the fact he is doing a branch, you cannot underestimate his potential capacity. So there should be automatically and always there should be an appropriate coordination between the principal auditor and the branch auditor or a component auditor. There should be a smooth coordination so that whatever the aspect of verification that the principal auditor wants to be verified on the component, you can advise the component auditor to go for a specific verification and reporting, like that it could be possible. Without this particular proper coordination and communication, it will going to be a very great problem. So there should be a appropriate coordination is essential, is what this particular essay is also insist upon. There are 3 definitions. One is a principal auditor, the other auditor and the component, as we have discussed about. The principal auditor means the auditor with responsibility for reporting on the financial information of an entity when that financial information includes the financial information of one or more components audited by another auditor. So it is like a consolidated financial statement. You just think of, I am Reliance Industries, I have 100 subsidiaries, all 100 subsidiaries put together, and then Reliance Industries consolidated financial statement is to be prepared. The financial statements audited by other auditor are also to be included in the reporting entity's financials. The person who is going to report on the consolidated financial statements will be called as a principal auditor. And the second one is other auditor, means an auditor other than the principal auditor with responsibility for reporting on the financial information of a component which is included in the financial information of the reporting entity. That is something called as other auditor. That's why I told you the previous auditor or an internal auditor or my friend who is a chartered accountant cannot be treated as the definition of another auditor because it may not fall within this particular definition. So we need to be careful whom we are referring as another auditor in the context of SA 600. And the third one is component, which includes branch, division, subsidiary, associate, joint venture, whatever name call, everyone will be treated as a component here. Division, branch, subsidiary, joint venture, associate enterprise or other entity whose financial information is included in the financial information audited by the principal auditor here. The key provisions of this particular essay is the principal auditor should consider whether auditor's own participation is sufficient to be able to act as a principal auditor. Am I having the capacity and capability to report on the consolidated financial statements or reporting entities financial statement as a whole? And if the other auditor is not a member of ICAI, then principal auditor needs to evaluate their competency. When the other auditor is not a member of institute, then I need to evaluate the competency. Sir, when this particular scenario will happen, if at all the component is in India, then this can never happen because always it is another by chartered accountant only is entitled. If the component is situated outside India, say for example I have a foreign subsidiary which is audited by a foreign auditor, then this particular provision will come into, I need to evaluate the competency of the other person or professional who has done the audit of that particular foreign subsidiary or foreign branch, as the case may be. This will come into place here. The principal auditor has right to access the books and records of the component in case of the company under Companies Act 2013, because this is one of the right of the company's auditor as given under section 143 of the Companies Act. They say that not only the holding company's financials or books of accounts, I am entitled to rely on the subsidiary company's books also. I am having right to access the subsidiary company's books and financials, records, vouchers, everything is available. So the principal auditor is having all entitlement to go and verify and access the component's financials as well. There is a small difference. Whether am I having access to the working papers of the component auditor? The answer is no. Am I having access to the financials of the component? Answer is double yes. That's the difference here. The working papers of the component is the auditor's property. That is the component auditor property as per SA 230 here. I cannot go and have access of the working papers. That is not permitted. Even SA 600 prohibits that. However, I can have access to the direct books of accounts of the component itself, and then I can do a re-verification irrespective of whether an audit has been already happened or not. I can do test checking. Everything is permitted under SA 600 as well as under Companies Act for the case here. The PA does not have direct access to the working papers of the other auditor. This is what the point that I was talking about. The PA may visit the component or other auditor if they consider necessary to do so. I am having all access in a practical scenario here. I can visit the branches, I can visit the subsidiary, I can even visit the branch auditor or subsidiary auditor to have discussion and to have an appropriate opinion on the financial statement as a whole. The PA should perform procedures to obtain sufficient appropriate audit evidence that work of another auditor is adequate for the principal auditor's purposes in the context of a specific assignment. Sufficient and appropriate audit evidence is an inevitable term that is going to be there in the principal auditor's perspective, sir. As per SA 500, that talks about what do you mean by sufficiency, what do you mean by appropriateness. Read with SA 700, unless there is a sufficient appropriate audit evidence which is enabling me to form an opinion, I may not be in a position to provide an opinion at all. So whatever the audit evidences that is acquired should be sufficient enough to enable me to form an opinion. Thereby I will be forming an opinion, thereafter I will be expressing an opinion. We are going to take those aspects under SA 700 here. So the work done by the component auditor, is it sufficient, appropriate? Because I am going to use as an audit evidence for the numbers that I am going to certify. Say for example, I am certifying the fixed assets values 100 crores, consolidated financial statement. 80 crores is verified by my component auditor. I am going to certify 100 crores. So the responsibility lies on me for certifying that 100 crores. So am I getting sufficient appropriate audit evidence that the 80 crores whatever he has provided is appropriate? Can I rely? Is it a competent person to do that particular working? Like that, there are multiple parameters that the principal auditor has to evaluate, because I am certifying those financial statements, I am providing an assurance engagement in this particular regard. Am I obtaining sufficient appropriate audit evidence or not shall be an important parameter for the principal auditor to verify here. The PA should issue written instructions to the other auditor to enable the PA to obtain sufficient appropriate audit evidence to support their audit opinion. Wherever required, I can also give written instructions. See, I cannot direct him. I cannot have control over what the other auditor has to do. No, he is also equally competent person. I can make certain specific requests. Sir, I feel this particular entity, the internal controls are weak. I feel these areas there are possibilities of material misstatements. These areas there could be a possibilities of frauds. Like that, the areas of weakness, the deficiencies that are identified by the statutory auditor can be communicated to the principal auditor and to go for a specific verification, and accordingly the conclusions can be drawn up by the principal auditor here. The PA should clearly advise other auditors that their work is relied on by the PA and shall enable adequate instructions and coordination and licensing. The other auditor is required to communicate their relevant findings in the course of audit of the component, and the PA shall discuss the same with the other auditor. Necessarily, because the component auditor's work is going to have an influence in the principal auditor's reporting, the component auditor is also having a responsibility to intimate the significant audit findings to the principal auditor. Accordingly, based on this significant audit findings, will it have influence on the reporting entity? Will I need to go for a change in my audit procedures? Should I need to incorporate that particular significant findings in my audit report? Like that, there are multiple considerations that the principal auditor will have into place. Consider here. The PA shall consider the report issued by the other auditor, including modified opinion and its impact on the audit report of the PA here. Say, for example, there is one component, a subsidiary company. That subsidiary company's auditor has qualified a particular financial statements. I am a principal auditor going to report on the CFS, consolidated financial statement, which includes the modified opinion audit financial also. Should I need to also modify that particular consolidated financial statements? Because there is a modification. Sir, when there will be a modification, we will be going and discussing exclusively on SA 705 that exclusively talks about what do you mean by modification. Whenever there is a material misstatement in the financial statement, whether it is either due to error or due to fraud, there is a material misstatement where the auditor identifies that there is a material misstatement. What is the responsibility of the auditor? To immediately communicate to the management, sir, there is a material misstatement, please correct it. When the management corrects that particular material misstatement, no problem, I am having a cakewalk. On the other hand, when the management is not willing to correct that material misstatement, management says, my stand is correct, my provision is right, my income recognition is right, like that the management is taking a stand contradictory to the auditor's thoughts, then the auditor will feel that there is an uncorrected material misstatement. That uncorrected material misstatement, should I need to go and report it to the shareholders by way of a modification in my audit report, or can I drop this uncorrected material misstatement? On what basis I will be deciding? I need to go and take the help of SA 450. SA 450 talks about the materiality consideration with regard to the uncorrected material misstatements. There may be an uncorrected material misstatement, still the auditor may not modify, considering SA 450's provision. So the auditor who is going to report needs to evaluate this particular material misstatement which is uncorrected will result in a modified opinion or not, because whether it is having an impact on the financial statement as a whole or not, like that I need to consider. I'll give you another example so that we will have a practical reliability. My inventory value is, technically speaking, 2 crores. But the management is valuing that particular inventory as 4 crores. Is it a misstatement or not? I want your answer. Is it a misstatement or not? Yes. Is it a material misstatement or not? Yes. 2 crores inventory valued at 2 crores 10 lakhs. Is it a misstatement or not? Answer is yes. Is it a material misstatement or not? May not be. It's based on other criteria. We need to decide. In the given case, 2 crores of inventory is valued at 4 crores. It is a misstatement. It is a material misstatement. But as per 450, the auditor has to apply whether is it a material misstatement considering the financial statement as a whole. Say for example, my balance sheet is a 1,000 crore balance sheet and the inventory is a minuscule, that is I'm a software company, I don't have inventory at all, but a very small number of inventory also I'm maintaining. The 2 crores is accounted as 4 crores. But my balance sheet is 1,000 crore number, my revenue is 1,000 crores of number. In that particular scenario, the auditor may even take a call that in spite of the fact that there is a material misstatement with regard to a component, it need not be a material misstatement considering the financial statement as a whole. Are you in line with me? So, in that particular case, I need to apply SA 450. I can even drop that particular mistake. I can give a clean opinion still. Or I may go for a qualified opinion. It's again based on the judgment, based on the impact. We'll be dealing completely on SA 705 in this particular regard. So here I am coming back to my original discussion where a component's financial statement has been modified. The auditor has given a qualified opinion. Should the qualified opinion should also be incorporated by the principal auditor or not is what the question. Answer is need not be is what the answer provided by SA 600. Need not be always you need to include that particular fact. If there is a modification in the component's financials, you can evaluate its impact, its significance and its impact on the financial statement as a whole. If you feel you can even drop it, no problem. Is what the right given by SA 600. On the other hand, if you feel that it is significant, the components numbers are going to have a significant influence in the consolidated financial statements, then appropriately discuss with the other auditor, understand the provisions, understand sufficient appropriate audit evidence, and you also modify that particular financials accordingly is what the prescription given by SA 600 here. Very beautifully discussed, sir. Also very importantly, I need to say, as a principal auditor, I need to say what is the extent of reliance that I am making on the other auditor's work. How I am going to rely, why I am relying on the other auditor's work to the shareholders of the company. Even though SA says you can rely, I need to explicitly provide the effect of this particular reliance to the shareholders of the company in line with SA 706. 706 talks about emphasis of matter paragraph and other matter paragraph. There are two matters that are discussed under SA 706. You are all with me or not? Sir, nalla saapadu, nityamrutam. So very good food we had, including with all goodness of curd. And then payasam also I took completely. And then sitting with complete AC room. The climate is very nice. And you start talking. Very good, sir. Your rhythm is also perfect. Super. Very good. Very contextual. Super. So the purpose, complete objective of this particular discussion is to have a mutual understanding and practical effect only, sir. You are all with me? It is not that I need to say some essay number 450, 600, 700. No. I'm just making the importance of the provisions that are explicitly given under the each essay. Because my entire audit is governed by the standards on auditing and standards on auditing only. Any regulator who comes for my verification will be asking the first question, have you complied with standards on auditing? Substantiate and prove that you have complied with standards on auditing in line with SA 230 documentation. So standards on auditing is it's like an oxygen, it's an elixir. I cannot live without standards on auditing. The point that I am driving home, in every seminar I used to tell this, in Indian context, the standards on auditing, whether people are aware or not, whether the people practicing who do the audit, whether they know the standards on auditing or not, is a question that many people will ask me. Many forums that I used to explain that every chartered accountant knows completely about the standards on auditing. We know standards on auditing. It is not that someone has to come and teach what you mean by standards on auditing. But the point is, are we substantiating with our documentation that these are all the standards that we have complied with? The answer is we require certain improvisation. Sir, SA 530 today morning, Pratima was beautifully describing about SA 530, about sampling. Whether sampling SA 530, whether we may not know SA 530 talks about sampling, but we know sampling. Do you agree with me or not? Right from articles, we did the sampling only. Nobody needs to come and teach how to do sampling. SA also says that. We also do that. But when a regulator comes and asks, 530, have you complied? 530, அது என்னது 530? புதுசாக சொல்கிறீங்க, வாட் யூ மீன் பை 530? சார் சாம்பிளிங் அது நான் பண்ணிட்டேன், பட் ஷோ மீ தட் யூ ஹவ் கம்ப்ளீட் வித் SA 530. In that particular scenario, I would have taken all reasonable care and caution in doing my audit. I would have verified everything as per the standards procedures, but I may not be in a position to document that I have done as per standards on auditing. The gap is very, very simple, sir, in today's parlance. I don't have any problem with regard to Indian chartered accountant performing an activity, beautiful activity that we do. 99.9% of Indian chartered accountants are really doing a great activity by doing an audit with professional skepticism is completely with me. None of the auditor will do a signing of financial statement just like that. Kudupa na sign pantu kudukran 5,000 rupees fees kudu. No, I am not doing it. Every work, every activity, every numbers are being verified and then only it is been signed. Do you agree with me or not, sir? We take that much of pain to evaluate and verify and then sign. Tomorrow comes and says you are not done your audit, grossly negligent. You don't have papers. Because of those papers that I am not having, doesn't mean that I am grossly negligent. I would have taken all reasonable care and caution, as stipulated by standards. But I have not documented. Let us understand what is to be done. Let us be very practical in what we need to do. Sir, idhe 530 sampling I would have done, sir. 1,000 vouchers are there. I have not verified 1,000 vouchers. I am not required to verify all 1,000 vouchers. 100% is a population I need not verify. I verified 100 vouchers. 100 vouchers verified. And then I am satisfied the purchases are appropriate. No problem. Okay, done. My problem is when someone comes for review or NAFRA, Quality Review Board, or Peer Review Board, whomsoever it may be, have you done your audit as per sampling? Yes, sir, sampling I have performed. Show me your working papers in line with SA 530. I may not have. What I need to do now? Whether I need to go only as per statistical sampling or judgmental sampling is permitted, SA 530 says it is based on your judgment to see whether I need to take a statistical sampling or a judgmental sampling. I can very much do judgmental sampling, no problem. But make a documentation. Sir, one A4 sheet paper. The total population with regard to the purchases is equal to 1,000 vouchers. From April to 31st March, the cut-off procedure that I have done, as per the cut-off procedures, the total number of vouchers is equal to 1,000. On what is the basis that you are taking sample? Based on judgmental sampling, the sample number taken is 100. In such a way that it is sufficient enough to cover the total population, being 10% of the population, one line item. Then what is your observation? Out of 100 vouchers that I have verified, I found that these are all there, approvals are there, data is there, working is there, and recording is there, audit trail is there. I don't find material misstatement in that financial statement of the component with regard to the purchases. Purchase population, there is no material misstatement. Sign it. There should be one person who need to review. There should be one person who needs to sign off. Sign it, have this particular paper. Your SA 530 compliance is over. Do you agree with me or not? I need to do one more item, like projecting the results of the population, of the sample to the population. So based on the 100 vouchers of this value, we found that there is no material misstatement. Accordingly, for the total population, we found no material misstatements. This is what your summary that you are making out of audit procedure of SA 530. You have complied with one A4 sheet of paper, sir. Because of this particular paper is not available, today chartered accountants are taken to task that you have not done your audit as per standards on auditing. Standards on auditing are nothing but whatever we do, whatever we practice, that is what that they said. In fact, whatever that we practice is what that they have written. External confirmation, are we not getting? Bank verification, are we not doing it? Analytical procedures, are we not doing it? Everything we do it. Everything we do it. SA 315 talks about identification and assessment of material misstatement by understanding the entity and its environment, including its internal controls. KYC, simple 3-letter word, knowledge about your client's business. Without understanding the client's business, will I take an audit, sir? I need to necessarily verify who is that particular client, what are all the activity that they do. I always used to say, the father would have started this particular company, and then the auditor would have been associated. Father may not be there available, he might have passed away. The son would have taken up the company now and he will be running the company. Even he may not know the nuances of the company, the auditor will be knowing it. Do you agree with me or not? That is the association, that is the way in which we understand the business and then do the things. So SA 315 compliance is a cakewalk for us. But we don't document as if it is a SA 315 compliance. So the point here is SA 230 is a very essential essay that talks about audit documentation. We need to document whatever that we have performed. It is not only performance, we need to capture whatever that we perform. That's why this particular standards on auditing compliance will have. Now coming back, I am just absolutely different from whatever the context that we are talking about, but it is very, very relevant. The point that I am driving here is there are interlinks between one essay to another essay. When I read SA 600, I cannot read SA 600 alone. I need to take the help of SA 706 that talks about emphasis of matter paragraph and other matter paragraph. In that other matter paragraph, SA 706, which talks about auditor's responsibility and auditor's reporting, I need to take a clue and take a help. In case the principal auditor is using the work done by the other auditor, I need to report in other matter paragraph as per SA 706 that this has been verified by the other auditor and we are relaying the work done by the other auditor. That's a responsibility that I need to report as per SA 706 here. You are all with me? Yes. The PA shall consider the report issued by the other auditor, including modified opinion and its impact on the audit report of the PA. In India, presently the audit report of the PA also places a sole reliance on the work of the component auditor, even as per the illustrative format in SA 700. I can solely rely on the work done by the other party. I need not question or doubt on the work done by the other party, because the other party is also a competent chartered accountant of a component here. The essay has also been the context of a circular issued by NAFRA, which is applicable for the classes of auditors under their jurisdiction. there is a larger need for understanding and application of this essay by the auditors, because this essay is a very good essay which shifts the responsibility from the principal auditor to the component auditor. Unless I make the disclosure as per essay 706 under other matter paragraph, I am not in a position to shift the responsibility. I need to necessarily include it, and then I need to shift the responsibility. So then the principal auditor will not be responsible for the work done by the other auditor. I can solely rely on the work done by the other auditor here. Unlike ISA 600, this is what the difference between international standard and our standard here. This is the only essay that there is a difference. Otherwise, all other essays are absolutely in line with international standard. Unlike ISA 600, this essay does not consider the other auditor to be part of their engagement team of the PA. Sir, how come another auditor in Indian context can be my engagement team member? He is an independent chartered accountant practicing in West Bengal, who is doing a branch audit of State Bank of India. I am a central statutory auditor. How can I become his engagement team member? At no point in time, at no stretch of imagination that he can be part and parcel of my engagement team, because my firm's policies and procedures are different. His firm's policies and procedures are different. And there is no contract between myself and the other auditor at all. I don't know even who is that. It is all the reporting entity which connects us both. So at no point in time, at even no stretch of imagination, he can be my engagement team member. That is not possible technically, is what my contention here. There is no right of the PA to direct or supervise the work of the other auditor, and hence the PA places reliance on the work of the other auditors and states so in their opinion also. So this is how the crux of the SA 600 talks about the responsibility can be shifted to the other auditor when he is the person whose financial statements has been relayed by the principal auditor here. Let's go for certain case studies as well in order to have a better understanding of this particular essay. RST and Associates is appointed as the principal auditor of G Private Limited, a company with operations in India, and a subsidiary audited by another firm, LMN & Co. The subsidiary contributes 30% of the total assets and 25% of the revenue of the group financials. So the moment here, there is a number that says 30% of your assets are from the subsidiary and 25% of your revenue are from subsidiary, it is something significant. It is something very, very relevant. If at all there is a material misstatement in the financial statement of the component, it will have a direct effect on the financial statements of the reporting entity also. What is the influence of the component? If the influence is high, I need to extend my audit procedures and then I need to look at the components accordingly. Assuming that on the other hand, if the influence says 2% of your total assets and 1% of your total revenue, that is also having an influence, but it is having a lesser influence. My nature, timing and extent of audit procedures will be different in that particular scenario here. As per SA 600, when the principal auditor uses the work of another auditor, the principal auditor should determine how the work of the other auditor will affect the audit. So accordingly, I need to go for it. I need to have a better coordination with this component auditor. Necessarily, yes. Because somewhere around 25% and 30% is going to be contributed by the component, certainly I need to have a much larger discussion with the component auditor, coordination with the component auditor, specifically wanting the component auditor to verify on certain aspects, including deficiencies in internal controls. Like that, there will be a possibility of discussion and then to consider the report given by the component auditor here. The principal auditor appropriately references the other auditor's work in the audit documentation, thereby complying with the requirements of SA 600 here. Considering the competency of the other auditor, ABC & Co is the principal auditor of G Limited, which has a branch in Nepal, audited by a foreign audit firm, Bright & Partners, which is not a member of the Institute of Chartered Accountants of India. How should the competency of the other auditor be evaluated? Very, very important aspect here. Sir, it is, as I told you, it is not with the Indian scenario. It is a component is situated in a foreign country. In such a case, where his work I am going to rely as an audit evidence because his work is having effect on the financial statements of the group. So whether he is first of all competent enough to evaluate that particular numbers with regard to the Nepal's financial statements, whether that firm, Bright & Partners, are they entitled to do the audit as per the laws of Nepal, whether they are licensed, whether they are competent enough, if they so, whether their objective and my objective is absolutely same. Say for example, in Nepal, their objective of audit is to identify frauds. Their verification methodology by itself will be different. In India, the objective of audit is to express an opinion on the financial statements, not finding faults, frauds. Fraud detection may be an incidental objective. But the point is, my verification process and their verification process should be in line, should be in sync, then only their work can be relied upon. So in this case, what I need to do, since the other auditor is not a member of institute, the reporting entity's principal auditor has to necessarily evaluate the competency. Again, evaluating the competency doesn't mean I need to make a test for him. You pass this test, then only I will ensure that you are a qualified person. No, that's not the criteria. We are not going down to that level. We will be just evaluating whether they are competent enough, whether they have the capacity to do the audit of this one, and then can I rely on the work? See, the point is my perspective. Whether can I rely their work as my audit evidence or not is what the sole concern that is to be addressed by the auditor here. SA 600, when planning to use the work of another auditor, the principal auditor should consider the professional competency of the other auditor in the context of specific assignment. If the other auditor is not a member of the Institute of Chartered Accountants of India, accordingly, before relying on the work of Bright and Partners with regard to a Nepal firm, ABC & Co. evaluates the professional competency of the other auditor in the context of the assignment. ABC & Co. obtains the information about the firm's qualification, licensing and membership with the local professional body, the auditing standards and audit methodology followed in Nepal, and the experience of the engagement partner and the engagement team in handling this particular branch audit, so that they are competent enough, they would have done an appropriate manner, and then I can rely on that particular work. Now what you need to do, I need to place SA 706 into place. That SA 706 other matter paragraph with regard to the component from the Nepal which is audited by another auditor, we have solely relayed the work done by the other auditor. Like that, you give the responsibility clearly. Assuming later point in time, there is a material misstatement with regard to the Nepal branch. In the Nepal branch, there is a material misstatement which is not detected by the Nepal auditor. Whether I will be responsible or not, answer is absolutely no. It is their responsibility to do so, because I have also stipulated the same under SA 706 other matter paragraph here. Outcome is the after evaluation, ABC & Co. concludes that Bright and Partners possesses adequate professional competency. Therefore, ABC & Co. decides it can relay the work of the branch audit here. Coordination between the principal auditor and other auditor is always essential. ABC & Co. is the principal auditor of D Limited with multiple branches. Chennai branch, contributing about 35% of total sales, is audited by another firm, M&O & Co. As the branch is significant to the company's results, effective coordination between the two auditors is essential for consistent audit procedures and timely consolidation of branch accounts. How will this be enabled? Necessarily, there will be a part of communication at the time of appointment itself. Even it will be a part of SA 210 engagement. When the branch auditor's appointment and the company makes an agreement with the branch auditors, SA 210, which talks about terms of the agreement of the engagement, may insist upon a clause that you need to report to the principal auditor whatever the audit findings, whatever the directions or instructions given by the principal auditor has to be adhered to, and appropriate timing reporting to be done like that. There may be timelines also can be stipulated at the time of appointment of the branch auditor itself, and appropriate coordination is also essential here. So here, to ensure proper coordination, ABC & Co. sends a written communication to M&O & Co. describing the scope of audit, information about the company, reporting deadlines, and the need to communicate any major issue through a summary, etc. M&O & Co. keeps ABC & Co. informed about their significant findings during the branch audit. Through timely listening and cooperation, both auditors maintain effective communication, addresses issues timely, and ensure consistency in the overall audit opinion as required by SA 600 here. Reviewing the work of other auditor, should I need to redo or should I need to review here? ABC & Co. is the principal auditor of Z Limited, whose major subsidiary ZP Limited is audited by another firm, LM & Associates. As the subsidiary contributes significantly to the group results, ABC & Co. needs to review and evaluate the adequacy of work of LM & Co. before relying on it for forming the group audit opinion. I can very much review, I can discuss with the other party, but the point is I cannot have access to the working papers of the subsidiary auditors. That's what the position is. To ensure quality and adequacy of the work performed LM & Co., ABC & Co. discusses with them the audit procedures applied and key findings, the areas of significant risk. LM & Co. Associates provides the responses to the written instructions and also provides a written summary of their key findings, issues, uncorrected misstatements, etc. All queries of ABC are satisfactory and understood, explained it appropriately. At times, I can even get a management's representation, sort of a thing from the auditor's component auditor also. These are all the aspects that we have verified. This is how I have planned our audit. These are all the outcome, and this is how our summary findings like that. The component auditor can even give that particular summary memoranda to the principal auditor. Based on it, that auditor can relay the work done by the others here. Statement about division of responsibility in the auditor's report. The moment you think of division of responsibility in 2 essays, this will have an effect. Division of responsibility, 1 in essay 299, that talks about joint audit assignment. When there is more than one person is appointed as a joint auditor, then who is responsible for what area? It is to be mutually discussed and decided. It is not to be instructed by the management. Then it will be treated as a sort of restriction in the scope. So it should be mutually discussed and decided by the joint auditors. What is your area? What is my area? Like that. The division of work and responsibility to be documented before commencement of audit, and then that is a part of my essay 299 requirement and documentation part as well. Again here under essay 600, where we have the division of responsibility, where we need to identify what is the responsibility of that particular component auditor, where I am going to relay the work done by him. I welcome our Central Council member Sri Priya ma'am for this session. Happy to have her, ma'am. Basically, as I told you already, ASB is taking a wonderful initiatives in ensuring that this particular standards and auditing reach out every member. So that's the purpose of this particular program, and very happy the chairperson by itself is here, who is taking care of the entire regulating the entire programs here. Thank you, ma'am. So let us proceed further for the next one, discussion and supplemental testing by the principal auditor. Should I need to do a testing of the work done by the component auditor or not? SA permits, you can even do a supplemental verification. You can have access to the component's financials, no problem, is what the suggestion given by SA here. M&O Associates is the principal auditor of Star Group, which is having a subsidiary audited by another firm, PQR & Co. During the review, M&O Associates observes that the subsidiaries' receivables have increased significantly, raising about the recoverability. So the moment there is a spike, even as per SA 520, when there are analytical procedures that are performed, when there are significant fluctuations with regard to the financials, there could be a possibility of material misstatement. Auditor need to extend their audit procedures to ensure that particular significant fluctuation is not a material misstatement here. Similarly, here also there is a significant fluctuation, increased significantly with regard to the receivables value, and it creates doubts on the thoughts of the principal auditor here. The application is, as per SA 600, the principal auditor may consider it appropriate to discuss with other auditor and the management of the component the audit findings or other matters affecting the financial information of the components. He may also decide that the supplemental test of the records or the financial statements of the component are very much necessary, because there is a significant fluctuation. After discussion with the component auditor, in spite of the fact the confirmation provided by the component auditor, the statutory auditor, that is the principal auditor, can even go for this particular supplement testing here. Such test may depend upon the circumstances, be performed by the principal auditor or the other auditor, as the case may be. Even in such a scenario, when there is appropriate coordination between the principal auditor and the component auditor, the principal auditor may even direct the component auditor to go for a specific verification and then report back. So that could also be possible, or the principal auditor himself can go for a supplement verification and then conclude accordingly here. Procedures to ensure adequacy of the auditor's work, how the other, because I am going to rely on the work done by the other auditor, what are all the audit procedures that the other auditor has performed? Because as per SA 600, I need to obtain sufficient and appropriate audit evidence. So in such a scenario, how I may be in a position to evaluate? ABC & Co is the principal auditor of N Limited. The company has a wholly owned subsidiary, NS Limited, which contributes nearly 40% of the group's turnover and assets. The moment we see 40% is contributed by one of the component, which will have a direct effect on the reporting entity's financials, which is considered to be significant as well. So I need to necessarily go and have a coordination with regard to the component auditor here. XYZ & Co has been appointed as the statutory auditor of the subsidiary. Since the financial information of a subsidiary forms a material part of the consolidated financial statements, ABC & Co needs to ensure that XYZ & Co audit work is adequate and can be relied upon. How this can be done? So, because again the other component auditor is also equally competent personnel, since the fact that they are competent enough who are members of the institute, I need not go and evaluate the competency, but on the next point, that is with regard to the sufficiency and appropriateness of the audit work. So as per SA 600, the principal auditor should perform procedures to obtain sufficient appropriate audit evidence that the work of the other auditor is adequate for the principal auditor's purposes in the context of a specific assignment. When using the work of another auditor, the principal auditor should ordinarily perform the following process, including the review of the work done by them. Their working papers cannot be accessed, but I may get a summary memorandum of the process that is performed by the other auditors here. Advise the other auditor of the use that is to be made by the other auditor's work and report, and make sufficient arrangements for coordination at the planning stage, informing the other auditor of the areas requiring special consideration, procedures for identification and intercomponent transaction, and the audit timelines here. And advise the other auditor the significant accounting, auditing and reporting requirements to obtain representations as to comply with them. So, as I told you earlier, there may be usually in the light of a bank audit, you just to take an example of a bank audit where the central statutory auditors shall be normally giving instructions to the branch auditors. These are all the specific areas to be looked into, and these are all the observations that you need to make in. Here as well, the principal auditor may be in a position to communicate to the component auditor in the initial stages itself. So these are all the specific areas or the weaknesses that are identified in the financial statements of the component. Look into specifically and then report back like that. There may be a possibility of coordination and effective cooperation with that. The objective can be achieved here. Principal auditor's right to visit a component. Can I visit irrespective of the fact that there is a separate audit which has been conducted? The management says, no, already there is an auditor who has then verified. So why you once again do a re-audit? It should be a double taxation avoidance. Like that, there could be a possibility management preventing the principal auditor to going it. There is no way. SA 600 permits. Companies Act also permits in this regard. XYZ and Co. is the principal auditor of Metro Bank, which has several regional branches. The Delhi branch is audited by another firm, PQR Associates. XYZ would like to visit the Delhi branch as there is an unusually high level of activity both in terms of loans as well as in deposits. However, there is a view that PQR shall alone do the audit. Is that correct or not? Absolutely not correct. In line with SA 600, we can have the right to visit the access of the that is very much permitted. Companies Act, again, 128 books of accounts which talks about where I have access to the component subsidiaries financials as well. As per SA 600, in certain situations, the statute governing the entity may confer a right on the principal auditor to visit the component. Exactly in Indian scenario, we have Companies Act. 143 right also says that. Visit a component and examine the books of accounts and other records of the said component if he thinks it necessary to do so. Where another auditor has been appointed for the component, the principal auditor would normally be entitled to rely upon. This is what the normal situation, general entitlement. I need not go with the suspected thoughts. Audit is not required to be suspicious activity on the component auditor, but I need to be skeptical always. Professional skepticism is the core word that the auditor has to always use. There are two important constant factors that is to be used by the auditor in every audit. Throughout the audit, this is to be maintained. One is professional judgment and the other one is professional skepticism. The professional judgment is making an informed decision by the auditor. Whatever the decision that I am taking is an informed decision that is being taken by the auditor. There are many areas in audit where the professional judgment is applied, including materiality, whether is it true and fair, whether it is reasonable or not, like that. There are multiple areas where the professional judgment shall be applied by the auditor, which is a constant factor. The second and most important factor to be applied by the auditor here is professional skepticism. What is this? It's technically an attitude, a quality of an auditor with three important points. One is having a questioning mind. Please remember that I need not have a suspicious mind. I need to have a questioning mind. Is it right? Why this is not? Why this is like that? I need to always have a professional skepticism, having a questioning mind. Being alerted to conditions that could be possibility of errors and frauds in a financial statement, maybe due to errors and frauds, where the moment there is a fraud indicator, the auditor needs to go for the professional skeptic. I need to extend my audit procedures here, that the moment there are indicators that could indicate possibilities of errors and frauds in a financial statement. And the third and most important one is critical assessment of my audit evidences. Is it sufficient? Is it appropriate? Is it relevant? And is it reliable or not? Like that, I need to keep on have this particular questions into my mind, and then I need to go and perform the audit understanding this particular relevance and significance here. Throughout the audit, the standards on auditing prescribes that throughout the audit process, the professional judgment and professional skepticism is to be maintained here. It is nothing but, in a normal colloquial term, having reasonable care and caution is what nothing but professional skepticism is. Because right from Kingston Cotton Mill case, where very old case law, the auditor is just a watchdog and not a bloodhound, what is expected from an auditor is to take reasonable care and caution. The moment the auditor is in a position to prove that I have taken all reasonable care and caution, irrespective of the fact that the auditor is unable to detect a material misstatement in the financial statement, he is free, no problem. But I need to prove that I have taken reasonable care and caution. In the context of standards on auditing, how I will be in a position to prove that I have taken reasonable care and caution? I need to be in a position to demonstrate these particular two factors, professional judgment and professional skepticism, has been rightly applied by the auditor throughout. If I have that particular audit working papers in line with SA 230, I shall be in a position to demonstrate, and no more further process to the auditor here. Here also, in the given case, wherever there are requirements where the auditor wants to go for a specific verification, because in the given case there is an unusual triggers with regard to the number, the auditor may very much go and visit that particular component and have access to the books and records also. The statute governing the entity may confer a right on the principal auditor to visit the component and examine the books of accounts and other records of the said component if he thinks it necessary to do so. Where another auditor has been appointed for the component, the principal auditor would normally be entitled to rely on the work of such other auditor unless there is a special circumstances to make it essential for him to visit the component and or to examine the books of accounts and other records of the said component. Under the Banking Regulation Act, the principal auditor has a statutory right to visit any branch and inspect his books of accounts. In the bank scenario, you have a Banking Regulation Act. Even in a normal Companies Act scenario, Companies Act gives that particular conferment here. Due to unusual increase in non-performing assets at Delhi branch, NPA, there is a complete shift in that. He decides, the statutory auditor, the principal auditor decides it essential to visit the branch and examine key records directly to ensure adequacy of the audit evidences. In normal circumstances, the principal auditor would have relied on the work of PQR, no problem. Because normally I am entitled to rely on the work by others, I can rely on it. But since there is a significant fluctuation where it raises the question of professional skepticism, the auditor may think, again it's based on the judgment of the auditor, based on the circumstances, the auditor is here thinking to go and have a specific verification, which is very much permitted here. After visiting the branch and reviewing the loan files, XYZ & Co. confirms that the audit findings were accurate and the working of PQR Associates was reliable. The principal auditor thus exercises a statutory right prudently and complies with SA 600 here. Also, in fact, with reporting as per SA 706. That's a very important point. We need to always consider that unless we report it under SA 706, the responsibility is not shifted. Wherever you are using the work of the other auditor as a component or as a branch, as a part of reporting under line with SA 706, we shall be in a position to disclose the facts also, which will better provide the users of the financial statement about audit, about auditor's responsibility, and also about the auditor's report here. With this, we conclude the first essay. Yes, madam. I would like to call upon our Central Council member to have a few words in this regard. Thank you. You are hearing from the right person, the right perspective. So, because what is exactly happening in SA 600 with regard to the international parlance and with regard to the NAFRA's push and ICA stance, you got from the exact apt person who is authoritative to provide this particular information. Excellent insights, and it's all news to us, ma'am. Thanks for the information that you are providing here. Shall we proceed? Yeah, yes, yes. Okay. Any specific queries or questions in essay 600? So that before going for the next one. 610, another beautiful essay with regard to using the work of internal auditor. And we will have a short commercial break before going for internal auditor's work. Thank you. We'll have a tea break. Thank you. Essay, which is a very simpler essay, not much of complications, where predominantly this essay will be a relevant essay and applicable essay. Unlike essay 600, only in case of a component financials are included, that will be relevant essay. But here, essay 610 with regard to using the work of an internal auditor, predominantly this is more useful and applicable standard here, where me as an internal auditor also can understand the responsibilities of mine because the statutory auditor is going to use. Again, from the statutory auditor's perspective also, how I may be in a position to use the work done by the internal auditors here. I'm not going to spend much time on SA 610 and SA 620 because these are all very regular and monotonous only. We will take up important aspects. We will focus more into SA 700, 705, 706, which is considered to be the face of the auditors, where there are a lot of outputs, a lot of analytical thoughts processes involved, and there are restrictions also with regard to the use of the wordings. We will be spending much time on 700, 705 and 706 is what my thought process here. Let us go and understand this as well. Let's say 610, which talks about using the work of an internal auditor. This essay is a revised standard, sir. Previously, the essay was different and this essay is different. Revised essay is different. There is one important change. As a statutory auditor, who is an independent personnel, can I take direct assistance of internal auditor? Because internal auditor is always part of the management. Internal auditor is appointed by the management for the purpose of management, for the betterment of management, to evaluate internal controls. That is not the case of a statutory auditor. I am an independent personnel to express an independent opinion on the financial statements of the company. If that being the case, being a statutory auditor, can I take direct assistance of internal auditor? If so, will it be prejudices? Because my independence could be compromised. He is a management person, technically speaking, irrespective of the fact that internal auditor could be an external audit firm. Still, internal auditor is always considered to be part of the management only. So in that particular case, can I take direct assistance of internal auditor? Can I use the work done by internal auditor? Assuming if I take direct assistance of the internal auditor, who will be responsible? I'll give a scenario. Fixed assets are to be verified, sir. As a statutory auditor, as a part of my audit process, I need to verify the fixed assets. I don't have such people to verify fixed assets. I don't have article assistant. Today, article assistant getting by itself is a great task. That's a separate session that is to be discussed upon. So, where the internal auditor is having a battalion of team. So, can I ask the internal auditor, sir, on behalf of me, you give me 5 articles or 5 team member, so that I will ensure this particular verification process is taken care. Whether can I take the direct assistance of internal auditor? This is point number 1. Point number 2, internal auditor has already verified one area. Can I rely on that particular area? Say for example, a simple example of a BRS, bank verification. BRS process is as a part of the internal audit process. Every month the internal auditor comes and meticulously verifies 100% of the BRS entries, and he is satisfied, gives a report to the management. Can I rely on that particular work, or should I need to go for a rework of that particular area? If I rely, then who will be responsible? So these both aspects are discussed exclusively in this particular essay in the context of revised essay 610, sir. Let us go and understand what is this particular essay 610 talks about. Says essay 610 revised, issued by ICA, addresses the external auditor's responsibilities when using the work of internal audit function during the audit of financial statements. When you very carefully watch, previous essay 600 uses the term principal auditor, component auditor. Now this essay 610 uses the term external auditor, internal auditor. All are auditor only. We are talking from the principal or statutory auditor's perspective only, because standards on auditing are written only in the context of statutory auditor. But in order to differentiate and give the significance and importance of the people we are discussing about, each essay very rightly addresses the term accordingly. Here the principal auditor, previously the principal auditor so called, in this essay he becomes an external auditor. External auditor nothing but a statutory auditor of the company is what external auditor. Internal auditor is nothing but the, as the name denotes, is the internal auditor here. Whether can I use the work done by internal auditor? It requires the external auditor to evaluate the objectivity, competency and the systematic approach of the internal auditors to determine the extent of reliance that can be placed on their work. Can I first of all rely? In order to evaluate this, the objectivity, competency and the approach of the internal auditor, which is equally applicable in the previous case also, systematically evaluate the competency of the other person and then rely, similar to that of SA 600. SA 610 also gives that particular point, where we need to take a clue and help of one another essay, the SA 315. Sir, SA 315, many speakers will be talking about SA 315. In all essays, this SA 315 will have an effect, because SA 315 is like a spinal cord. Like for the entire body, spinal cord is the pivotal one. Similarly, for all the standards on auditing, SA 315 is the pivotal one. It talks about the responsibilities of the auditor to identify and assess the risk of material misstatement by understanding the entity and its environment, including its internal control. So as a part of the audit process, the statutory auditor evaluates the internal controls of the organization. I want your core understanding and attention here. I am a statutory auditor. Should I need to evaluate the internal controls of the company? Is it necessary? As a statutory auditor, I am not going to talk about internal controls. I am not going to express an opinion on the internal controls of the organization. Even internal financial reporting, where I need to go for it, I am not going to comment on the internal controls of the entity. I am going to comment only on the internal financial controls of the with reference to financial statements only. So being a statutory auditor, should I need to verify internal controls, or it is absolutely the role of the internal auditor for that matter? I need to go and refer SA 315, which categorically insists upon being the statutory auditor, in spite of the fact that you are going to express an opinion on the financial statement, internal control evaluation has to be done by the auditor, statutory auditor. I cannot say I am a statutory auditor, I am not an internal auditor, I need not look at the internal controls of the organization. No, not possible. You need to verify. SA 315 says how internal controls can be evaluation, can be done, 5 components of internal controls, how it is to be evaluated, like that. It talks about very precisely on the statutory auditor's responsibility about internal controls. Here, internal auditor who exclusively works on the internal controls and its improvements and to identify weaknesses in the internal controls, the statutory auditor can very much rely on the work done by internal controls, provided I need to evaluate the competency of internal auditor here. Whether internal auditor is objective, is he independent, is he systematically plays his verification process, what is the scope of the internal auditor to evaluate, like that. I need to go and evaluate the competency, objectivity and approach of the internal auditor also. Please understand, whether internal auditor should be independent, whether internal auditor's independence is having an effect on the statutory auditor, how to evaluate the independence of the internal auditor. Are you all with me? Because unlike a statutory auditor, the Companies Act doesn't prescribe the qualification or a restriction with regard to the internal auditor. You need not hold shares, you are a key managerial personnel, you should not be a relative of a key managerial personnel, you should not have business relationship with the company, like that. There is no such prescription for the internal auditor. So how to evaluate internal auditor's independence? In this case, please understand, practically, even my internal department can be my internal auditor. Say, for example, a large manufacturing company, they have 10 people who may be headed by a chartered accountant, you are internal audit team, you verify. Like that, there will be a process. Then what is the possibility of independence there? You are absolutely part and parcel of management. You are employee of the company. How come I may say that you are an independent? Please understand the concept of independence with regard to internal audit vis-a-vis the statutory audit. It is different. With regard to the internal controls and internal auditors' independence is concerned, to whom the internal auditor is reporting is a parameter to evaluate about his independence. Whether the internal auditor is reporting to the general manager, whether the internal auditor is reporting to the CFO of the company, whether the internal auditor is reporting to the audit committee chairman of the company, in which 3 scenarios you feel independence of the internal auditor is high? Case 1, case 2, case 3. Which case you say it is high? Case? Obviously, yes, case 3. Because instead of me reporting to the manager, general manager, instead of internal auditor reporting to the CFO of the company, when the internal auditor goes and directly report to the audit committee or audit committee chairman or the appropriate those charged with governance, the independence is high. The independence should be evaluated on that particular basis, while statutory auditor evaluating the objectivity and the competency of the internal auditor should also consider the independence of the internal auditor, whereby I may very much place reliance of the work done by internal auditor. No problem. Also, very importantly, the statutory auditor can take direct assistance of the internal auditor. No problem. This was a change when you compare with pre-revised SA 610 and post-revision of SA 610. As per revised SA 610, I have given an example of a statutory auditor verifying a fixed asset. I don't have team members. I am calling a team from internal auditor and then ask him to do the verification. Can I do that verification or not? The answer is yes, as per revised SA 610. However, it should be under direct supervision of the statutory auditor. I shall be solely responsible for that particular work done. I cannot escape my responsibility tomorrow, assuming that I take the help of the internal auditor to do the verification, and then I have certified the financial statement. Tomorrow there is a material misstatement in the fixed asset. Then at that point in time, I cannot say, no, I have not verified, sir. It is the internal auditor who has verified. Like that, there is no shifting out responsibility shall be possible here. The statutory auditor shall be solely responsible for that work as well. However, whenever I am going to take the direct assistance of the internal auditors or the internal audit team, then I need to go and direct, supervise and take up the responsibility of that particular work. It will be the responsibility of the statutory auditor only. So the standard also guides the auditor in deciding whether and how the internal auditors can provide direct assistance under supervision. There is one another important point. When I take the direct assistance and supervision of the internal auditor, the work done by internal auditor is part and parcel of the statutory auditor for that particular activity, and it becomes my working papers. Please remember this particular fact. There is a difference given by SA 610. Assuming in a remote possible case where I take the direct assistance of internal auditor, on behalf of me, internal auditor goes and verifies that working papers will become part of my working papers. It will be the statutory auditor's working papers. I will be solely responsible for the work done by the internal auditors. The moment we think of internal controls or internal audit, immediately there are essays that is to come into our mind, sir. Essay 315 that talks about internal controls. You have something called as audit risk. The possibility of auditor going wrong is absolutely basing off risk of material misstatement and deduction risk. The moment you think of risk of material misstatement, you need to think of inherent risk and control risk. The control risk is nothing but internal controls evaluation. Immediately our mind should work on it. Not only that, there is also a specific CARO reporting responsibility, CARO. I have also contributed to the guidance note on CARO. That's what introduced. It was a CARO book is what that they have introduced, but it is nothing but a CARO book where I have also contributed a little bit, where there is a specific question to the statutory auditor of the company, whether you have, whether internal audit reports have been provided to you. Have you considered in your nature, timing and extent of audit procedures about the internal auditor's findings, whether your audit workings has been amended in such a way to categorize or to accommodate that particular workings also like that. There are questions to be reported by the auditor in CARO as well. So it ensures the coordination between the internal and external auditors, enhances audit efficiency without compromising audit quality. Despite using the internal auditor's work, the external auditors retains sole responsibility of the audit opinion. Never, ever I can shift the responsibility. Always it is the responsibility of the statutory auditor to express an opinion, and I shall remain for that particular work here. There is also a beautiful implementation guide that is issued by WASB. See, please remember, whenever you have standards on auditing are so easy. They are all guiding factors. They are all hand-holding activities for me to comply my audit in an appropriate manner. The standards on auditing is like this. You have a main paragraph of standards, and you have a paragraph, application paragraph, giving examples of that particular situation that is discussed in the main paragraph, like accounting standards. And also you have certain standards, you have implementation guides. Predominantly, the institute is making in such a way that implementation guides are in an FAQ format. So when, what, why, how, whom, like that, it will ask the question and then it will provide the answers also. Just it will take half an hour for every one of us to go through the standard, go through the application part of it, and also to go through the implementation guide to that particular standard. Whenever you say, for example, you travel and then in an airport you sit for half an hour, just you take this particular one standard, it will be complete, and you will have an enriched knowledge the moment you have a control over the standard and its contents here. So the suggestion is, wherever possible, the implementation guides will give a very lucid impact to you to understand that particular standards, including the practical nuances here. The crux of SA 610 goes like this. SA 610 deals with the responsibilities of the external auditor on using the internal audit work and direct assistance in audits. Yes, it is possible. It applies only if the entity has internal audit function and such internal audit is relevant to the audit, or if based on the work performed under SA 315, the auditor does not expect to use the work of the IA function. Say, so I need to evaluate whether can I use the IA work. Say for example, internal audit work is nothing to do with the statutory audit or financial statements, then I cannot use the work done by the internal auditor at all. Assuming in a case in a manufacturing entity, the internal auditor is appointed to focus only on the operations of that particular company. Nothing to do with the financial statement part. Whether goods have been received properly, whether goods have been utilized properly, whether goods have been manufactured properly. This is what your job and scope. When that is being given, I may not be in a position to use the work done by the internal auditor for financial statement purpose. But for control verification, I may be still in a position to use. So I need to evaluate whether internal auditor is first of all competent enough so that can I rely on the work. Very, very interestingly, that if you see, Companies Act section 138 of the Companies Act talks about to whom internal audit is first of all applicable. Internal audit is a voluntary activity, first point. It is a management activity, second point. It is now moving towards a risk-based internal audit as an analysis rather than a traditional internal audit working. Now, Companies Act 138 mandated that for these companies, mandatorily you need to have an internal audit, like listed entity is one of the case where you need to have internal audit mandatory here. Again, to whom I can be appointing as an internal auditor. Section 138 of the Companies Act says a statutory chartered accountant holding certificate of practice, a cost accountant, or such other professional as may be decided by the board of directors. So the board of directors are having complete control to appoint anyone who is having competency in that particular company or in that area of operations can be appointed as an internal auditor. Need not be a chartered accountant only. So if that being the case, the competency has to be evaluated by the statutory auditor, whether can I use that particular internal auditor's work into my audit evidence or not, should be evaluated, and objectivity also to be evaluated here. Before using the internal audit work, assess the objectivity, competency and the systematic approach of the function. External auditor not to use internal audit work if objectivity, competency or disciplined approach is inadequate in that particular case. I can ignore that internal audit. Sir, if internal audit is ignored, what I need to do? I need to necessarily extend my audit procedures to evaluate the internal controls of the organization. If the controls are weak, I need to go for an extended audit process in line with SA 260 and 265. Sir, what is this? New essays are getting introduced. 260 and 265 would have already been discussed yesterday, where there are deficiencies in the internal controls, where there are difficulties that are faced by the auditor with regard to the verification. I need to be in a position to communicate to those charged with governance and management. 265 is more relevant here because if at all there are deficiencies in internal controls. The moment there are deficiencies in internal control, how it is going to affect the auditor? Because the moment there are deficiencies in internal controls, more possibilities of errors and frauds could happen. Because of more frauds and errors, more possibility of misstatements, more possibility of material misstatements, more possibility of financial statements containing material misstatements may be undetected by the auditor. It increases my audit risk. So please understand, every aspect is having a chain effect for an auditor. The ultimate outcome is to go and express an appropriate audit opinion. I need to be carefully evaluating what are all the areas that I may go wrong, so that I need to make provisions accordingly in such a way to protect myself here. Internal auditors can assist only under external auditors' direction, supervision and review if law permits. In India, there is no law that prohibits internal auditors' work. So I may very much use the work of an internal auditor as well. The IA function cannot be involved in aspects that they have specifically dealt in their function, wherever there are self-review threats. Yes. Even though I told you some time back that I can use the direct assistance of internal audit, however, there are certain small carve-outs. I cannot use the internal audit function for everything whatever I feel. Wherever there are high risk, wherever there are high judgmental aspects that are involved, wherever there are possibility of high risk of material misstatements, wherever the internal auditor himself have done that particular activity, in those areas, I should not operate with the internal auditor as a part of my engagement team. No, that it is prohibited, because SA 610 specifically prohibits that you, in those areas, you cannot use the work of internal auditor like that. There is a prohibition here. The key aspects in this context are the extent of organization status and policies and procedures which can help support the objectivity of the function, level of competency of the function, internal audit function, whether the IA function has a systematic and disciplined approach including quality control here. Use less internal audit work where judgment or risk of material misstatement is high. Internal auditors cannot perform tasks involving significant judgment or high risk areas. As I told you just now, it cannot be done. They can perform. I cannot ask the internal auditor to perform on behalf of me. That's the point that we need to take it up. The auditor must document evaluations, decisions, agreements and review the details when using the work of an internal auditor or direct assistance. Planned use of internal audit work or direct assistance must be communicated to those charged with governance. Yes, again, I need to communicate to those charged with governance that I am going to rely on the work done by the internal auditors, or I am going to take direct assistance of the internal auditors because they are part of a management team here. There are references to the internal audit in the following context. Section 138 of the Companies Act regarding mandatory internal audit for certain class of cases, and assessment of internal audit function in CARO reporting. CARO reporting, very importantly, the guidance note suggests that even though the statutory auditor does not provide with all the recent internal audit reports, at least even for a draft reports that you need to be in a position to evaluate. Many a times, the internal audit reports will be an eye-opener for the statutory auditor to verify a particular aspect. Because internal auditor is considered to be more close with a particular company, he is having a lot of transactions to verify. So he may be access and he may spend much time to verify details in depth when you compare with the statutory auditor. So many a times statutory auditor may use this as an input. Internal audit reports can be at times speaking report which talks about what is the issue and what is the recommendation, what is the management's call on it, what is the time for your rectification, like that. There are speaking reports that are available. Based on it, the statutory auditor can decide his audit procedures also here. SA 315's context is considered to be very, very relevant. This is what 138 of the Companies Act says, to whom internal audit is mandatory. There is a question in Caro, whether are the companies having internal audit commensurate with the size and nature of the operations here. So for all listed companies, internal audit is mandatory. For other companies with specified companies, they need to have internal audit. Sir, I am not a listed company, I am a public company. Whether for me internal audit is mandatory? Answer is yes, if these numbers are there. Say for example, my paid up share capital of 50 crores or more, my turnover of rupees 200 crores or more, our outstanding loans and borrowings from banks or public financial institutions of 100 crores or more at any point in time, exceeding 100 crores. It's not 100 crores or more, it is exceeding 100 crores, and outstanding deposits of 25 crores or more at any point of time during the preceding financial year. Then if any one of the condition is met, it is all R condition. It is not and condition, it is R condition. Any one condition is being met for that particular company, for that year, internal audit is mandatory. Either a cost accountant or a chartered accountant or such other professional as decided by the board of directors, she needs to be appointed as an internal auditor, specifying the scope and verification methodology here. The same provisions are equally applicable for a private limited companies also. That is the second point and third point will be covering for a private limited company to have an internal audit mandatory here. Otherwise also voluntarily internal audit can be appointed for the internal control purposes, and for better governance and corporate governance purposes, internal audit can be appointed by the management here. There are certain classroom, there are discussions here. XYZ company was appointed as statutory auditor of ABC Limited. During planning, the team decided to involve the internal audit function for certain procedures. A junior team member assumed that the responsibility for such areas would be that of the internal auditors. This led to a discussion within the audit team about the roles and accountability. So whenever internal auditors' work are used by the statutory auditor for the audit opinion, it will be the statutory auditor's responsibility and not that of the internal auditor. I can relay the work done by them. If I feel that the internal audit is effective, I may reduce the area of verification. I may reduce the extent of verification over there. However, the statutory auditor will be responsible for this particular activity here. Lack of sufficient competency. DEF Limited, a mid-sized manufacturing company, engaged GHA & Co. as their statutory auditors. During the audit planning phase, GHA & Co. considered utilizing the internal audit team for the direct assistance in performing substantive audit procedures. However, upon reviewing the qualifications of the internal auditors, it was noted that the internal auditor held a bachelor's degree in arts with no additional professional certification or specialized training or relevant experience in auditing or accounting. In such a case, I need to evaluate the competency. If I feel that the competency is not appropriate to do the extent of verification, I may not be in a position to use. I need to go for an alternative audit procedures to evaluate in such a scenario here. Given that internal auditor in question lacked advanced qualification or specialized training, GHA & Co. determined that the internal auditor did not possess sufficient competency to perform the proposed audit procedures. GHA & Co. decided not to use the work of internal auditor for direct assistance. This is the appropriate manner here. I need to document all this. I need to identify, see, this has been done and it has been taken care, but the auditor has to document what is the area that is proposed to be verified by the internal auditor, what is the competency of the internal auditor, why I have concluded not to use the work done by internal auditor, like that. I need to document so that it takes care of my SA 610 compliance here. Direct assistance by internal auditors. During the audit of T Limited, the external audit team considered delegating parts of the testing on financial controls to the company's internal audit department. However, when it came to areas requiring significant professional judgment, such as evaluating complex accounting estimates and assessing unusual transactions, the engagement partner had a doubt whether internal auditors should be involved. Can we involve? See, I want to evaluate with the help of internal auditor to do the financial aspect verification, but there are areas which involves complex accounting process. There are areas which involves complex judgments. Can I use the internal auditor to do the verification on my behalf or not? No, it is prohibited, as we discussed some time back, where there are certain restrictions that cannot be used by the internal auditors area. In this area also, the auditor cannot use the work of internal auditor here. Formal agreement before using the internal auditors for direct assistance. This is very essential. Whenever I am feeling that I can use the work done by the internal auditor or to take a direct assistance of the internal auditor, I need to have a formal writing between the internal audit team and the statutory audit team with regard to the use, scope, and the responsibility, including sharing of the working papers and all, needs to be very properly communicated so that there is no confusion or ambiguity in this particular regard. J&Co statutory auditors of MNO Private Limited decided to involve internal auditors for direct assistance during the audit. However, in the interest of time, the engagement team proceeded without formally obtaining written agreement from the company regarding the scope and independence of the internal auditor's role. So here in this case, J&Co failed to comply with SA 610 by not securing written agreement from the entity. The oversight compromised the independence and authority structure of the audit process, potentially exposing the firm to professional and regulatory consequences. The matter was later flagged during quality review also. So I need to go with our appropriate terms of engagement. Any places where I am going to use the work of others, including experts and internal auditors, there should be an appropriate communication and terms of agreement whenever I am going to use the direct assistance of internal audit. On the other hand, when the internal audit reports are going to be given to me like arrow and then I need to go for reporting, no specific requirement. Whenever there is a direct assistance to be used, I need to have a formal agreement so as to have remove the confusions in this regard. That's it with regard to this essay here. Any specific questions, sir? Super. We'll move on to the next essay, another simple essay here, essay 620. Using the work of auditors expert. So 600, 610, 620, all are using the work of others. Essay 610 with regard to component principal auditor, essay 610 with regard to statutory auditor, internal auditor. Now here we are going to talk about an auditor's expert. Sir, this particular essay should be read in line with essay 500, sir. Why? Because essay 500 talks about audit evidence, that is the base essay for all audit evidences that we are going to talk about, where they specifically mention about management's expert. Who is a management's expert? Expert is a person or an entity which is having special knowledge in areas other than accounting or auditing. This particular word is very, very, very important. They are having technical expertise in areas other than accounting or auditing. If at all they have specialized in areas in accounting or auditing, they are called chartered accountants. They need not be called as an experts here. They are always experts. So no problem that. So anyone who is a person who is having technical knowledge in areas other than accounting or auditing, then that person in the context of audit is called as an expert. If that expert's work is used by the management in preparing the financial statements or a component in the financial statement or an item in the financial statement, then that particular expert will be called as a management's expert. On the other hand, when such a sort of expert is used by the auditor to verify a particular statement provided by the management or to provide an assurance or provide to assertion or to validate a particular assertion, if the work is used by the auditor, then that particular expert will be called as an auditor's expert. Where it cannot be same, cannot be one person. He is a actuary, cannot be a management's expert as well as auditor's expert in a particular context. The point is, there are people, say for example a valuation engineer, a valuer or an actuary, or there are many technical, including legal professionals will be treated as an experts in this particular case. There are different thoughts that we need to understand. When the management uses management's expert, whether necessarily auditor should also use auditor's expert? Need not be. I can rely on I can again, as per SA 500, evaluate the competency, objectivity of the management's expert and then rely as an audit evidence and then proceed further. Possible. Even though management doesn't use the management's expert, if the auditor wants to evaluate a complex item with the help of an auditor's expert, yes, that is also possible. So, these two are mutually independent here. Because management uses the management's expert, auditor should use auditor's expert, like that. There is no precondition. If I want, I can very much use wherever there are complexities that are involved in the case of an audit here. Please understand SA 620 to be read in line with, to understand with something called as inherent risk. Where there is an inherent risk in an audit report, sir, in an audit for that matter. There are three types of risk: inherent risk, control risk and deduction risk. Inherent risk is inbuilt in the operations of the entity. Even without knowing to the management, there could be possibility of material misstatements in the financial statements. You are all with me? Yes. Inherent risk are risks that are even without the knowledge of the management, possibility of misstatements. Say for example, I am Tata Salt, Tata Chemicals, where I have manufacturing salt. I am auditor of one another company, Reynolds Pen. So I am auditor of two entities. Reynolds Pen, they have 1,000 number of closing stock of pen, ballpoint pen, 1,000 numbers. As a part of inventory verification, being an auditor, will I be in a position to verify 1,000 numbers of inventory? Possible or not possible? Very much possible. Sir, 100 pens you put one bundle. So 10 bundles will be there, 1,000 numbers of pen is there, verified, done. Quantity verification over. Valuation, sir, my cost of production is equal to 10 rupees, my market price is 20 rupees. So cost or net realizable value, whichever is lower, I will go for valuation. 10 into 100,000, I will go for the inventory valuation. Tick, no problem. Inventory valuation in the case of Reynolds pen is such a simple activity, done over. On the other hand, I am auditor of Tata Chemicals, which is doing salt manufacturing, where I want to verify the inventory of salt. They have inventory of salt into two manners. One is 1 kg packed item, and the other one is the salt that is heaped in the salt pan. In Dwaraka, they have a huge salt works that they have in a salt pan. In there, the 1 kg packed item, they may have precision. How many number of packets, what is the weight of that particular inventory. They can precision, they can say, and then I am satisfied. With regard to the quantity of inventory which is there lying at the salt pan, will the management be in a position to give a precise number of the closing stock? They may use only estimation methods. This many number of heaps are there, each heap is equal to 1 ton. On what basis? The height, width, breadth. This is what the historically 1 ton will be there. So I have 1,000 heaps, so 1,000 tons of salt, like that. They go with an estimation. They go based on judgmental. They go based on past historical data. Wherever there are possibilities of high complexity involving estimates, judgments, assumptions, there is a high possibility of material misstatement due to their inherent risk. Management by itself may not know that there is a problem with inventory valuation. They would have valued higher, or there would be a lower valuation could be there. Material misstatements because of their complexity involved. Do you agree with me or not? So in that particular case, the inventory valuation is an inherent risk for the management, where SA 540, today morning we had a discussion with regard to assessment of estimates, how it is to be done to be taken care, and also the auditor needs to use the work of an auditor's expert if required. So I may even take an expert who is an expert in that particular salt inventory valuation, an engineer or such a technically qualified and competent person to go for estimation, and then who may confirm that particular estimation is more or less appropriate, like that. Nobody can give a precise number, accuracy cannot be given, but whether is it reasonable or not can be substantiated by the expert here. Wherever required, I may use the work of an auditor's expert. Let us go for this particular essay in line with this particular basic understanding. SA 620 issued by ICAI deals with the auditor's responsibility when using the work of an expert in field other than accounting or auditing, because expert definition by itself as per SA gives like that. The auditor shall evaluate the competency, capability and objectivity of the expert. When you think of SA 600, 610, 620, in all these three particular essays, you may see these technical words: objectivity, competency, capability, and all shall be verified. In component auditor, I shall evaluate. In internal auditor, I shall evaluate. In auditor's expert also, I shall evaluate here. The auditor shall also obtain an understanding of the expert's field of expertise. Adequacy of expert's work must be evaluated in the context of relevant assertions. This is considered to be most important point. I am the auditor of Joy Alucas. I want to verify the inventory. They have gold, they have diamonds. As a person who knows only debit and credit, I may not be in a position to differentiate between a glittering stone and a diamond. Do you agree with me or not? I am not. You may be, yes. But there are technical competencies that is required to evaluate whether it is a gold or it's a diamond or it's just a normal white stone. In order to evaluate, I may require an expert who is having expertise knowledge in evaluating, sir, this is diamond only. No, this is glittering stone, like that he can throw away. So in that particular areas, who is having expertise in areas other than accounting or auditing, I may very much rely on their particular work. Especially, I need to understand the work or the basis with which the work has been done by the auditor's expert. Please understand, even though I am not technically competent enough, even though that is not my domain area, but still, as per standards on auditing, I need to have the gross understanding of the manner with which the accounting is or the process is done by that expert. Say for example, an actuarial valuation. My gratuity liability is to be provided by an actuarial valuation. There is an actuary who comes and does this activity, and then he says this is the number, 5 crores is what the provision to be made for gratuity provision, like that. He gives the number. As a statutory auditor, can I close my eyes and then say 5 crores? If at all there is a material misstatement, it is the actuary's responsibility. Like that, can I close? Answer is no. Answer is no. The point that is to be driven here is, being a statutory auditor, I need to understand the gross working that is on the basis with which the actuary, the expert has worked out. Say for example, the data with which the actuary has worked out, the assumption that is made by the actuary, like that I need to evaluate a gross understanding. In spite of the fact I may not be technically aware, but I need to have a gross understanding. I need to have it as an evidence, is what the provision given by SA 620. There is one general clarification given by WASB. There are two general clarifications totally given. One is on account of SA 210 with regard to agreeing the terms of engagement, and the other one is with regard to SA 620 with regard to evaluating grossly about how the work done by an expert by the statutory auditor is what given here. So as a statutory auditor, the point that I am driving here home is, in spite of the fact that you are using a technically competent person, I cannot simply close my eyes and then follow whatever he said. I need to go for a gross understanding of the work done by that person, and then still I can rely on the work done by the other person here. The auditor's expert work does not reduce the auditor's responsibility for the auditor's opinion. Documentation must include the evaluation and conclusions drawn from this here. The auditor decides whether expertise outside accounting or auditing is required to obtain a sufficient appropriate audit evidence also. See, even without auditor's expert also, the auditor can proceed, no problem. However, if there are complex aspects are involved, the auditor may decide that to use the work of an auditor's expert. It is again based on the judgment of the auditor and complexity of the issue involved here. Even when an expert's work is used, the auditor alone remains responsible for the audit opinion. Auditor must evaluate the expert's competency, capability and objectivity before relying on their work. Auditor determines nature, timing and extent of procedures based on significance, complexity and risk of that particular matter. Auditor must obtain a sufficient understanding of the expert's field. See, I need to understand how that particular expert has worked in that particular field to evaluate their work appropriately here. Auditor must agree in writing, evaluate the reasonableness and relevance of the expert's finding, review the assumptions, methods, model and source data with which the expert has worked. All these are all basic points to be covered as per whenever I am using the work of an auditor's expert. Even when management uses the management's expert, auditor has to evaluate these particular things here as per SA 500. If the expert's work is not adequate, it's a beautiful case. When the expert work is not adequate, the auditor must seek further work or perform additional audit procedures here. Because of the fact that the auditor's expert work is not adequate, I need to go for modification in audit opinion. No, it cannot be. Unless I am really satisfied that there are material misstatements, I cannot go and provide a modified opinion here. Auditor shall not refer to the experts in an unmodified report unless law requires. If referenced in a modified opinion, clarify the responsibility is not reduced here. See, please understand the difference between SA 600 and SA 620. SA 600, I rely the work done by the component auditor. As per SA 706 paragraph, other matter paragraph, I rely on the work done by the component auditor. That cannot be the case of an auditor's expert. You cannot give a separate paragraph saying that I have relied on the work done by expert, so I am not responsible, he will be responsible. Like that, I cannot shift my responsibility. I cannot give that particular information here. It is part and parcel of my working paper. I will be remaining responsible for the audit opinion that is ultimately provided in the financial statements here. With this, I close SA 620 here because we will proceed further with regard to 700 series. Any specific case or any doubts with regard to SA 620, sir? Super. Yes, sir. 700 series is a beautiful one, sir. SA starting with SA 700. Yes, sir. I cannot disclose. Correct. As a part of my working paper, I may have it, but as a part of disclosure to the users that I use the work of this expert, like that, I cannot disclose it, sir. Correct. You are right. Because SA 620 specifically prohibits that particular disclosure here. It's a part and parcel of my own work. That's why it is not permitting you. Sir, beautiful SA 700. The face of auditor is SA 700. The outcome, the output, the product that is released by the auditor is 700. Everything is revolving around 700 only. Because that's the one which speaks with the person with whom I have been appointed. SA 700 is the only speaking methodology the auditor can convey to the users of the finance statement. 700 is considered to be a very, very effective and very, very important tool for the auditor that is available to him. I need to necessarily comply with SA 700 and 700 only. I don't have any other alternative to go for a choice. I don't have any other alternative to go for a via media to deviate with 700. Nothing doing. Squarely, I need to comply with SA 700. Forming an opinion, reporting on the financial statements. First of all, I need to form an opinion on the financial statements. Thereby, I need to express an opinion on the financial statements on the specified manner. SA 700 very categorically talks about the manner, the methodology, the format with which the audit report is to be given here. I cannot change the order even. I need to give the same. Sir, I am not going to do an audit of a company. I am going to do an audit of an NGO, whether my SA 700 is to be followed or not. I am going to do a tax audit of a partnership firm. I am going to do a tax audit of an individual, whether SA 700 to be followed or not. Because SA 700, there is something like title, addressee, opinion, basis of opinion, management's responsibility, auditor's responsibility, like that, a list of items are there. I am going to do an audit of an individual, sir. Why I need to give all this? One person is going to deal this particular report. For the purpose of some complaints, I need to give this. Whether should I need to give this? Answer is yes, yes, yes. Because the underlying thumb rule is whenever there is an audit of financial statement is to be done by an auditor. Audit of financial statements, standards on auditing is mandatory. No other choice. Irrespective of the size and nature and complexities involved in that particular auditee, whether it is an individual, partnership firm, HUF, company, private, public, listed, unlisted, statutory, or charitable, whomsoever it may be. The moment audit of financial statement is involved, the auditor who is going to do that particular audit has to comply with standards on auditing and has to give his report only as per SA 700, which talks about the format also. Sir, if you say like that, tax audit case, my audit report format is prescribed by the Income Tax Act, Form 3CA, Form 3CB. It doesn't contain opinion paragraph or auditor's responsibility, management's responsibility, basis of opinion, like that. They give a particular format with which only I need to update. Then should I need to refer this essay how it is to be done? When essay by itself addresses this particular question, when the audit report is prescribed by law or a regulation, what I need to do? If I give and comply with that particular law or regulation, will it be tantamounting to non-compliance of SA 700? Answer is yes. Answer is yes. That's the conflict. Sir, please understand, in spite of the fact that a statutory regulation wants an audit report in a prescribed manner, you may give that. However, you need to also give in SA 700 format. That is what the prescription given by the council also with regard to SA 700 compliance. Because I cannot go and change the Income Tax Act now. You give as per your audit report, whatever the report format with which that is given for the purpose of uploading and thing. But as a separate one, you need to go and comply with standards. You give the audit report in this particular fashion, communicate to the management, and also get in the agreeing the terms itself, you put a particular clause for the purpose of reporting, I will be uploading the fact. However, for the purpose of this particular SA complaints, I shall be giving the report in this fashion. Like that, I need to go and provide it so that I comply with standards on auditing always. So this is a key catch that we need to remember and understand this particular essay. Let us go and understand this essay. See, the timings that is given for 9 essays is just a 3-hour time, which is absolutely not possible. What we are trying to do is creating an interest and discussing the core key aspects of that particular essay. I earnestly urge you for going back and then reading this particular essay, so that there are a lot of other inputs that you may have it, so that it can be implemented while you are day-to-day practice here. Let us go and take the key provisions relating to SA 700. If you give me SA 700 alone, 3 hours I can speak, because that's that volume, that importance of this particular essay here. Let us go for this. SA 700 revised issued by ICA deals with the auditor's responsibility to form an opinion. That's very, very, very important. I need to first of all form an opinion. Without me forming an opinion, I cannot express an opinion. Sir, I am a person. I need to say about this boy, whether he is a good boy or bad boy. On what basis I will say he is a good boy or bad boy? First of all, I need to form an opinion about this personality. I need to convince myself, then only I can communicate about the other person, about this person to other party. Myself doesn't have any information. Without having sufficient appropriate information to form an opinion, I cannot express an opinion about the person. Similarly, with regard to a financial statement, in order to form an opinion on the financial statement, I need to obtain sufficient appropriate audit evidence. That should enable me to form an opinion. Based on me forming an opinion, I need to conclude this is the opinion that I need to have it, and accordingly I need to express that opinion by way of an auditor's report, which is a specified format. Usually, SA 700 audit format, people used to criticize that it is a template based reporting. Every company, same reporting that is being done. Why? Sir, it is not a template based reporting, it is consistency in reporting, standardization in reporting. Whether it is a small company, whether it is a big company, whether it is a listed company, the reporting formatting is going to be the same. It is nothing but the consistency and standardization rather than template based reporting here. It is not template based, it is a standardization that makes. Why every mobile charger is having a C type, B type? Why it is to give different mobile company different types of charges that they are going for? They want a standardization. Where a pen drive, it is a standardization that is happening, so that any pen drive you can use it in any laptop. It is not this particular pen drive can be used only in that particular laptop like that. It is all standardization that happens. Even in audit reporting there is a standardization. That's why we have this particular formatting also. The financial statement prescribes the basic format and elements of the auditor's report. The opinion shall be based on the evaluation of conclusions drawn from the sufficient appropriate audit evidence. The auditor report shall be in writing and express a clear opinion in the financial statement. It includes title, addressee, opinion section, basis of opinion section, and other prescribed elements here, including key audit matter, other information, report on legal and regulatory requirements like that. There are multiple points to be included here. The report must be dated no earlier than the date of which the auditor has obtained sufficient appropriate audit evidence. The date shall not be earlier than the date of approval of the financial statements by those charged with governance. That's the sequence with which the audit report is to be given. It is to be approved by the board, then only audit can be taken up and then audit report can be given. It's not prior to that approval of the board here. That's a very common and important point to be noted. Another important aspect is whether the audit report I am giving as per SS 700, should I need to consider all the events up to the date of audit report, or should I need to consider as of 31st March? Because I am going to sign the financial statement as of 31st March. This is what the position of 31st March. I am signing the audit report on 31st May. Should I need to consider the events that are happening between April and May? Because 31st March is what the financial statement date is. Should I need to stop with 31st March, or should I need to conclude and continue the events that are happening even up to 31st May is what the question. Answer is SA 700. You cannot go for SA 560. Today morning we have discussed about SA 560, about subsequent events. That's different. Here, up to the date of audit report, whatever the events that are coming to the attention of the auditor needs to consider the same, the effect of that same in the audit report, and then the auditor has to report accordingly. Up to the date of audit report, whatever the events that are happening, the auditor has to consider. That is what the SA 700's prescription. I cannot say, no, I am signing as on 31st March only. Up to 31st March only I will consider like that. Auditor cannot say so. SA 700 by itself imposes that responsibility to do for up to the date of audit report here. The objective is to enhance the consistency and clarity in the auditor's report for the intended users. There are two types of reporting that is possible, sir. One is a fair presentation framework and the other one is a compliance framework. This is a little bit of a technical one. What do you mean by fair presentation framework? What do you mean by compliance framework? Sir, the fair presentation framework is nothing but where the management explicitly acknowledge their duties with regard to the financial statements and their preparation and compliance of the financial reporting framework. Are you all with me? Yes? There is something called as financial reporting framework. Sir, what do you mean by financial reporting framework? We need to understand the terms. It is very important in context of SA 700 related with SA 705. What do you mean by financial reporting framework? Financial reporting framework will be changing from entity to entity. It is not common. It is not uniform. It will be changing from entity to entity. Usually, financial reporting framework comprising of the accounting standards or Ind AS as the case may be, the generally accepted accounting principles and practices, relevant statutory requirements including Schedule 3 requirements wherever applicable. This is what usually FRF comprising of Financial Reporting Framework. Accounting standards are Ind AS, generally accepted accounting principles and procedures, relevant statutory requirements including Schedule 3 requirements. This will be changing from entity to entity as I told you. Say for example, I am a listed entity, then Ind AS will be applicable, generally accepted accounting principles and practices will be applicable, my Companies Act Schedule 3 will be applicable, also my SEBI LODR regulations will also be applicable. That's what applicable legal and regulatory requirements. On the other hand, I am a banking company, then for me my accounting standards will be applicable, generally accepted accounting principles and practices will be applicable, my RBI Act will be applicable, my Banking Regulation Act will be applicable, my RBI framework will be applicable, my Companies Act to that extent of companies formation will be applicable, my Schedule 3 will not be applicable. So it will be changing from entity to entity. In case of an insurance company, my IRDA regulations will be applicable. In case of an NBFC company, RBI, NBFC provisions will be applicable like that. Wherever the applicable financial reporting framework which are applicable to that entity, the auditor has to evaluate what is first of all applicable to you and your financial statements in all material respects comply in accordance with applicable financial reporting framework or not. That is what the point that the auditor has to look into. Applicable financial reporting framework. FRF is a very important aspect here. This is with regard to the accounting part. With regard to the reporting point from the auditor, where you have two types of reporting. One is fair presentation framework, other one is compliance framework. In India, we use fair presentation framework predominantly. 95% fair presentation framework is used, where the auditors goes and comments on the truth and fairness of the financial statement. The financial statement reflects true and fair view. It's nothing but the fair presentation framework. Also explicitly acknowledging the responsibility of the management with regard to preparation and fair presentation of the financial statements are of the responsibility of the management and not the responsibility of the auditor. Like that, we will be making an explicit acknowledgement of the responsibility of the auditor and also of that management. It is something called as fair presentation framework. On the other hand, in a compliance framework, we will be just reporting, yes, it has been complied. That's it. This act has been complied with. Nothing to do with the truth and fairness of the financial statements and all. So we, in India, where predominantly we use the fair presentation framework only, where truth and fairness, the financial statement reflect true and fair view, like that we give a report. In a banking scenario, we report the financial statements give full and fair view, like that based on banking regulations, we report that accordingly also. Why true and fair, why not true and correct? That's a different topic, because reasonable assurance is what that is expected from an auditor, and absolute assurance is not to be expected to be provided by the auditor, because the financial statement by itself is having inherent limitations in the preparation, estimates, judgments, going concern, assumption by itself is involved. So I cannot go for 100% preparation perfectly. When preparation by itself is not 100%, I cannot give an assurance for 100% in that particular manner. So there is a fair presentation and there is a compliance framework that is to be reported here. The auditor forms an opinion on the financial statements whether they are prepared as per applicable financial reporting framework. If in all material aspects that the financial reporting framework are in compliance with the financial reporting framework, I have sufficient appropriate audit evidence that it is complying, I will say the financial statement reflects true and fair view. That is nothing but a clean opinion, otherwise unqualified opinion, otherwise unmodified opinion that shall be provided by the auditor. SA 700 talks about providing a clean opinion where you have sufficient appropriate audit evidence, where you also have sufficient appropriate audit evidence that the financial reporting framework has been in all material respects has been complied by the financial statements here. The auditor must conclude whether sufficient appropriate audit evidence has been obtained to be reasonably sure that the financial statement as a whole are free from material misstatements. The auditor's report includes the title, addressee, opinion, basis for opinion, responsibilities and signature. And the auditor specifies the applicable financial reporting framework such as Ind AS, IFRS or compliance framework. The opinion section must clearly identify the entity, the state its financial statements were audited, list the statement audited, refer to the notes and specify the dates, periods covered. The auditor expresses an unmodified opinion when the finance statements comply in all material respects with the framework here. This is what exactly that I have told you. I will be going for an unmodified opinion. There are two types of opinion and two types of opinions only. What are all the two types of opinion? One is an unmodified opinion, the other one is a modified opinion. In case of a unmodified opinion, there is no further subdivision. That's it. Unmodified is clean opinion, in other words, where it's a cakewalk. Everybody wants that particular clean opinion. On the other hand, with regard to the modified opinion, we have further three subclassification. Either we can go for qualified or adverse or even a disclaimer of opinion can be given in line with SA 705. SA 705 talks in when and in what situation you can go and provide a qualified, when and what situation you can go and provide a adverse, and when in what situation you can go for a disclaimer like that. SA 705 categorically discusses about those particular facts here. The auditor modifies the opinion under 705 if the financial statements contain material misstatements or if sufficient evidence is not available. The auditor addresses going concern issues in accordance with SA 570 if applicable. The auditor communicates key audit matters for listed entities in accordance with SA 701. SA 701 talks about key audit matter. Sir, what is a key audit matter? Again, there is also one separate essay talks about this key audit matter. There is a misconception. Anything that the auditor feels that it is important, I will be communicating as a key audit matter. Answer is no. That's not the key audit matter. Out of the matters of the current period, which is of most significance, which is already communicated to the management, based on the auditor's judgment that I feel that I need to communicate to the shareholders, I can include the same under the key audit matter. Key audit matter by itself is not a negative reporting by the auditor about the company. Key audit matter is nothing but a complex matter where there are complexities involved, including the audit procedures and performance. The auditor may try to put that particular matter as a key audit matter, and also auditor needs to explain how that key audit matter was verified by me. In no way key audit matter to be considered as a qualification or a negative reporting that is made by the auditor. Key audit matter is just addressing to the shareholders about something most significance which is already communicated to the management. So please be clear, as of now SA 701 key audit matter reporting will be applicable only in case of listed companies. For other companies it is voluntary. If the auditor wants, he can report, otherwise he can keep quiet. I cannot even say that key audit matter is this matter, but I have nothing to report like that. You need not say that. SA 700 format by itself prescribes you don't open your mouth about key audit matter when it is not applicable. Ignore. On the other hand, listed company, necessarily you need to give the fact that it is a key audit matter. If nothing to be reported, give the fact that nothing to be reported. There cannot be a situation nothing to be reported in a listed company. Certainly there is at least one matter to be reported could be there. Unless there is no operations at all, then you can say there is no key audit matter to be reported here. Please be careful on key audit matter reporting. It is applicable only in case of listed entities here. And then auditor's report explains the management's responsibility, auditor's responsibility. In auditor's responsibility paragraph, first line that I am giving is, we have conducted our audit in accordance with standards on auditing. First point is that. It is a will that I am giving and writing that I have conducted my audit as per standards on auditing. Unless I conduct my audit as per standards on auditing, I cannot give that declaration that I have conducted my standards on auditing. So when someone like MCA comes, sir, your audit report says, you have stated the first line under audit responsibility paragraph, you have conducted your audit as per standards on auditing. Yes sir, yes. ₹1 கொடுத்தேனா ₹1 கொடுத்தேன். ₹1 எத்தனை பழம்? 2 பழம். ஒன்னு இங்க இருக்கு, இன்னொன்னு எங்க? When you have stated that you have conducted your audit as per standards on auditing, please prove that you have done your audit as per standards on auditing. That's it. No more questions that I am going to ask you. Please prove that you have conducted your audit as per standards on auditing. Show the documentation. In case I don't have it, in case I am not in a position to demonstrate, then it is deemed that you have not done your audit as per standards on auditing, and that's a problem to the auditor. Please understand, we are trying to bridge the gap between what is expected and what we are performing. So that these are all a documentary perspectives, or there are little bit of improvisation wherever required. Let us improvise. That's not a problem at all. So that we are compliance is taken care is what that we need to remember here. The audit report should be dated only after the auditor has obtained enough appropriate audit evidence to support the opinion. The auditor inserts a mandatory basis of opinion section. Previously, before SA 700 revision, only in case of a modified opinion, I need to give the basis of opinion paragraph. Now, Any opinion that I give, I need to give the basis of opinion paragraph. Irrespective of the fact whether it is modified or unmodified, I need to give the basis of opinion paragraph here. The auditor may refer both essays and ESAs wherever applicable in case of an audit conducted as per standards, as also as per international standards here. When, say for example, a foreign holding company, a subsidiary company, India needs to comply with international standards like that, a group reporting responsibility, I may conduct as per ESA also, but I need to give the fact accordingly here. If the financial statements are prepared under the two frameworks, the auditor covers both the frameworks, that is ESA as well as essays. If supplementary is integral to financial statements, it is covered by the audit opinion. If not integral, ensure a clear differentiation. If not possible, auditor explain that such information is unaudited. Wherever there are other information that is given which is not part of the financial statements, I need to carve out on what item I am giving my opinion, because my opinion is restricted only to financial statements and financial statements only. I cannot extend my reporting responsibility to other aspects also. Let us go for essay 705, sir, so that we will come back. I have a certain separate presentation here. Usually I have a other presentation here. This is essay. This preparation and presentation is based on WSB, but here it is my own preparation where it will have a better effect. Yes, sir. Going to 705. Yes. Obviously, yes, sir. Read with SA 600. Your point is correct. His doubt is, I am a holding company, listed company, subsidiary company is also a listed company. Subsidiary company auditor gives a CAM in his audit report. Whether the same should be reported in the CFS is what his question is. I need to go with SA 600. SA 600 says, any reporting by the component auditor, the reporting entity's principal auditor has to understand the significance of it. Based on the significance that CAM is not significant in the consolidated scenario, I can ignore that particular point, no problem. Yes, sir, permitted. Very valid question. Let's go for the 705, sir, where I take a little bit of deviation from the regular WSB presentation. For better understanding, I give this presentation here. The audit opinion can be divided into two, as I told you, unmodified and modified. Unmodified, there is no further division, it is a clean opinion. Unqualified. Qualified, qualification is equal to not your CA, CMA and all. Qualification is equal to something negative. If there is a qualification, means there is something negativeness. So qualified opinion is a negative opinion that is given by the auditor as a part of modified opinion, and you have adverse, you have disclaimer also. So when to go for qualified, when to go for adverse, when to go for disclaimer. Very, 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 very important point. There are 2 points to be considered, very, very technical. I want you to understand, because many a place the auditor makes a difference, many a places the auditor makes fault in this particular regard. I want to ensure that we are not committing any of these points here. There are 2 important factors to be considered. One is sufficient appropriate audit evidence. The other one is pervasiveness of the material misstatements that are there in the financial statements. Let us go and understand what is this. These are all the elements of the auditor's report. SA 700, title, addressee, opinion, basis of opinion, going concern, material uncertainty. If it is there, then I need to go for reporting it. Key audit matter, in case of listed entity, I need to report it. Other information, all corporate entities, I need to report this particular key, other information as per SA 720. Responsibilities of the management, responsibilities of the auditor, other reporting responsibilities like legal and regulatory responsibilities like 143.3 reporting, CARO reporting, ICOFA reporting and all will be form and parcel of this particular other responsibilities. Signature of the auditor, place, date, including UDIN has to be made in this regard. Key audit matter that we have done. Sir, this is what the points are. If the financial statement is not free from material misstatement, or I don't have sufficient appropriate audit evidence to say that the financial statements are not free from material misstatement, I need to go for modified opinion only. What is mean by modified opinion? You can either go for qualified, adverse or disclaimer. When to go for qualified, when to go for adverse, when to go for disclaimer. What will be the effect if I go for qualified, adverse, disclaimer? Let us understand this clearly. Qualified opinion can be given in 2 scenarios, sir. Are you all with me? After obtaining sufficient appropriate audit evidence, the auditor feels that there are material misstatements, but they are not pervasive to the entire financial statements, I can go for qualified opinion. Or I am unable to obtain sufficient appropriate audit evidence, but based on the judgment, the auditor concludes the possibility of undetected misstatement could be material but not pervasive, still the auditor can go for qualified opinion. There are two scenarios with which the auditor can go for qualified opinion. I am giving a qualification. After having obtained sufficient appropriate audit evidence, the auditor concludes misstatements are material but not pervasive, qualified. Or situation, unable to obtain sufficient appropriate audit evidence, still based on the judgment of the auditor, he concludes the possibility of undetected misstatement could be material but not pervasive, I can go for qualified. Sir, what do you mean by misstatement first of all? What do you mean by material misstatement first of all? What do you mean by pervasive material misstatements? These are all the three encroaching words that I need to go for clarification. What is misstatement first of all, sir? Misstatement is a mistake, sir. Avlodan. Simple. What should be there, what is there is difference is misstatement. 1 lakh should be there, 10 lakhs is there, misstatement. 1 lakh should be there, 1 lakh is there, no misstatement. 1 lakh should be there, 1 crore is there, misstatement. That misstatement can be because of error or can be because of fraud. Whether a misstatement is always a material misstatement, again it is based on the judgment of the auditor to decide a misstatement whether it is material or not. Whether it is going to influence the economic decisions of the users or not, like that, based on various parameters of materiality, in line with SA 320, the auditor shall be deciding whether a misstatement is going to be a material misstatement or not. As per SA 200, if a misstatement, if it is not material, considering the financial statement as a whole, auditor can even leave it. Because auditor's responsibility is only to look at those misstatements which are considered to be material, considering the financial statement as a whole. நம்ம லாஸ்ட் 5 hours விளையாடிட்டு இருக்கோம், அப்படியே சர்ன்னு போயிட்டு இருக்கு. யூ ஆர் ஆல் வித் மீ ஆர் நாட்? எஸ், சூப்பர், தேங்க்யூ. I don't bother in this. I want the aspect to be given, because the purpose of this is not to have a CPE complaints. I completely agree with you. You have spent all your time and energy to have something on this, to identify a little bit of improvisation in our regular understanding is what that I am also trying to have it here. So let us understand very clearly. What do you mean by misstatement? The difference between the amount, classification, presentation, or even a disclosure of a reported financial statement item and the amount, classification, presentation, or disclosure that is required for that item to be in accordance with the applicable financial reporting framework is what the difference is something called as a misstatement. Please be careful. The misstatement need not be only in numbers. The misstatement could even be in disclosures. My numbers balance sheet is absolutely pakka, sir. But on important related party transaction which is to be disclosed, if it is not disclosed, still it will be treated as a material misstatement only because of the disclosure fact. Material misstatement can be because of inconsistency in application of your accounting policy, or inconsistency in application of accounting policy, or even inadequate disclosures shall be resulting in a material misstatement here. So a misstatement which could be either because of fraud or error. Again, the materiality, something on judgment of the auditor. A low value item will not be a material item, no. Cumulative effect of small and insignificant item could also be material. A high value item is always treated as material. And non-compliance of a regulatory requirement will be treated as a material. Like that, there are multiple parameters of materiality. Judgment of the auditor will be playing a very vital role. Let us go and understand the word pervasive. What do you mean by pervasive? Pervasive means spreaded widely. In the context of financial statement, the material misstatements are not confined to a one particular segment. It could be spreaded widely, then it is treated as pervasive material misstatements. I will go with examples so that we will understand here. The effect of material misstatements, possible misstatement, is pervasive. When it pertains to an amount in the financial statement, it is not confined to a specific component, accounts or items of financial statement. If it is not confined to a particular item, then it will be spreaded widely, it is treated as pervasive. Even if it is confined to one particular component, but it is going to have a significant influence, then it will be treated as pervasive. If it is so confined, it represents or could represent a substantial portion of the financial statements, or where it pertains to disclosures, such disclosures or matter therein could be fundamental to the user's understanding of the financial statements. If it is so, it will be treated as pervasive. The term pervasive means spreaded widely. Material misstatements, if it is spreaded widely, then you need to go for a different stand. Material misstatements, if it is not spreaded widely, then we need to go for a different stand. Pervasive material misstatements, non-pervasive material misstatements. Usually in intermediate classes where they have not seen anything after +2, they only see +2. They are kids. They don't know anything about accounts, audit, annual report, this, that and all. I used to have a simple example. I thought we also go back to foundation or intermediate so that we will understand pervasiveness better. This is what that I used to have it in my classroom. Chola dynasty 300 BC, our own Chola dynasty, where this is what the undivided India, then we have head, tail and all completely. And we have, this is what the Chola dynasty's regime. You remember 6th standard social science and all? TTK maps, we would have shaded all this color, Blue Bay of Bengal, Arabian Sea, Dakshashila, Pataliputra and all. Correct? This is what Chola dynasty. In 300 BC. Cholas was very strong in the complete South India, including Sri Lanka. I think this board, you may not be in a position to see, even including Sri Lanka, they have even went to Cambodia there and all. This is Chola dynasty 300 BC. This is Maurya dynasty 265 BC. Some 20-35 years later, this Maurya dynasty was ruling the entire India, except for the core area where Cholas are so strong. Otherwise, that everything was Maurya dynasty only, complete India, including Afghanistan, Kazakhstan, Kandahar, everywhere. They are the one who are ruling. Assuming this is the India map as your balance sheet, if misstatements are confined only to a particular component, it is said to be non-pervasive material misstatement. It is material misstatement but not spreaded widely. The misstatement is confined only in fixed assets. The material misstatements is confined only to salaries and wages. The misstatements are confined only to intangibles. So it is a material misstatement, but it is confined to a particular component. Non-pervasive material misstatement. On the other hand, material misstatements are there spreaded widely. In fixed assets there are material misstatement. In intangibles there are material misstatements. In salary there are material misstatements. In depreciation there are material misstatements. It is like spreaded widely. It is something called as pervasive material misstatements. Are you all with me? So Maurya dynasty is considered to be pervasive material misstatement rather than Chola dynasty is a non-pervasive material misstatement. Now come back for qualified opinion. When I need to go for a qualified opinion? When I have sufficient appropriate audit evidence and conclude that there are material misstatements but they are not pervasive, I can go for qualified, stating that except for depreciation, that the financial statement reflects true and fair view. No problem. There is a problem, but I am carving out that problem and give true and fair view. Even though I don't have sufficient appropriate audit evidence, I feel the possibility of material misstatement can be confined to one or two components. It is not having a pervasive effect. Then I will carve out those items and then say, in spite of the fact I don't have second scenario, I don't have sufficient appropriate audit evidence, still based on the judgment, the auditor concludes the possibility of undeducted material misstatement could be material but not pervasive to the financial statement as a whole. I may go for qualified opinion. Except for this item, financial statement reflects true and fair view. Auditor will be giving this. Are you all getting? Sir, when there is no material misstatement, what do you need to do? Unqualified. It's a clean opinion. The financial statement reflects true and fair view. Like that, a cakewalk will be given. The second type of modified opinion, something called as adverse opinion. When adverse opinion can be given? In the adverse opinion, what the auditor says is, the auditor says the financial statement do not reflect true and fair. I say he is wrong. When I can say he is wrong? Only if I have audit evidence that he is wrong, then I can say wrong. Otherwise, I cannot open my mouth. Exactly, that is what the position in adverse opinion, when the auditor obtains sufficient appropriate audit evidence. After obtaining sufficient appropriate audit evidence, the auditor concludes that there are material misstatements that are pervasive. The financial statements do not reflect true and fair view. Adverse opinion are given. Negative, adverse, completely opposite. Financial statement do not reflect true and fair view, like that I give. What is the basis? Why I am giving do not reflect true and fair view, like that I give the basis? Because depreciation is misstated, salaries are materially misstated, fixed assets are materially misstated, receivables are materially misstated. I go financial statements are containing material misstatements that are spreaded widely, pervasive material misstatements. I have audit evidence also for that. I give financial statement do not reflect true and fair view. Are you getting it? In classroom, what will happen, sir, when I say this, immediately people will say, sir, in doubt, yes, sir, please proceed. He will become chartered accountant, I know that. when he has a problem or doubt in this, he will become a chartered accountant. He will say, sir, if depreciation is materially misstated, then profit is also materially misstated. If profit is materially misstated, then your net worth is also materially misstated. If net worth is materially misstated, your liability is also materially misstated. So materially misstated is spread widely only. வெரி குட், சூப்பர், நல்ல கொஷின். உனக்கு ஒரு பல்லு வலிச்சதுன்னா அந்த பல் வலி எல்லாத்துலேயும் இருக்கும். எல்லா பல்லையும் எடுப்பியா இல்லை அந்த பல்லை மட்டும் எடுப்பியா? The effect of material misstatement could be there on every item. It is arithmetical effects. That you cannot see it is materially misstated pervasive. Individually, component wise, it is materially misstated. எல்லா பல்லுலையும் there is a problem, then you need to remove everything. That is what the example that you used to say, because people will, it's very common to understand pervasiveness accordingly, because there are material misstatements is what they may think. We need to be very careful. If there is a component, that component alone you remove and then say finance statements are reflecting true and fair. If there are multiple components, all are bad, then you need to say finance statement do not reflect true and fair. You need to have audit evidence accordingly. Are you getting it? Super. Then the last type of modified opinion, something called as disclaimer of opinion. Even NAFRA cannot understand what is this disclaimer of opinion. NAFRA says, you have given only disclaimer. No, you are wrong like that. Auditor maximum can give only disclaimer of opinion. That this fact is not understood by them, the great regulator of India, with regard to the audit quality. They say, sir, when disclaimer of opinion can be given? When disclaimer can be given? When I do not have sufficient appropriate audit evidence, but I feel, based on the judgment, I conclude that could be possibility of material misstatement and pervasive, I don't give any opinion, because I cannot say he is bad, because I don't have evidence. I cannot say he is good also, because I know he is going to be bad, so I am withdrawing my reference in this regard, something called as disclaimer of opinion. Disclaim, I don't give any opinion at all. Where I am unable to obtain sufficient appropriate audit evidence to form an opinion, I am unable to form an opinion, then only I need to express an opinion. Here, because of the restrictions that are caused by the management. Sir, why I am unable to obtain sufficient appropriate audit evidence? Is it because of my incapacity? No. Management doesn't permit me to do the verification. There is a restriction in the scope. Books of accounts is not provided to me. When management restricts me, when I feel that there could be possibility of material misstatements and that too pervasive, I need to go for disclaimer of opinion. Sorry, sir, I don't give any opinion like that. I come out of this particular financial statement is what something called as disclaimer of opinion. All types of modified opinion over. Which is most negative to the management, sir? Qualified, clean, qualified, adverse disclaimer. Edu? Disclaimer or adverse? Adverse? In clean opinion, truth and fairness is there. In qualified opinion, except truth and fairness is there. In adverse opinion, truth and fairness is not there. In disclaimer of opinion, no opinion is being provided. I used to give as an example when I say in intermediate, when I take class, in final, when I take classes, the parents of the students will never come and see me, because the students would have trained their parents, now where a level course padikiran, you should not open your mouth. So they will be pushing their parents away. In foundation, the parents will be more interested about their student, how they are reading, how they are performing and all. In inter, to certain extent, assuming that a parent comes and asks, sir, how is my student is performing in the classroom? Sir, beautiful, sir, he is very regular, perfect, he is preparing, and he will be clearing his CA. What is the opinion that I am giving? Clean opinion, super, correct. Sir, he is coming to the class, but he is sometimes in it takes phone and then chats, we need to improvise, sir. What is the opinion that I am giving? Qualified. Sir, he is not at all understanding the concepts, he is not listening at all, he is looking there, here. Very difficult, sir. If the same continues, it will be very difficult for him to complete his CA. What is the opinion that I am giving? Adverse. Sir, who is your son, sir? Our class I have not seen once. At least in the adverse opinion, father is happy, my son is sitting inside the classroom, but he is not attending. Here, he is not even coming to the class. Even books of accounts are not provided in case of a disclaimer of opinion on account of restriction to the auditor. Please understand. When I say that I have not been given access, when nothing was provided to me, to the shareholders and to the reporting regulatory authority, they will take into task. Something very, very difficult for the company to manage. Disclaimer of opinion, especially on account of restriction on the scope of audit, is going to be very, very serious for the company. Adverse is negative only. Adverse is most negative, I understand. But disclaimer on account of restriction is something considered to be very impactful here. So this is what the restriction, this is what the opinion matrix with which my audit opinion can be there. This is what SA also suggests. Two parameters are sufficient appropriate audit evidence and pervasiveness in the financial statement. If I don't have, what will be the effect? When material but not pervasive, if financial statements are materially misstated, material but not pervasive, go for qualified. Irrespective of the fact, inability to obtain sufficient appropriate audit evidence, material but not pervasive, still go for qualified because no pervasiveness. If pervasive is there, when financial statements are materially misstated, I know that there are materially misstatements and pervasive misstatements are there, adverse opinion only. When I don't have sufficient appropriate audit evidence, disclaimer of opinion is what the matrix, decision matrix with which I need to conclude on SA 705. Are you getting it? Super. This is what the truth and fairness is. No true and fair view, no opinion on the truth and fairness here. Let us proceed for another simple essays. Essay 701 that we have discussed, sir, something about key audit matter may not be very squarely applicable to everybody. Only in case of listed entity, key audit matter will be applicable. Essay 706 is considered to be very, very, very important, sir, because of the practicality. I'll go for 706 discussion. Emphasis of matter, other matter. What do you mean by emphasis of matter when it is to be given? What do you mean by other matter? Sir, 5:15 is what my timing, or what's the timing with which I need to close? 5:15. I take 5:15. Are you with me? Okay, sorry. See, it's not sorry. It is the time that is given for me. 5:15 is what the time that is given in the schedule. I'll try to complete that within the schedule there. Sir. There is no standard for 5:15. Very good. Sir, whether we complete 10 standards, 20 standards, 30, 35 standards for that matter, what we get is what important, sir. Standard numbers are not the matter. Whether we close now, that's not a matter. I have the satisfaction that we have dealt with, we have absolutely, practically, we have discussed. That is more than sufficient, sir. We are not here to something learning and all is there. We are trying to practically understand a point. That's it. One point. That's more than sufficient. Purpose is solved. Do you agree with me or not? Proceed. Let us go for 706, sir. Emphasis of matter. Beautiful essay, sir. When emphasis of matter to be given, when other matter to be given. Pre-revised essay, we need to understand. Assuming that there is a going concern effect. Pre-570, before revision 570, when there is a problem with regard to going concern, but the going concern is valid. Going concern issue is there, but the management feels going concern is valid. Then auditor, in order to give the fact to the shareholders, there is a matter on going concern, however going concern is valid, like that I need to indicate to the shareholders. Usually, we used to give, as per standard essay 706, we need to give emphasis of matter paragraph. What do you mean by emphasis of matter paragraph? Emphasis of matter is a matter which is fundamental to the user's understanding. Very, very important. Which is fundamental to the user understanding, which has been already disclosed in the finance statements by the management. I am giving only reference to that particular note of the management. I am not modifying my opinion, something called as emphasis of matter. As the name denotes, I emphasize this particular matter. That's it. I am not modifying, I am not saying it is negative. I am important matter that is fundamental to the user understanding. I am drawing the attention of the users is what something called SA 706. Previously, when going concern is having a material uncertainty, but going concern is still valid, the auditor is expected to give SA 706, drawing the attention about the going concern effect. But now today, after SA 570 revision, after SA 706 revision, I cannot give emphasis of matter on account of going concern because as per SA 570, read with SA 700, I need to include a separate paragraph called material uncertainty relating to going concern. Like that, I need to include a paragraph. In that, I need to give what is the material uncertainty, where the management has already disclosed that particular fact, draw reference to that particular discussion, and then say the fact that we are not modifying our opinion. Accordingly, we need to include that paragraph. When you carefully remember, today we are talking about Indigo, and this, that, and all, where Jet Airways, the last published financial statements of Jet Airways contained this particular emphasis of matter paragraph. When there is a question on the going concern and all, they have given emphasis of matter paragraph and going concern is valid, like that they have stated here. So where the point that I am driving here home is, it is not very often we can just like that go and give emphasis of matter so that I am discharging my responsibility like that. Please don't do that. Emphasis of matter can be used only in the specific scenarios that is discussed in SS 706. Sometimes what happens, in order to protect us, we ourselves expose us. I give you an example. Debtors and creditors are subject to confirmation and reconciliations. Like that we might have seen notes in the financial statements. Do you agree with me? I have sent debtors confirmation. They have not given. They say, sir, industry practice they will not say. So in order to protect me, I will include a note in the financial statement stating that debtors and creditors are subject to confirmation and reconciliation. Abba, I am protected. So tomorrow somebody asks a problem in debtors and creditors, go and see the notes. I have safely stated like that. Sorry. When you give that particular note, when debtors and creditors are considered to be substantial in the finance statement, that itself indicates that you don't have sufficient appropriate audit evidence of a particular component. You should have qualified your opinion. 705 will be applicable. I don't have sufficient appropriate audit evidence, the possibility of material misstatement, but not pervasive like that. Assuming you go for it, then you should have qualified. Without qualification, by protecting, I give a response. That itself is an indicator that you have not done your duty properly. FRRB gave a specific direction that if at all you are given like this, it is wrong. You should have gone for a qualified opinion like that. So the point that I am driving here home is usage of emphasis of matter is to be very, very careful. Only when a matter which is fundamental to the user understanding, which is already disclosed by the management, I need to include that matter based on the auditor's judgment. I need to draw reference to that particular matter, something called as emphasis of matter paragraph, number 1. 2, other matter paragraph. What is this other matter paragraph? It is not as fundamental as that of emphasis of matter, as the name denotes. A matter which is not disclosed by the management, but I feel disclosing that will give a better understanding about audit, about auditor's responsibility and auditor's report, I give other matter paragraph. Say for example, like SA 706 read with SA 600, where audit of component has been done by these people like that, I give an other matter paragraph. To better understand about audit, auditor's responsibility and auditor's role, other matter can be given. I need to say that it is not a modification. Both emphasis of matter and other matter is not a modification to the audit report. I need to draw reference to the, in case of emphasis of matter, I need to draw reference to the fact of the reporting made by the management, which is of a fundamental to the user understanding here. SA 706 issued by ICA deals with the inclusion of emphasis of matter and other matter. An emphasis of matter highlights a matter appropriately disclosed in the financial statement in the auditor's judgment is fundamental to the user's understanding, then emphasis of matter. Other matter paragraph relates to matter not disclosed in the financial statements, but relevant to the user's understanding about the audit, auditor's responsibility, auditor's report. I need to include it as an other matter paragraph. These paragraphs do not affect the auditor's opinion. And just like that, I cannot give everything under emphasis of matter. I need to ensure the importance of emphasis of matter accordingly. The auditor includes such paragraph based on professional judgment and after communicating with those charged with governance here. This is what emphasis of matter and other matter here is. We have discussed completely, especially in light of SA 570, we need to remember very carefully with regard to emphasis of matter. When emphasis of matter to be placed in the audit report, there is a placing requirement also there. Say for example, opinion paragraph, basis of opinion paragraph, emphasis of matter to be given. In case material uncertainty is coming in, then in that particular case, opinion, basis of opinion, material uncertainty related going concern to be there, and then only you can have an emphasis of matter here. Super. I'll go with one another essay, another 10 minutes. I have essay 710. I'll just touch upon so that there is no point that I have not touched a particular essay. Essay 710, very simple essays, not much of complications are there. Essay 710 talks about comparative information. Comparative information can be of two types. One is corresponding figures, other one is comparative financial statement. In Indian scenario, Indian context, we go only with corresponding figures. We don't give comparative financial statements itself. No. In the financial statements, we give only the comparative or corresponding figures is what that is given here, and not the comparative financial statements by itself. So how it is to be placed when the comparative financial statements, that is when comparative figures involves previous auditor's work, how it is to be taken care is what the SA 710's specific aspects here. SA 710 issued by ICAI deals with the auditor's responsibility relating to comparative information in an audit of financial statements. What do you mean by comparative financial information? Comparative financial information may be corresponding figures or that of comparative financial statements by itself. The auditor shall evaluate the comparative information is presented in accordance with applicable financial reporting framework. First point, if the prior period's financial statements were audited by another auditor, this is considered to be relevant, read with SA 510. If the prior period's financial statements were audited by another auditor, a reference to the predecessor auditor's report shall be made wherever, if it is permitted, wherever applicable, we need to make. Where it is to be made, in line with SA 706 it is to be made. Other matter paragraph, we need to make this particular one, because predecessor work I am going to solely rely on the closing balances, which becomes the opening balance of the current year, and then it becomes the corresponding figures of the current year, and then I need to go for giving the reference of the previous auditor's work also. Very interestingly, there is one point, I'll take that particular point here. If it applies when information is presented as a corresponding figures or comparative financial information, the auditor must evaluate whether comparative information complies with applicable financial reporting framework. Yes. The auditor must verify the accounting policies are consistent. Fine. If a material misstatement is found in prior information, that's what, very important, where previous number you find is a material misstatement, the auditor must perform additional procedures in line with SA 560. They go with 560 because that particular number is materially misstated, will have effect in the current year financials also, because previous opening balance becomes a current year, previous closing balance becomes the current year opening balance. If there is a modified opinion, especially in the previous year, I want your understanding, when previous year contains a modified opinion financial statements, what does it mean? There is a material misstatement, that material misstatement is uncorrected, that's why there is a modified opinion. Do you agree with me? It may be the modification can be adverse, modification can be qualified, can be discussed. There is a modification. That means there is a material misstatement. The material misstatement was uncorrected. If it is corrected, I would have there could be a clean opinion could have been done. That uncorrected material misstatement now becomes my opening balance, which may have effect on my reporting financials also. In such a case, what I need to do? Whether that modification has been rectified in the current year. Whether the financial statements in which I am going to report also having the same negativeness or not. Whether the virus has been removed or not is to be reported. Where the virus has been removed, no problem for me. If the virus is not removed, then what is the effect on the current financial statement? Should I also need to go for a modification? Like that, I need to go for taking up with those charged with governance, make amendments to the financial statements, and then report it accordingly. Is what 710's effect. This is to be read in line with SA 510 that talks about initial audit engagements also. Both are to be read hand in hand here. Other matter paragraph to be given by the auditor, because I am going to rely on the work done by it. Please be careful, sir. This is another mistake that people usually used to do. Whenever you are taking up the statutory auditor for the first time, I am going to do an initial audit engagement. Previous audit report which you are going to rely upon, necessarily SA 706 to be included. Other matter paragraph to be included in your audit report. Are you making it right? So this is the first time I am going to do the audit of this financial statement, previously audited by other auditor. I need to mandatorily include SA 706. Other matter paragraph stating that the initial opening balances are audited. Previous year financial statement has been audited by XYZ and Co. And they have reported their report dated so and so, which is an unmodified opinion. Like that, I need to give information in the other matter paragraph, which is the format and illustration is given in SA 510 illustration itself. That is a point to be noted here. I go with the last essay with regard to SA 720, another interesting essay that is applicable to everybody except for non-corporate entities. Auditors' responsibilities relating to other information. Sir, what do you mean by other information? Sir, my objective, my scope, my responsibility all restricts only to financial statements. There is no further extension of my responsibility other than the financial statements. However, in the annual report that is given by the management, there are multiple data and information that is presented to the shareholders, users of the financial statements. As an auditor, being a statutory auditor responsible for the financial statement expression of an opinion wherein the financial statements are going to rely upon, it is also my responsibility as per SA 720 that to read the other information that are presented along with the annual report. There are management discussion and analysis, performance reporting, CSR reporting, like that. There are multiple other data that is given to the shareholders. If at all there are any information that is inconsistent with that of the financial statements, the auditor's responsibility is to draw to that particular inconsistency and ask the management to correct that particular inconsistency. Say for example, the company for the past 2 years incurring losses. That is what the financial statement, I have given my opinion appropriately. In the management discussion analysis, the management says, consecutively for the 10th year, the company is making profits. Your company is boosting, I'm expanding my process, like that. They give one information which is inconsistent with that of the financial statement, which is wrong factually. So I need to read it, and wherever there are inconsistencies, material inconsistencies, again, it is not every line I need to go, every data wise I need to go, no. Again, material aspects will be applicable in that case. If there is something which is inconsistent, I need to draw attention of the same and then try to modify, try to make the amendments in the financial information or that particular other information. If the management is not doing it, then I need to report to the shareholders accordingly, is what SA 720 talks about. Very importantly, many times what happens, sir, auditor will give the report, but the management may not give the annual report to the auditor. It is underprinting and all. So before giving my audit report, they need to give this annual report. Then only I can read it. Then only I can include it in my audit report. If at all something I am going to give the audit report and later on the management is going to do it, how it will be possible? Practically it is not possible. So what the SA gives the suggestion is, sir, no problem, practically it is how that will happen, but get the draft report of annual report and then read it, at least to the nearest closure point that you read it, and then get an acknowledgement from the management. You will share the finalized version and there is no inconsistency, like that you get a declaration and then proceed like that. There are other information related matter to be reported by the auditor under SA 720. Please be careful, SA 720 is applicable to all corporate audits. Whether it is a private, public, listed, unlisted, I need to include a SA 720 paragraph, other matter paragraph. I need to say that I need to read, and in case of any inconsistencies, I need to report it to the users of the financial statement. We have nothing to report in this case, like that. You need to go for reporting. If there is something to be reported, you need to report that particular fact also after in discussion with the management here. Are you getting it? Nandri Vanakkam. 5:15. I'm sorry. I really thank you all people for your rapt attention. A wonderful evening. I am very satisfied that I made certain good deliberations and discussion. It's my satisfaction. It is you to give the feedback. But I feel that it was a very good audience, very relevant people, very relevant discussions. Practically is what that I thought we made it. And very happy. I will be in a position to have any of your queries. I think my contact numbers are not given. If required, you can take down. My mobile number is 999. With you by the WASB and the SIRC here, and any clarifications in any of these particular standards, we shall be very happy and glad to discuss and deliberate with you all people, with all your knowledge and practicality. I'm so happy to have a discussion with you all people. Thanks to WASB for making this event, and thanks to SIRC and all the office bearers to effectively coordinate and have a smoothful conduct of this 2 days sessions here. Thank you all once again, and with pranams. Super. Thank you. Exactly, you are right. That's the impression that I want to create by giving this, and it reaches. Thank you. Thanks for your heartfelt feedback. Thank you.
So we also want to take the opportunity to thank you for this insightful and wonderful interactive session. Thank you so much, sir. Okay, with this we'll conclude the session. Thank you all.